Hello friends, welcome to Navkar Digital Institute. Friends, today I am trying to cover each and every Ind AS for revision purpose in this short span of time. Revision is a key to success. We will cover each and every topic, and whenever it's needed, we will also cover some practical topics also. Clear? I am starting with number 1, that is nothing but a basic topic, that is called the Introduction of Accounting Standard. Then I will take the introduction of the Indian Accounting Standard, and then friends I will take that is nothing but all the Indian Accounting Standard one by one. Clear? This revision series is for the CA final new syllabus students who are appearing in the November 2020. That exam is already delayed. Clear? So without wasting much time, let's start revision of the financial reporting subject, and in that financial reporting subject I will cover each and every Indian accounting standard. Clear? Okay friends, so my purpose is nothing but revision of Indian accounting standard, and first topic I am starting, that is nothing but introduction of accounting standard. Number of CA final students are thinking whether this particular topic is relevant for exam. Answer is yes. Introduction of accounting standard is also relevant, and the introduction means applicability of the Indian accounting standard is also relevant for an exam purpose. Clear? First of all, friends, if we discuss what are the objectives of accounting standard. If I give two name of company, one is nothing but the Tata and the second is nothing but the, let's say, Reliance. Clear? And if I am preparing just the statement of profit and loss in a T format, the both companies have purchased one unit on the 15th March and the one unit at a price of rupees 10, and the second unit they have purchased, that is nothing but on 25th March, and the price is nothing but, let's say, 15 rupees. Let's say 15 rupees. My problem is very clear. If assume that Tata is following the FIFO method for the valuation of inventory and the Reliance is following the LIFO method for valuation of inventory, no doubt Ind AS 2 is not allowing the LIFO method, but just I am taking an example. If Tata is following the FIFO method and out of 2 units they have sold 1 unit, can I say in the closing stock of the Tata they are having the 1 unit? And if they are following the FIFO, so they sold the unit of rupees 10, but the closing stock is at rupees 15. Is it okay? But whenever I am talking about the Reliance is following the LIFO method. And if the Reliance is following the LIFO method and out of 2 units, if the Reliance has sold the 1 unit, in the closing stock of Reliance, they find the closing stock of rupees 10. Is it clear? Can I say my basic objective of the accounting standard is nothing but, accounting standard helps to standardize the different accounting policy. You know very well, for inventory valuation, basically there are 3 types of method, FIFO, LIFO and the weighted average. But as per accounting standard 2 and as per Ind AS 2, only 2 methods is allowed, that is nothing but the FIFO and the weighted average. So my first method is nothing but the standardize the different accounting policy. Clear? Second, can I say this accounting standard help us to eliminate the non-comparability of financial statement? Can I say one line? If the both companies have followed the same accounting policy for the valuation of inventory, profit of the both company will be similar. Can I say this profit of the Tata is higher by rupees 5? Why? Because the closing stock is higher. Clear? You know very well, if your closing stock is higher, your profit is higher. Closing stock is lower, your profit will be lower. If your opening stock is higher, your profit will be lower. And if your opening stock will be lower, your profit will be higher. Is it okay? Simple. There is a direct relationship between the profit and the closing stock. There is an inverse relationship between the profit and the opening stock. And the third objective, if any company is following the accounting standard or the Indian accounting standard, obviously it adds the reliability of the financial statement. If I am giving 2 financial statements in your hands, one company is following the accounting standards or the Ind AS, but second company is not following. So obviously the company who is following the accounting standard provides the more reliable results and the more reliable the financial performance and the financial position of an entity. So if anyone asks you what are the objectives of accounting standard, there are 3 objectives. It standardizes the different accounting policy. It eliminates the non-comparability of financial statement, and it adds reliability of the financial statement. Clear? Next, why we need to follow the accounting standard? Friends, it's in India. In India, if something is compulsory, then people will follow, otherwise people will not follow that particular method. Problem is that basic preparation and presentation of financial statement is actually a responsibility of the management. And at the time of the preparation of financial statement, under section 133 of the Companies Act 2013, it is clearly mentioned Every company has to follow accounting standards suggested by the central government, means suggested by the MCA, Ministry of Corporate Affairs. Clear? That was mentioned in the section 133 of the Companies Act 2013. You know very well, every company is preparing the director's report. Because the basic preparation and presentation of financial statement is the responsibility of the management. So whenever you are preparing the director's report, in director's report you are presenting one statement. And that statement is nothing but the director responsibility statement. In director responsibility statement, you have to write that your company had followed all the applicable accounting standards. It may be possible accounting standards or it may be possible Ind AS, whatever the situation. Clear? Please remember, section 133 suggests that every company has to follow accounting standard. In section 134, we are preparing the director's report, and in director's report, we are writing one statement that is called the director responsibility statement. And in director responsibility statement, we are writing that we have followed all the applicable accounting standards of the Ind AS. Don't you think so? Whatever writing in the director's report is nothing but the self-declaration. And if it is a self-declaration, actually, if you ask me, it is not much more reliable. And if it is not reliable, that's why one section is introduced, that is called the section 143 of the Companies Act 2013. And as per section 143 of the Companies Act 2013, it's a responsibility of the auditor to check the financial statement of the company whether they have followed applicable accounting standards or Ind AS or not. If not followed, auditor may qualify its audit report. Clear? Simple. Please remember three sections. Basic preparation and presentation of financial statement is the responsibility of the management. As per section 133 of the Companies Act 2013, every company has to follow accounting standard. Section 134 suggests the director's report, and in director's report we will write the one statement. That statement is known as a director's responsibility statement. And in a director responsibility statement, simple, you have to write you had followed all the applicable accounting standard. But it's a self-declaration. That's why we have given an opportunity to the chartered accountant under section 143 to audit the accounts, and if the applicable accounting standard is not followed by the company, auditor may qualify its audit report. Clear? So we have covered section 133. We have also covered section 134, subsection 5 and the clause A. And in the last section, section 143, I am just reading section 143, subsection 3, clause E of the Companies Act 2013 requires that auditor has to report whether in his opinion the financial statements comply with the accounting standards referred in section 133 of the Companies Act 2013 or not. If not, auditor may qualify its audit report. Clear? Okay. So this is a mandatory to follow the accounting standard. But yes, now we are discussing the advantages of accounting standard. ICA may ask one question. Write down the advantages and the disadvantages of the accounting standards. Simple, you have to write this number of points. Clear? Friends, in a market, we have different accounting policies. Like simple, if you ask me, for inventory valuation, we have different accounting policies like FIFO, LIFO or the weighted average. Ind AS 16, we can use the cost model or the revaluation model, or we can disclose the asset at a fair value. That is a third choice also. For accounting of the government grant, we have again various options like for if we are receiving any government grant for the depreciable asset. One option available is that that amount of the grant should be deducted from the cost of the asset. Or if you don't want to deduct from the cost of the asset, you have a second option. And that option is nothing but that amount of the grant is disclosed on the liability side in the heading of the deferred government grant. Clear? For again, like if I discuss the Ind AS 38 intangible asset, for amortization of the intangible asset, actually we should amortize the intangible asset in the ratio of the future consumption. But if that is not reliably measurable, we can use again the straight line method. So actually, if you ask me advantages of the accounting standard, simple, it eliminates altogether confusing variation in the accounting treatment used to prepare the financial statement. Clear? Second, it may be possible some information is not required by law. Clear? Like let's assume it is not required by the Companies Act 2013, but that is required by the Ind AS or accounting standard, then you have to disclose. Friends, please understand, there is a common line. If there is any contradiction between the Companies Act 2013 or the Indian accounting standard, Ind AS will prevail to the Companies Act 2013. Means if there is any contradiction between the Companies Act 2013 and the Ind AS, friends, you have to follow the Indian accounting standard. Clear? So it may be possible some information is actually not required by the law to be disclosed, but standard may call for disclose beyond the requirement by the law. Clear? Next. Third, if I discuss the advantage, we can easily compare the financial statements. And whenever I am using the word the comparison of the financial statement, please understand, we can compare the financial statement of the current year with the previous year of the same entity, or we can compare the financial statement of the current year of the one entity with the financial statement of the current year with another entity. Clear? So simple, this comparison is possible. So if anyone asks you what are the advantages, simple, there are three advantages. It eliminates the confusion for selection of the accounting policy. Number two, if some information is actually not required by law, but accounting standard or the Ind AS may call for the disclosure that is beyond the requirement by the law. And simple, third is nothing but we can easily compare the financial statement. Each coin has the two sides. If there are some advantages of accounting standard, obviously there are some disadvantages also. Actually, if you ask me, we are following the rigid view. If it may be possible, LIFO is preferable for my business for valuation of inventory. But can I say accounting standard 2 or the Ind AS 2 is only suggesting the FIFO or the weighted average? So I have no choice. I have to compulsorily follow either FIFO or the weighted average. I am not having the option to follow the LIFO method. So it's actually the rigid view. And there is and away from the flexibility in applying the accounting standard. Clear? Number 2. Choice between the better alternative accounting treatment in a particular situation is eliminated. If some situation is actually better for me, but if that was not mentioned in the Indian accounting standard, I cannot follow that. Clear? So simple, please remember, whenever institute asks a question of the compliance accounting standard, you should write 4 points. Number 1, basic preparation is responsibility of the management. You should give the reference of section 133, 134 and the 143. If institute asks the advantages of the accounting standard, 3 points. First is nothing but, that is, eliminate the confusion. Number 2, that is nothing but the easy comparison of the financial statement. And the number 3, if information is not required by law, but accounting standard may call for that information. In simple disadvantages, only there are 2 points. Clear? Let's go ahead without wasting much time. If anyone asks you, how many accounting standards are there? So friends, please understand, actually there are 32 accounting standards. Clear? But from that 32 accounting standard 6 and the accounting standard 8 is already been withdrawn. Accounting standard 6 is basically for the accounting of the depreciation that was merged with revised accounting standard 10, which was issued in the 2016, and the name of the revised accounting standard 10 is nothing but the property, plant and equipment. Accounting standard 8 basically deals with the research and development. That is again merged with the accounting standard 26, that is nothing but the intangible asset. So friends, out of 32, there are 2 accounting standards already eliminated. So now we have just 30 accounting standards. And height is that from 30, there are 3 accounting standards. That is nothing but AS30, AS31 and the AS32 was notified by the government, but actually was not an applicable. Clear? It is before the applicability, it was withdrawn. Clear? So effectively, if you ask me, from 30, if I deduct that 3 accounting standards, now effectively we have just 27 accounting standards. Again, I am repeating, actually 32 accounting standards, but the AS8 and the AS6 is already withdrawn. AS8 is merged with AS26, intangible asset, and the AS6 is merged with AS10, that is property, plant and equipment. So actually 30 accounting standard. But actually out of 30, just notified is 1 to 7 except AS6 and the 9 to 29. Clear? AS30, 31, 32 was announced, but actually it was not notified by the central government. So today it is not at all applicable. Clear? Now friends, please understand what I am trying to convey here. Accounting standards are given by the 2 different entities. One is issued by the MCA, Ministry of the Corporate Affairs, and second is nothing but for the ICA. Here I am writing, one is MCA and second is ICA. Don't worry, I will cover each and every topic. Don't worry. Whenever Ministry of Corporate Affairs is issuing some accounting standard, then it is only applicable to the corporate entities. But what about the non-corporate entities? So accounting standard issued by the ICI is applicable to the non-corporate entities. My today's topic is nothing but the accounting standard for the corporate entities, which I am talking about the companies. Number of students are asking me a question, sir, when Ind AS is applicable, accounting standard is not applicable to company. Answer is no. Ind AS is not at all applicable to each and every company. It is applicable to those specified entities. We will check the net worth criteria and all. Clear? So yes, in today's situation also, accounting standard is applicable to some of the companies if they are not fulfilling the net worth criteria for applicability of the Ind AS. So actually, under the old Companies Act 1956, under section 210A of the Companies Act 1956, they have constituted one body, and the name of body is nothing but the NACAS. Full form of the NACAS is nothing but the National Advisory Committee on Accounting Standard. But can I say you are talking about the Companies Act 1956? Today, we have Companies Act 2013. And under section 132 of the Companies Act 2013, they have constituted one body that is called the NAFRA. And what is the full form of the NAFRA? That is National Financial Reporting Authority. Friends, up to 2018, NAFRA was not constituted. NAFRA was actually constituted on the 1st October 2018. So today we are not having any body like NACAS, we are having just a NAFRA. So whatever the accounting standard issued by the NAFRA, that is applicable to the corporate entities. If I just make a summary, under the old Companies Act 1956, friends, we have one body. That body is nothing but the NACAS. Full form of NACAS is nothing but the National Advisory Committee on the Accounting Standard. Today we are having the NAFRA under the Companies Act 2013, and the full form of the NAFRA is nothing but the National Financial Reporting Authority. NAFRA was constituted on 1st October 2018. So any accounting standard issued by the NAFRA, that is applicable to the corporate entities. Clear? Next point. Whether Ind AS, whether accounting standard is applicable to the non-corporate entities, partnership is supposed to follow the accounting standards. Proprietorship is supposed to follow the accounting standard. Trust should follow the accounting standard. Friends, partnership and the proprietorship should follow the accounting standard. If in a trust, your single rupees of activity is related to the commercial activity, then again accounting standard is applicable to that trust also. But sir, everyone is following all the accounting standard, means like difficult one like impairment and the employee benefit and all, cash flow and all. Answer is no. And that's why ICAI has categorized the non-corporate entities into the three parts. ICAI has categorized the non-corporate entity into the three parts. That is level 1, level 2 and the level 3. Clear? Level 1 will follow all the accounting standards. There are some relaxation for the level 2 and the level 3. First of all, you should consider that which entities are covered under the level 1. First, entities whose equity or debt securities are listed or in the process of listing, either in India or outside India. If your equity or the debt securities is listed in India or outside India, you are in the level 1. Next is nothing but any of the bank, financial institution or the insurance companies. Next is nothing but the turnover is exceeding rupees 50 crore in immediate preceding accounting year. Number 4th, borrowing is greater than 10 crore at any time during the preceding accounting year. And the number 5th is nothing but the holding and subsidiary of above. Means if you are in level 1, your holding and subsidiary is also covered by the level 1. Just remember 5 things. Number 1, your debt or equity is listed or in the process of listing in India or outside India. Turnover is greater than 50 crore in immediate preceding accounting year. Borrowing is greater than 10 crore at any time. Means you will not just check the closing balance. If the balance of the borrowing is greater than 10 crore at any time during the preceding accounting year, then simple friends, you are in the level 1. Number 4, any of the bank, financial institution and the insurance company. And the number 5, that is nothing but if you are falling under the level 1, all the holding and the subsidiary company is also covered under the level 1. Clear? This is for the level 1 entities. Now please understand, which entities are covered under the level 2. Whenever I am using the word the level 2, under the level 2, just 3 entities is covered. Number 1, whose turnover is greater than 1 crore, but friends, it is a less than or equal to 50 crore in immediate preceding accounting year. Whenever I am using the word the turnover, it's nothing but just the revenue from operation. We will not consider the other income. Number 2, the borrowing of the entity is greater than 1 crore but less than or equal to 10 crore at any time during the preceding accounting year. It's a greater than 1 crore, less than or equal to 10 crore. And if you are falling in the level 2, your holding and subsidiary is also covered in the level 2. And if I am asking for the level 3, If any entity is not covered under the level 1 and 2, they are covered under the level 3. It's very easy. Level 1 just 5 condition, level 2 just 3 condition, and the level 3 is a residual category. Now problem is that if my turnover is exact 50 crore, whether I am falling in the level 1 or the level 2, sir, you are falling in the level 2, because here I am clearly written, it's a less than or equal to 50 crore. Sir, if my borrowing is exact 10 crore, whether I am in level 1 or 2, sir, you are in level 2, not in the level 1. The problem is that, sir, my turnover is exact 1 crore. Whether I am in level 2 or the level 3, if your turnover is exactly 1 crore, you are in the level 3. Why? Because friends, please understand, here it is clearly written, it's a greater than 1 crore. If it is a greater than 1 crore, then only you are falling in the level 2. If your turnover is exact 1 crore, then simple, you are falling in the level 3 entities. Can I go ahead? Perfect? Okay. Friends, please understand. There are 4 words. There are 4 words called SMC, SME, non-SMC, and the non-SME. SMC matlab small and medium sized company, SME matlab small and medium sized enterprise, and the non-SMC and the non-SME. If you are a company and falling under level 1, then simple, it will be considered as a non-SMC. If you are a other than company and the falling under the level 2 and 3, then it will be considered as an SMC. If you are other than company, means if you are a non-corporate entities and the falling in the level 1, then simply it will be considered as a non-SME. If you are, that is nothing but the non-corporate entities and the falling under the level 2 and 3, then it will be considered as a SME. Can I go ahead? Perfect. If I am talking about the Reliance Limited, then it will be falling under the definition of the non-SMC. Let's assume ABC Limited turnover is just 45 crore. And if the turnover is nothing but just 45 crore, means they are in the level 2. So simply it will be considered as an SMC. Navkar Digital Institute partnership firm. Turnover is 800 crore. Simple. If turnover is 800 crore, we are a partnership firm, means we are the non-corporate entities. Simply it will be considered as a non-SME. Vatsal Shah individual. Turnover is nothing but, let's say, just 3 crores. And if just 3 crore, I am again non-corporate entities. And if I am again non-corporate entities, simply it will be covered under the SME. Clear? So simple, I have covered the topic introduction of accounting standard. Now let's start. That is nothing but introduction of Ind AS. Friends, in the budget of the 2014, at that time our Honorable Finance Minister, late Mr. Arun Jaitley ji, announced that now it's time we have to follow the one accounting language that is applicable to at global level. Because in India, friends, if you understand, we need more FDI. That is called the foreign direct investment. Whenever we need the more FDI, people will check first of all the financial statement of the companies, then they will only invest. And we have to prepare the financial statement in such a way so that they will get the better idea. So now it's time we have to follow the Indian accounting standard. Friends, actually, India is not converted to IFRS. India has followed the concept of the converged IFRS. There is a difference between if India is converted to IFRS or India has followed the concept of the converged IFRS. There are drastic difference between that. Why, sir? There are drastic difference. Whenever I am using the word we have converted to IFRS, means we have directly adopted IFRS as it is. But India has not selected that option. India has taken the IFRS, modified the IFRS as per the Indian economy, and we have selected the option of the converged IFRS, and now we have to check when actually Ind AS is applicable. First of all, in the month of July 2014, in the budget speech, at that time our finance minister, late Mr. Arun Jaitley ji, has announced, now Indian company will follow the Indian accounting standard. That is called the converged IFRS. And in the month of the February 2015, they have introduced the company's Ind AS applicability rules. That is obviously in the month of approx February 2015. Whenever I am using the word, they have issued the company's Indian Accounting Standard Rules 2015. One thing should be clear in your mind. Ind AS is only and only applicable to companies. Other than companies, actually Ind AS is not applicable. So if you are a non-corporate entities, you don't think about the Ind AS, you should follow just and just accounting standards only. My second line is very important. Ind AS is actually not applicable to each and every company. Ind AS is applicable to specified company who is fulfilling some criteria. And if you are fulfilling that criteria, then and then only Ind AS will be applicable. Otherwise, Ind AS is not at all applicable. Clear? Whenever I am using the word company, that company may be registered under the Companies Act 2013 or any other previous law. Means if that company is registered under the Companies Act 1956, then it will be okay. Whenever I am using the word company, it may be a listed company, unlisted company, private company, public company, one-person company, small company, whatever the company. If they are fulfilling, even Section 8 company, even the government company, if they are fulfilling such of the criteria, then Ind AS will be applicable. Clear? And they have announced in companies Indian Accounting Standard Rules, any company may voluntarily apply Ind AS from the 1st April 2015 or the later. Means after 1st April 2015 at any time. Friends, if my company is a newly incorporated company and we want to follow Ind AS voluntarily from the 1st April 2021, can we follow Ind AS? Answer is yes. Voluntarily you can follow from 1st April 2015 or later at any date. This is nothing but my phase 1 company. And whenever I am using the word phase 1 company, it's a mandatory phase 1. Any company whose net worth, we are not checking any turnover criteria, we are not checking any borrowing criteria. In this, we will check the net worth criteria. And whenever I am using the word, the net worth criteria, any company whose net worth is greater than rupees 50 crore should mandatorily follow Indian Accounting Standard from 1st April 2016. This is a mandatory phase. If your net worth is more than 500 crore, then you should follow Ind AS. I think so. You are having a doubt. When should we check the net worth and all? I am explaining. This is from the 1st April 16. And now friends, this is a phase 2. If you are a listed company, irrespective of the net worth, but if you are listed on the SME, that is called the Small and Medium Exchange, then we are not considering you are a listed company, you will be considered as a non-listed company for the applicability of the Ind AS. Means every listed company should follow Ind AS from the 1st April 2017, but any other companies who is having the net worth more than rupees 250 crore should follow Ind AS from the 1st April 2017. Now please understand what I am trying to convey. If we make the summary, from the 1st April 2015, it's a voluntary applicability. From the 1st April 2016, every company who is having the net worth more than rupees 500 crore. From the 1st April 2017, every listed company irrespective of the net worth, but if your company is listed on the SME, that is called the Small and Medium Exchange, then it will not be considered as a listed company for the applicability of the Ind AS, and the other company whose net worth is greater than 250 crore should follow Ind AS from the 1st April 2017. If you are following, then your holding, your subsidiary, your associate and the joint venture should also follow Ind AS. Don't forget that whenever we are discussing the applicability of the accounting standard, if I am in the level 1, then my holding and subsidiary is only in the level 1. We are not touching the associate and the joint venture. But whenever I am talking about the Ind AS, if the Ind AS is applicable to my company, holding, subsidiary, associate and the joint venture is also covered by the Ind AS. And yes friends, in this question, please understand what I am trying to convey. Whether I am following the voluntarily or if I am following the mandatorily, then again holding, subsidiary, associate and joint venture is covered by Ind AS. Let's assume my company name is nothing but the ABC. I am following voluntarily Ind AS from the 1st April 2021. Again, my subsidiary whose name is XYZ should mandatorily follow Ind AS from the 1st April 2021. Sir, why? You have adopted voluntarily. Why your subsidiary should follow? Yes, this is a rule. If you are following, then your subsidiary, associate, joint venture holding is also covered. Clear? Friends, we are not just checking direct relationship, but we are also checking the indirect relationship. Clear? So if I am following Ind AS, my subsidiary will follow Ind AS. And if my subsidiary is following Ind AS, let's say XYZ is having a one subsidiary, that is called the PQR. PQR should also follow Ind AS. Means if holding is following the Ind AS, subsidiary is covered by the Ind AS, and if subsidiary is covered, then sub-subsidiary is also covered by the Ind AS. Clear? Second thing, you should check net worth first time on 31st March 2014. Actually, Ind AS will be applicable from the 1st April 2016. But I am talking you should check the net worth on the 31st March 2014. Man, please understand. If I open the audited financial statement of the 31st March 2014, if my net worth is a 605 crore, Ind AS will be applicable from the 1st April 2016. On 31st March 14, if my net worth is a 255 crore, Ind AS will be applicable from the 1st April 17. Let's assume on 31st March 14, my net worth is just a 5 crore. Ind AS is not applicable. But for the same company, on 31st March 2015, if my net worth, it's let's assume 300 crore. In a 1 year only, because of the great business, we have generated the net worth of the 300 crore. Simple. If I check the net worth on 14, then Ind AS is not applicable. But after 1 year, on the reporting date, if I check the net worth, now it's a 300 crore. So today, I'm making a decision. Ind AS will be applicable from the 1st April 2017. But let's assume, again in the 1 year, they have done the huge business. And on 31st March 16, if they are checking the net worth, so on 31st March 16, the net worth is, let's assume, on 31st March 16, it's 605 crore. From tomorrow, means from the 1st April 2016, Ind AS will be applicable. So it is not like that. Just we are checking the net worth on 31st March 14, story will be finished. You have to check the net worth on each and every reporting date. So it may be possible. It's a reverse situation. On 31st March 14, your net worth is a 605 crore. So apparently, Ind AS will be applicable from the 1st April 2016. But if I check the net worth on the 31st March 16, your net worth is just the 5 crore. Whether we should follow Ind AS from the 1st April 16, answer is yes, you should follow, because we are following always strict conditions. Clear? Second thing. Let's assume I am following Ind AS voluntarily from the 1st April 2021. I followed the Ind AS for the year 2021-2022. But now I am taking a decision. There is no fun in following of the Ind AS. And now I want to follow the accounting standard. Is it allowed? Answer is no. Once Ind AS is applicable, means it is a lifetime applicable. You have no choice. Clear? It's a lifetime applicable. Clear? Simple. Whether you are following the voluntarily or you are following the mandatorily. So simple, net worth shall be calculated as per the standalone financial statement on 31st March 14, or the first audited financial statement for the accounting period which ends after that date. Clear? If company not existed on 31st March 14 or an existing company fall in any limit after 31st March 14 shall apply Ind AS from the immediate next accounting year. Friends, please understand. Please understand. Now I am taking one example. On 31st March 14, my net worth is 5 crore, but I am a listed company. Clear? So simple, whether Ind AS is applicable or not applicable. Some students are answering, sir, our company is a listed company, so actually Ind AS should be applicable from the 1st April 2017. You are not listening my word correctly. My word is very clear. You should check net worth on 31st March 14. You should not check the listing criteria on 31st March 14. If your company is listed on the 1st April 2017, then only then only Ind AS is applicable. Otherwise, it's not applicable. So let's assume this company on 28th March 2017, if it is a delisted. So simple, on 1st April 2017, this is not a listed company. So actually friends, Ind AS is not applicable. Ind AS is not applicable. But let's assume this delist is not on the 28th March 2017. Company is delisted on the 5th April 2017. And if the company is delisted on the 5th April 17, this company is listed on the 1st April 17. And if this company is listed on the 1st April 17, Ind AS will be applicable. So we will check the net worth criteria on the 31st March 14, but we will check the net listing criteria on the 1st April 2017 only. Clear? So simple. It may be noted that immediately before the applicability date, if criteria not met, then Ind AS is not required to follow, irrespective of the fact that criteria was met on 31st March 14. Above note is only applicable to the listing criteria, and same is not related to net worth criteria. Friends, I already covered this particular points is not applicable to three entities. That is nothing but the bank, NBFC and insurance company. So what about the bank, NBFC and insurance company? Let us start first of all, applicability of the Ind AS for the NBFC. Friends, you know very well for bank, if anything is changing, then RBI will issue some notification. For insurance company, IRDA, Insurance Regulatory Development Authority of India, will issue some notification. But for NBFC, rules is given in the company's law only, company's accounting standard rules only. What is the rule? Just remember my one line. Same limit, but applicability is deferred by the 2 years. Means you have to check the normal applicability for the normal companies and just add 2 years, then simply it will be the applicability for the NBFC. Number one, if NBFC has a net worth more than rupees 500 crore, then simply Ind AS will be applicable from the 1st April 2018. Every listed NBFC, because normal is applicable from 1st April 16, so for NBFC it will be applicable from the 1st April 18. Every listed NBFC irrespective of the net worth, but if your NBFC is listed on the SME, then it will not be considered as a listed company for the criteria of the applicability of the Ind AS, and whose net worth is greater than 250 crore, then simply Ind AS will be applicable from the 1st April 19. Because for the normal companies, it will be applicable from the 1st April 17. So here, now it's applicable from the 1st April 2019. Otherwise, the rule is same. If NBFC is covered by the Ind AS, its holding, subsidiary, associate and the joint venture is also covered by the Ind AS. Clear? Okay. If we check for the bank, they have made just time pass. How? First of all, as per notification dated 11th February 2016, they have introduced that Ind AS will be applicable from the 1st April 2018. Friends, believe me, they have started application of the Ind AS. After 5 to 6 days, they have just issued a notification. Then now the Ind AS will be applicable from the 1st April 2019. Before applicability on the 1st April 2019, in the month of March, if I speak exact date, it's 22nd March 2019. They've issued one notification. Now, banking companies will not follow Ind AS till the further notice. Means today, actually, Ind AS is not applicable to the bank. Clear? And as per IRDA circular, that is Insurance Regulatory Development Authority of India, they are applying the Ind AS from the 1st April 2021. Means in the today's scenario, just the normal companies, even NBFCs are following the Ind AS, but the banks and the insurance company is actually not following the Ind AS. Clear? Next point. It may be possible applicability date for the normal entities, means the non-financial entities, and the NBFC, that is called the non-banking finance companies, are the different. Sir, is it possible? Yes, answer is possible. Let's take an example, then you will get the better clarity. I'm talking about. My company name is nothing but the EBC Limited. It's a normal manufacturing company whose net worth is a 505 crore. So can I say, friends, Ind AS is applicable from the 1st April 2016. Ind AS is applicable from the 1st April 2016. Is it okay? There is one subsidiary and the name of subsidiary is XYZ, and XYZ is actually NBFC. And let's assume whose net worth is just a 5 crore. And the NBFC's net worth is just a 5 crore. Obviously, Ind AS is not applicable. Sir, it is not like that. If ABC is following the Ind AS, NBFC should also follow Ind AS. Answer is no. So what should be done? ABC Limited will prepare their standalone financial statement as per the accounting standard, or rather as per the Ind AS. XYZ NBFCs, actually Ind AS is not following, so simple, they will prepare their standalone financial statement as per the accounting standard. But can I say XYZ is a subsidiary of ABC? So ABC should prepare the consolidated financial statement also. And whenever ABC Limited will prepare their consolidated financial statement, they should prepare their consolidated financial statement as per the Ind AS only. Now the problem is that holding company is preparing their standalone financial statement as per Ind AS. Subsidiary company is preparing their standalone financial statement as per the accounting standard. And we should prepare the CFS as per Ind AS. Now you are following me. The data of the both companies are prepared by different set of accounting standards. So it's the responsibility of the subsidiary, associate or the joint venture to convert their data as per the accounting policies adopted by the holding and send the revised data. Means what XYZ will do? XYZ Limited will prepare their standalone financial statement as per the accounting standard only. But whenever they are giving the data to the holding company for the consolidation purpose, they should convert their entire data as per the Ind AS. Clear? It's a responsibility of subsidiary, associate and joint venture. Next thing. Whenever you are preparing the first time Ind AS financial statement, you should prepare 3 balance sheet. Let's assume actually the Ind AS is applicable from the 1st April 2016. Then obviously I will prepare the first balance sheet on 31st March 17 with compared to 31st March 16. There is no doubt at all. But yes, we will prepare one more balance sheet that is on the 1st April 2015. So friends, effectively if you can check, my applicability date of Ind AS is 1st April 2016. But my transition date of Ind AS is not 1st April 16, but my transition date of Ind AS is the 1st April 2015. My word is very clear. I will not prepare the financial statement 3 times. I will prepare just, that is nothing but balance sheet 3 times. Clear? Next point. If simple, let's assume X Limited is Indian company. And let's assume Ind AS is applicable to the Indian companies. His subsidiary is not in India. His subsidiary AINC is an US company. Obviously, if any company is not registered under the Companies Act 2013, if this company is a foreign company, how can I tell them just follow the accounting standard or the Indian accounting standard? AINC will prepare their standalone financial statement as per the requirements of their jurisdiction. Means they will follow the US GAAP. Clear? For example, in India, I want to prepare the consolidated financial statement. Rule is simple. It's a responsibility of the AINC to convert their entire data as per the Ind AS. Clear? It may be a reverse situation. If I am in India, I am following the Ind AS. But my holding company is not in India. My holding company is in US. So obviously if they are in US, they will prepare their standalone financial statement as per the US GAAP. But it's my responsibility from India. I have to convert my entire data as per the US GAAP only. Clear? So simple. Overseas subsidiary, associate, joint venture or other similar entities of Indian company may prepare their standalone financial statement in accordance with the requirement of specific jurisdiction. But CFS are as per the Ind AS if applicable. Next point. Indian company, which is a subsidiary, associate or joint venture of the foreign company, will prepare standalone financial statement as per the Ind AS if applicable. And yes, this is the one thing is very clear. Once Ind AS is applied voluntarily or mandatorily, that option is irrevocable. Means you should follow Ind AS for the lifetime period. Clear? Okay. Just a minute. Okay. Now friends, we are checking how to calculate the net worth. Because under the Ind AS applicability criteria, we are first checking the net worth. And how to determine the net worth? Net worth should be determined as per the section 257, as per section 2 subsection 57 of the Companies Act 2013. What we will cover? Paid up share capital. Clear? After paid up share capital, we will consider the reserves and surplus. After reserves and surplus, securities premium. Then if it is accumulated losses, we will deduct. If it is a deferred and miscellaneous expenditure not written off, then it will be deducted. And please understand, obviously, your net worth should be considered as per the stand-alone financial statement only, and it should not be considered as per the consolidated financial statement. Clear? Perfect. Now, we are not converted to IFRS. We have selected the option of the converged IFRS. Clear? So obviously there is a difference between the IFRS and the Ind AS. And that differences will be considered into the two part. It may be possible it will be considered as a carve in, or it will be considered as a carve out. Please understand what I am trying to convey. What is the meaning of the carve in? Because of the changes between the Ind AS and the IFRS, if you are not violating the IFRS, then simply it will be considered as a carved in. But because of the difference between the Ind AS and the IFRS, if it is a violation of the IFRS, then simply it will be considered as a carve out. Again I am repeating. Because of the difference between the IFRS and Ind AS, if Ind AS suggesting that accounting policies which is actually not a violation of IFRS, then simply it will be considered as a carved in. But because of the difference, if I am violating the IFRS, then simply it will be considered as a carve out. Just remember my one simple example. Let's assume in IFRS they are giving a 5 option, A, B, C, D and E, 5 option for some accounting policies. But in Ind AS, I am giving just a 3 option. And that 3 option is taken from the 5. Means under Ind AS, under IFRS, A, B, C, D, E. But in Ind AS, I am just giving 3 options that is called A, B and C. I am not giving the D and E option. So can I say if Indian company is following the Ind AS and if they are selecting any of the accounting policy, maybe A, maybe B and maybe C, then all accounting policies already there in IFRS. So simple, because of this difference, we are not violating the criteria of the IFRS. So simply it will be considered as a carved in. But let's assume under IFRS there are 5 methods, A, B, C, D, E. We are not giving that 5 methods under Ind AS. We are giving F and G. So simple. Indian company will select either F or G. And if they are selecting that accounting policy actually was not there in the IFRS, so it's considered as a violation of the IFRS. And if it is considered as a violation of the IFRS, simply it will be considered as a carve out. Clear? So simpler, carve in means differences which do not lead to contradiction with IFRS. As for example, IFRS prescribes FIFO, LIFO or the weighted average, but Ind AS prescribes FIFO or the weighted average. Clear? This is just an example. Let's carve out lead to different accounting treatment than as prescribed in the IFRS. Okay, perfect. Let's take next example. Friends, how we are giving number under the Ind AS? If it's a IAS 1, then we are giving the number Ind AS 1, presentation of financial statement. If IAS 2, that is called the International Accounting Standard 2. First of all, there was the IAS. Clear? Simple, we are giving the number Ind AS 2. But friends, after the year 2002, they are not giving the new IAS. They are issuing the IFRS, International Financial Reporting Standard. If they are giving the IFRS 1, simply, we are giving the number Ind AS 101. That is called the first time adoption of Ind AS. If they are issuing the IFRS 2, Ind AS 102. Recently, there are 2 Ind AS is recently newly introduced because of the issuance of the IFRS. One is IFRS 15 they have introduced from the 1st April 18. That's why we have introduced Ind AS 115, revenue from contract with customer. They have introduced IFRS 16 leases. That's why we have introduced Ind AS 116 leases. They are planning to introduce from the next accounting year IFRS 17, that is nothing but the insurance contract, and we will issue the Ind AS 117, that is called the insurance contract. So simple, whenever it's a IAS, we are giving the as it is number, But whenever it's in IFRS, we are just giving the 101, 102 and the 103. Okay, perfect. But this is my discussion on the introduction of Ind AS. So basically we have covered two topics in 45 minutes. Introduction of accounting standard and the introduction of the Ind AS. Now let's start one by one Ind AS. I'm taking in a sequence only. We are not changing the sequence and we are not following the ICI module. We are taking the sequence 1, 2, 3, 4 and all. Clear? Let's start with Ind AS 1. Friends, the name of Ind AS 1 is nothing but the presentation of financial statement. Content is not exactly like accounting standard 1. Accounting standard 1 is a very narrow scope. And the name of accounting standard 1 is nothing but the disclosure of accounting policy. This is a very easy Ind AS, very short Ind AS. Let's discuss. Friends, Indian Accounting Standard 1, that is called the presentation of financial statement, is applicable to all the profit-oriented entities. All the profit-oriented entities. It may be possible including public sector entities. If the public sector entities is nothing but the profit-oriented entity, then Ind AS 1 will be applicable. Clear? But let's assume that if you are opening the Section 8 company, like club and all, and if you are opening the Section 8 company, let's assume that that entity is nothing but the not for the profit oriented. They can again use Ind AS 1, but that Ind AS 1 will be by suitable modification. You cannot adopt directly as it is. You have to change some accounting policies. Clear? Friends, in India, actually we are preparing the SFS and the CFS. But sometimes we are preparing the interim financial report because standalone financial statement is actually issued at every annual period. And let's assume if we want to take a loan from the bank, we are preparing the interim financial reporting, and that interim financial reporting is as per the Ind AS 34. Then we have specific Ind AS. And if we have the specific Ind AS, then in that situation, we will not use the Ind AS 1. So simple, it does not apply to interim financial reporting covered under Ind AS 34. Clear? Next point. For specific type of entities, there is a specific jurisdiction. Like for the banking company, any accounting policies if you want to change, you have to take the approval from the RBI. For insurance company, we need the approval from the IRDA, that is called the Insurance Regulatory Development Authority of India. Simple, if you are preparing the financial statement for under the income tax law or for the electricity companies, then simple, you should not follow the Ind AS 1. Clear? Okay. Now, what thing is covered in the complete set of financial statement? I am not talking about the interim, I am talking about the complete. Please understand, you have to consider 7 things. 7 things. Clear? Number 1, balance sheet. Number 2, statement of profit and loss. Clear? Number 3, statement of cash flow. Number 4, statement of changes in equity. Number 5, in notes to accounts, we will write the significant accounting policies disclosure. Number 6, that is comparative financial information. And the number 7, that is called the opening balance sheet. Again, I am repeating. Balance sheet, profit loss, cash flow, statement of changes in equity, notes to accounts, then the comparative information and the third balance sheet. That is called the opening balance sheet. Can I say the balance sheet shows the financial position, and that balance sheet shows the financial position on a particular date. Statement of profit and loss shows the financial performance, and that financial performance is for the particular period. Statement of changes in equity will suggest the changes from the opening balance to closing balance, and we will write all the addition and the deduction. And then in the notes to accounts, we will write all the disclosures of the significant accounting policies. Comparative information, obviously whenever we are preparing the financial statement for the year 2020-2021, we have to provide the comparative information for the year 1920. And that comparative information is not just in the balance sheet and the statement of profit and loss. That comparative information should be in notes to accounts also. Clear? And friends, you know very well, actually in the Ind AS, we are preparing the opening balance sheet in the 3 situations. Means just remember that one line. 3 balance sheet in the 3 situations. Which 3 situations? First of all, if you are adopting the Ind AS for the first time, number 1, if you are rectifying any of the error as per the Ind AS 8, and the number 3rd is nothing but if you are retrospectively applying the new accounting policy. In that situation, friends, you should prepare third balance sheet. Clear? So 7 things: balance sheet, statement of profit and loss, statement of changes in equity, statement of cash flow, significant accounting policies and other explanatory notes, comparative information in respect of the preceding period, a balance sheet as at the beginning of the earliest comparative period when an entity applies an accounting policy retrospectively or for the prior period item. Clear? Next, friends. There are some features of the financial statement, general features. That is nothing but the true and fair, going concern, accrual basis of accounting, offsetting, frequency of the reporting, comparative information, and the consistency. Let's discuss one by one. True and fair presentation. Your financial statement should be true and fair. But friends, please understand what I am trying to convey. Management should write the one statement, and that is unreserved statement in the notes to accounts, that they have applied all the applicable Ind AS. We cannot write we have applied all the applicable Ind AS except 32,107 and the 109, that is called the financial instrument. No. You should write the unreserved and the explicit statement in the notes to accounts. After writing that statement, if auditor finds some query in applicability of the Ind AS, then it will be okay. Then it will be the lookout of the auditor. They can qualify their audit report. I cannot say like that. If auditor is raising some query, then that line is wrong written by the management. No, it's not like that. Clear? Next is nothing but the going concern. What is the meaning of the going concern? Going concern means your business should continue for the foreseeable future. Whenever I'm using the word business should continue for the foreseeable future, please understand that your business should continue for near 1 to 2 years. If you are finding that going concern is not appropriate or going concern assumption is not longer valid, number 2, that is nothing but the management is discontinue some particular business operation. So simple, it's a violation of the going concern. And whenever it's a violation of the going concern, simple, you should prepare the entire accounts on the non-going concern basis. And whenever I'm using the word, entire account should be prepared on the non-going concern basis. Please remember what I'm trying to convey. Every assets or liability should be valued at carrying amount or fair value less cost to sell, whichever is lower. Clear? Third, accrual basis of accounting. It's a very easy. Simply, friends, whenever you are preparing the accounts, your account should be prepared on the due basis and not on the cash basis. Next, materiality and aggregation. What is the meaning of the materiality? Materiality means any item of the financial statement which can affect the decision of the readers of the financial statement. Materiality means something important. There are two types of materiality. One is nothing but the quantitative, and the second is nothing but the qualitative. If in some transaction amount is material, then it will be considered as a quantitative materiality. But if in some transaction the nature of the transaction is material, then I can tell you it's a qualitative materiality. Clear? Friends, you know very well as per the Companies Act 2013, in the notes to account, you should separately disclose the income and expenses which are in excess of the 1% of the turnover or rupees 1 lakh, whichever is higher. Next point, if I discuss, if in the shareholder, if any person is having more than 5% of the equity shares of the company, then the name, percentage of holding should be disclosed in the notes to accounts. Clear? Next point is nothing but the offsetting. Offsetting means nothing but the set-off of the income with the expenses or the set-off of the assets and the liabilities. Actually, offsetting is not permitted in Ind AS except some Ind AS is specifically for giving the permission for that. If I am earning the commission of rupees 10 from my parent company, and if I am working as an agent, and I am appointing some sub-agent, and if I am giving the 7 rupees commission to my sub-agent, then I cannot disclose my net income of rupees 3 directly. Clear? Simple. I have to disclose the 10 rupees income separately. I have to disclose the 7 rupees expense separately. I cannot directly set off to each other. But yes, one thing is very clear. As per the Ind AS 12, deferred tax asset and the deferred tax liability can be set off in the two situations. If they are created under the same tax law or the entity has a legally enforceable right to set off, then in that two situations, you can set off this particular thing. Clear? Frequency of the reporting. You know very well. In India, we are issuing our financial statement on an annual basis. Comparative financial information, whenever I am using the word comparative financial information, you should provide the information of the preceding year. Means whenever we are preparing the financial statement for the year 2020-21, you should give the information for the year 19-20 also. Consistency. This is the most important point. Why consistency? You should follow the same accounting policy year by year. And whenever I am asking you, you should follow the same accounting policy year by year, means you cannot change your accounting policy. Clear? Simple. We have discussed this true and fair. We have discussed the going concern, offsetting, comparative information. We have already discussed consistency. Clear? Yes, friends. Here we are in the consistency. Means you should follow the same accounting policy year by year. If anyone asks you, can we change our accounting policy? Friends, please understand. Your first answer should be no. you cannot change your accounting policy. Clear? Why? Because we are following the consistency concept. But yes, it is allowed under just the two situations. First, if it is required by the Ind AS, or the second, for the better preparation in the presentation of financial statement. Friends, please understand, whenever it's required by the Ind AS, it will be considered as a mandatory change. But whenever it's for the better preparation in the presentation of financial statement, it will be considered as a voluntary change. And whenever it's a mandatory change, whether we should give the provide prospective effect or the retrospective effect, that was already mentioned in that particular Ind AS only. But whenever we are giving the voluntary change, simple, you should provide the new accounting policy retrospectively. Clear? This is all about the consistency. Accrual we have checked, materiality check, frequency we have checked. Yes, now new topic. That is nothing but the current and the non-current asset. Friends, this will help you in the preparation of the financial statement. Friends, please understand. Actually, under Ind AS 1, they have given the definition of the current asset. And obviously, other than current asset, everything is considered as a non-current asset. And there are basically four conditions. If you are fulfilling any of the following conditions, then it will be considered as a current asset. Number one, if it is expected to be realized or consumed in normal operating cycle, if it is held for primarily for the purpose of trading, if the operating cycle is not clearly identifiable, then it is expected to be realized within 12 months from the reporting date. Please understand, not within 12 months from the acquisition date, it is 12 months from the reporting date, and any cash or cash equivalent which is not restricted in use. Clear? Let's take one by one. First of all, it's expected to be consumed or the realized within normal operating cycle. Best example is our data, our raw material, whatever, which is actually for the purpose of trading, and the best example is nothing but the finished goods. Even though there are some non-moving items in our business, from the last 4 to 5 years, that items are in stock. Still, that closing stock is disclosed in the current asset only, because that is specifically for the purpose of the trading only. If the operating cycle is not clearly identifiable, now what is the meaning of operating cycle? We will check. That is from the raw material acquisition to the realization from the data, that the time period will be considered as an operating cycle. And last is nothing but the cash or cash equivalent. Under Ind AS 7, we will check what is the meaning of the cash or cash equivalent. Simple, it is cash balance, bank balance, any demand deposit with bank or any of the financial institution. And the cash equivalent means any of the asset which is actually in the short term, it's a highly liquid, which can be easily convertible into the cash without significant changes in the value. Clear? Simple phrase, please understand what I am trying to convey. Whenever I am using the word short term, means it should be realized within 3 months from the date of acquisition. Clear? Simple, other than current asset, everything will be considered as a non-current asset. And yes, I already explained you what is the operating cycle. It is a time between the acquisition of asset for processing and the realization in cash. Clear? If operating cycle is not clearly identifiable, we can consider at just 12 months. Perfect. We have checked the definition of the current asset and the non-current asset, and now I am trying to cover the definition of the current liability and the non-current liability. It is exactly like same. They have given the definition of current liability, and other than current liability, everything will be considered as a non-current liability. In the asset, there are 4 conditions, but in liability, there are 3 conditions. If you are fulfilling any of the one condition, then simply we will consider its current liability. First, it's expected to be settled in normal course of business. In current asset, is expected to be serialized within normal operating cycle. If operating cycle is not clearly identifiable, then it is to be settled within 12 months after the reporting period. In asset, it is expected to be received within 12 months from the reporting period. And the third and the most important, please understand. If entity does not have unconditional right to defer the settlement at least 12 months after the balance sheet date. Friends, and I have the best example, that is nothing but the torrent deposit. Obviously, whenever we are making the deposit to the torrent, that is for the electricity companies, that torrent deposit is considered as an asset for the holder, but it will be the liability for the issuer, means for the torrent. Problem is that torrent deposit will be considered as a current or the non-current. Friends, for customer, it will be considered as a non-current asset because we are not expecting to be realized that amount within the normal operating cycle or within the 12 months from the reporting period. Clear? Now the problem is that, second number point, that is, for torrent, it will be considered as the current liability. Sir, why? Let's assume I am going to the foreign for permanent period. Now I don't want the electricity connection at my house. So I am revoking that connection and I am asking the refund of the deposit. Torrent has not any right to defer the settlement for at least 12 months after the balance sheet date. If I don't want connection, electricity connection today, they have to give money today only. They have to give money today only. They have not right to defer the payment. So simply, it will be considered as a current liability for the torrent. And other than current, everything will be considered as a non-current liability. Clear? Yes. That is the most important point. Please understand. Friends, first of all, I am explaining the IFRS. Means rather I am explaining the IS1. Clear? What is the situation? Let's assume we are taking the long-term borrowing from the bank. And we have committed some breach of any of the condition, loan condition, that is called the loan covenant. That breach was the before reporting date, but that breach is continued up to the reporting date, that is called the 31st March 20. As per IS1, on long-term borrowing, if you are making some breach of condition and that breach is nothing but the material breach, and that breach was the before reporting date and that the breach was continued up to the reporting date, simple, you should reclassify that borrowing from the non-current liability to current liability. And the IFRS is done. But what is the treatment in the Ind AS 1? If we are making some breach on reporting date or the before reporting date and that breach is continued up to the reporting date, then obviously it should be classified from the non-current liability to current liability. But please ensure, if before approval of financial statement, if that breach is rectified, if before approval of financial statement, if that breach is rectified, then friends, please understand, it should be now in the original form, means now we will convert in the current liability to non-current liability. So simple, under Ind AS, we are considering this event as an adjusting event. That was not there in IFRS. In IFRS, if there was a breach up to reporting date, simply it should be converted into the current. But Indian people are thinking, this type of breach is normal in India. And if this type of breach is normal in India, if we are converting from the non-current to current, the financial position of the company will be changed like anything. So we are giving the option for rectification of that breach before approval of financial statement. And if you are rectifying, simply it will be considered as a non-current only. Clear? So loan become payable on demand due to breach in covenant, its current liability. Breach should be up to the reporting date. It should be a major breach. If the breach is rectified before approval of account and the loan is now not repayable on demand, then it is a non-current liability as per the Ind AS change. Clear? I covered torrent deposit point. Clear? Now friends, please understand. India is following the single statement approach. And what is the meaning of the single statement approach? We are just giving the title, the statement of profit and loss for the year ended this and this. And in this state, we are starting from the revenue. After revenue, it's expenses. Then we will check the profit before tax, and if we deduct the tax expense, then it is nothing but the profit after tax. IFRS is not following the single statement approach, they are following the two statement approach. Means they are preparing the statement of profit and loss on the one page, and on the other page, they are preparing the statement of the other comprehensive income. But India is following the single statement approach, means after profit after tax, we are adding OCI. That is called the other comprehensive income. And the profit after tax plus OCI, we will get TCI. That is called the total comprehensive income. Clear? Now friends, for this OCI, there are two parts. One part, reclassification to P&L is possible. And the second part is reclassification to P&L is not possible. Mr. What is the meaning of this reclassification to P&L possible or not possible?
Once today this amount is transferred in OCA, if in the future this amount is now transferred to P&L, then we can say that reclassification to P&L is possible. But if today this amount was transferred in OCA and in the future that amount cannot be transferred in the P&L, we can say that simple reclassification to P&L is not possible. Clear? And now we have a list items that is not reclassified to P&L. Just we are making a list. Whenever we will learn this particular Ind AS, obviously we will cover that again. Revaluation surplus, friends, you know very well. Whenever we are doing the revaluation reserve is disclosed in OCA, and for which reclassification to P&L is not possible. Second number point is nothing but the actuarial assumptions if changing under Ind AS 19, and because of that, if the value of the defined benefit obligation or the plan asset is changing like anything, then simply it will be considered as actual gain or loss, and that actual gain or loss is recognized in OCA. Reclassification is not possible. If friends, under Ind AS 109, you are doing the accounting of the financial asset, and in that if you are doing the accounting of the equity instrument, I already explained you, there are two types. One is held for sale and second is nothing but the not held for sale. If the equity instrument is a not held for sale, and the number two, that is nothing but if you are selecting the irrevocable option of the FAT OCI, then again, today gain or loss is transferred in OCI, but reclassification to P&L is not possible. And the number four, share of OCI in associate and joint venture to the extent not reclassified to P&L. Now I am starting item that will be reclassified to P&L. Effective portion of the gain or loss in the cash flow hedge as per Ind AS 109. Change in the fair value of the investment in the debt as per Ind AS 109, you know very well. Debt instrument, if your purpose is to just to collect the contractual cash flow, then accounting will be as per the amortized cost. But if your purpose is to get the contractual cash flow plus the benefit of the fair value, then it should be as per the FAT OCI. So this is like that. And if you are transferring FAT OCI, then reclassification to P&L is possible. Foreign exchange difference on the foreign operation. If there is, whenever we are doing the translation of the trial balance of the foreign operation, whatever the gain or loss is accumulated in the equity under the heading of the foreign currency translation reserve, and whenever we are disposing that foreign operation, whatever the gain related to that foreign operation is transferred to P&L. Gain or loss from associate or joint venture and other, like this Ind AS 104 is not in your syllabus, so let's forget that. Clear? Okay. And my finally Ind AS 1 is done. Now let's start Ind AS 2. It's a marathon revision. We will cover Ind AS, so you should be patient, and you cannot do today anything except some natural calamity. You have to concentrate. Today I am guaranteeing you in the full day we will cover the financial reporting, and obviously it will be helpful before the day of exam. Let's start Ind AS 2. That is called the inventories. It's a favorite Ind AS of the students. First of all, you should check the meaning of an asset, because inventory is actually an asset. Asset means in the resource which is owned or controlled by an enterprise as a result of the past event from which future economic benefit is expected. Now friends, this is the easy definition from intermediate, you are learning this. Then we have to check the inventories. What is the meaning of inventories? Friends, inventories means actually an asset which is held for sale. Whenever I am using the word held for sale, I am talking about the finished goods, which is held for consumption in production of goods or the rendering of services. Simple. That's why I am talking about the raw material. And which are the part of production process. That's why it's considered as a WIP. Clear? If we are shut manufacturing company, then for us, cotton will be considered as a raw material. From cotton, we are preparing one cloth. That cloth will be considered as a work in progress. And from that cloth, if we are making the shirt, that shirt will be considered as a finished goods. Clear? And all the three things will be considered as an inventory. Then friends, we have to learn that Ind AS 2 is not applicable at a two particular point. One is any biological asset which is related to agriculture activity and the agricultural produce at the point of the harvest. Friends, because for this, we have one specific Ind AS, and the name of the Ind AS is nothing but the Ind AS 41. Number two, if your normal core activity of business is nothing but for the trading in the financial instrument, still that financial instrument will not be considered as an inventory for you. Friends, you should do the valuation or accounting as per Ind AS 32, 107 and the 109, means financial instrument presentation, financial instrument disclosure and the financial instrument. Clear? Friends, if you know, under accounting standard, there is one more point. That is nothing but the inventory for the service provider. But friends, you are not believing me. Under Ind AS 2, we will recognize inventory for service provider also. As per accounting standard 2, there is no inventory in the service industry. But yes, as per Ind AS 2, 110% there is an inventory in the service industry. Clear? We will check how to value. My common question, whether this pen, let's assume it's not a smart pen, it's a marker pen. We are using that marker pen to write on the blackboard. This pen will be considered as an inventory for any of the coaching institute? Answer is yes. This will be considered as a stationary stock for the coaching institution. So it will be considered as an inventory. Clear? Now we are starting with the valuation. We have to do the valuation for the three things: finished goods, WIP and the raw material. I am starting with number 1, that is called the finished goods and the WIP both together. Finished goods and WIP. It is nothing but cost or NRV, whichever is lower. But whenever we are doing the whichever is lower, that is on individual basis. Means, let's assume I am having the three types of inventory. If we consider the cost 10, 15 and 12, so total is 37. But actually total is not relevant for you. NRV, if I can check 8, 17 and the 5, then simple, it's 30. But we are not doing the valuation of inventory like 37 or 30, whichever is lower. We will check on individual basis. 10 or 8, whichever is lower, 8. 15 or 17, whichever is lower, 15. 12 or 5, whichever is lower is 5. And actually my valuation of inventory is nothing but the 28. Clear? So now we have to check the cost or net realizable value. Under accounting standard 2, they have not used the word fair value less cost to sale. Under accounting standard 2, they are using the word just the net realizable value. That is because in many Ind AS, like whenever we will check the Ind AS 36 impairment of asset, they are talking about the fair value less cost to sale. Whenever we are checking the Ind AS 41 agriculture, they are talking about the fair value less cost to sell. But please remember, under Ind AS 2, they have used just the word net realizable value. Clear? Friends, if we consider, whenever I am using the word cost, in a cost there are three elements included. One is purchase price, second is cost of conversion, and the third is any cost incurred, bringing the inventory to its present location and the condition. Friends, please remember, if in the purchase price some duty or taxes is included, and if you are eligible to take the credit or refund of that duty or taxes, then it should be deducted from the purchase price. But if in the purchase price some duty or taxes is included, and if you are not eligible to take the credit or refund of the duty or taxes, then it should not be deducted from the purchase price. If in the purchase price some trade discount is included, then it should be deducted from the purchase price. But if in the purchase price some cash discount is included, then it should not be deducted from the purchase price. It may be possible you are purchasing the inventory today, but you are deferring the payment. Obviously, whenever you are deferring the payment, you will pay some extra amount. And whenever you are paying some extra amount, friends, please understand that extra amount will be considered as the interest, and it will not be considered in the purchase price. Next point. What is the meaning of conversion cost? Conversion cost is nothing but any cost incurred for converting the raw material into the finished goods. Simple. Basically, two things is needed. One is the labor, and second is the overhead. We have the labor, it's a variable cost, so we have per product per unit. Variable overhead is again ready, but what about fixed overhead? So friends, fixed production overhead is always absorbed on the basis of actual capacity or the normal capacity, whichever is higher. So my total fixed overhead is nothing but the 10,000. This fixed overhead. My normal capacity is nothing but the 1,000. Can I say actual capacity is maybe 1,000, maybe 900 or maybe 1,200? If it's exact 1,000, then you should absorb 1,000. If it's 900 or 1,000, whichever is higher, it's a 1,000. 1,000 or 1,200, whichever is higher, it's a 1,200. Clear? So please remember one rule. Fixed overhead is always absorbed on the basis of the actual capacity or the normal capacity, whichever is higher. Clear? Now, NRV. What is the meaning of NRV? Expected selling price minus expected completion cost minus expected selling cost. I want to clarify one thing. Cost or NRV, whichever is lower, rule is not only applicable to finished goods, but the same rule is equally applicable to WIP. Let's remember one thing. If this cost of completion word is not written here, this rule may be only applicable to finished goods. Because we are taking the selling price of the finished goods. So here we will take the cost from conversion of the WIP into the finished goods and then we will deduct the selling price. And that is the most important point of the Ind AS 2 read with Ind AS 10. Please understand. If the cost of the finished goods is 100, if NRV on 31st March is 80 and on 15th April is nothing but, let's say it's a 70. We are taking physical stock on 31st March. One rule is very clear. If after balance sheet date, before approval of financial statement, if NRV is changing, we should consider that NRV for the reporting of the closing stock. Under accounting standard, we are just taking the NRV of the 31st March only. In this situation, we will take, let's assume I am approving my financial statement on 30th April and I am having the NRV of the 15th April and which is actually lower than the cost. Simply, we will value the inventory or the 70 rupees. But at the time of the 31st March, we are finding that if we want to sell this particular stock in the market, we have to incur 5 rupees cost. So simple, we will deduct 70 minus 5 and we will take the 65 rupees. Clear? But let's assume we are not taking the physical stock on the 31st March, but we are taking the physical stock in the future. And if the physical stock in the month of April, then simple, on balance sheet date, we have not any evidences for that event, we cannot deduct. Clear? So for estimating NRV, we should consider fluctuation in the price directly relating to events occurring after the end of the reporting period to the extent that such events confirm conditions existing at the reporting date. I have an example. ABC Limited is actually manufactures and the sale envelope. Stock of envelope was included in 31st March 17 at a cost of rupees 50 each per pack. During final audit, we are finding that in the month of April 15-17, our price is nothing but the 40 rupees. So obviously we will consider. Further inquiry reveals that due to the physical stock, there is a water leakage. And because of the water leakage, we have to incur rupees 50. So my cost is nothing but 50. My NRV, if I can check, if I want to sell the stock at rupees 40, I have to incur the expense of rupees 15. So 40 minus 15, my value is 25. Whichever is lower is 25. So my value of the inventory is 25 and my loss will be 25. Clear? Next point. Whenever we are considering the cost of inventory, in the cost of inventory, we are not considering basically 6 things. Which are that 6 things? Selling, admin, storage, interest, abnormal loss and the foreign exchange gain or loss. Next friends, if I can check. After this, okay, joint product and the byproduct. First of all, we will determine the joint cost. After joint cost, we will deduct the net realizable value of the byproduct. Whatever the net joint cost will be allocated between the main product. But please understand, we are not taking just the ratio of the number of units, because whenever we are just considering the number of units, we are ignoring the economic importance of the product. So we should actually take the ratio of the sales value. Clear? And simply we will get the answer. Friends, after that, we have actually 2 methods. One is standard cost method and the retail price method. That is not much more important. For valuation of inventory, LIFO method is not allowed. Only just 2 methods is allowed, FIFO and the weighted average. If nothing is given in the question, you should use the weighted average method. Clear? FIFO is actually our second priority. And the next and the last point, that is nothing but the raw material valuation. Common point is that for the valuation of the raw material, first of all, we will determine or we will check the value of the finished goods. If the NRV of the finished goods is higher than or equal to its cost, then raw material is valued at cost. But if the NRV of the finished goods is lower than its cost, so raw material is valued at a cost or replacement cost, whichever is lower, you will not find NRV of the raw material because we are not selling the raw material in the market. So for raw material, we will have actually a replacement cost only. Clear? And yes, I already told you, under Ind AS, there is some inventory for the service provider, and that inventory is basically valued at a cost, and the cost is nothing but of the labor only. Clear? Otherwise, there is no any other cost. Clear? So we have completed basically 4 topics: accounting standard, introduction of Ind AS, Ind AS 1 and the Ind AS 2. Now friends, I am starting with the Ind AS 7, and the name of Ind AS 7 is nothing but the cash flow statement. Clear? Friends, you know very well in Ind AS 1 we have checked whenever we are presenting the full financial statement, we have to present balance sheet. We have to present the statement of profit and loss, statement of changes in equity, and the statement of cash flow also. So let's check. First of all, we are discussing some definition. Whenever I am using the word cash flow, actually in a business, there are three types of cash flow. One is nothing but the cash flow from the operating activity. Second is nothing but the cash flow from the investing activity. And the third is nothing but the cash flow from the financing activity. Friends, please understand what I am trying to convey. If any cash flow is directly related to operating activity of business, then simply that cash flow will be considered as a cash flow from the operating activities. But if any cash flow is related to for the purchase or the sale of the fixed asset, then it will be considered as a cash flow from the investing activities. But if you are taking the borrowing or if you are issuing some securities and for that you are receiving some amount, then it is considered as a cash flow from the financing activities. If I am talking about the Navkar Digital Institute, if the Navkar Digital Institute is receiving the fees from the student, then it will be considered as a cash flow from the investing activity. If Navkar Institute is selling one of the building, then simply it will be considered as the cash flow from the investing activity. But if the Navkar Institute is taking the borrowing from some bank, then simply it will be considered as the cash flow from the financing activity. If anyone asks you which cash flow is the good cash flow for any of the business, cash flow from the operating activities will be considered as a good cash flow in any of the business entity. Clear? So simple, if we consider operating activities, principal revenue generating activities of the business and includes any activity which is not classifiable elsewhere. Clear? Investing activity. Acquisition and disposal of the long-term asset investment other than for the cash equivalent, and the financing activities that result in the debt, borrowing or the equity. Now, you should understand the meaning of the cash or cash equivalent. Whenever I am using the word cash or cash equivalent, friends, I am considering the cash balance. I am considering the bank balance. Even any short-term, highly liquid instrument that are readily convertible into the known amount of cash with insignificant risk of changes in value. Again, I am repeating definition of a cash and cash equivalent. Cash balance, bank balance, demand deposit with the bank or any other financial institution, and it includes any short-term, highly liquid instrument that are readily convertible to known amount of cash with insignificant risk of changes in value. Clear? So friends, please understand, whenever I am using the word short-term, short-term is nothing but less than or equal to 3 months. And this less than or equal to 3 months, this 3 months is not from the date of balance sheet, but this 3 months will be considered from the date of acquisition. Means, if I am investing some fund in short-term security on the 1st February and that is maturing on 15th April. So actually, if we can check from the balance sheet date, it's just the 15 days. But can I say from the reporting date, it's a 15th April, rather let's say 15th May. So Feb, March and April, it's 3.5 months. Simply it will not be considered as short term. Clear? So whenever I'm using the word short term means, friends, please understand it's 3 months from the date of acquisition. Clear? Okay. What are the objective of Ind AS 7? There are 3 objectives of Ind AS 7. Friends, Ind AS 7 provides information about changes in cash equivalent. It helps us to assess the ability to generate the cash and cash equivalent, to understand the timing and certainty of their cash generation. If I'm taking one example, there is company A, there is company B. Forget everything, we have to just take the decision from the sales, which company is a good. And if I consider the sales of the company A is a 5 crore and the company B is a 5 crore. And if I am asking the question, which company is the good, which company is better performing, we cannot take an answer. Because now I am giving one more information. Company A is making the cash sales, but company B is making all the sales on the credit basis. So simple, if you are now asking me, sir, which company is a good company, I can easily give an answer. Friends, company A is the good company because they are generating their cash. Clear? So simple, there are 3 objectives. Clear? Now, you know very well, for reporting of the cash flow, you are having 2 methods. Number 1 is nothing but the direct method, and the number 2 is nothing but the indirect method. Every listed company is mandatorily required to follow indirect method for the reporting of the cash flow. Again, I am repeating, for reporting of the cash flow. Clear? Which entities are mandatory? Every listed entity is clear. And how we are reporting the cash flows as per the indirect method? We are starting from the net profit before tax. We will add non-cash expenses and deduct the non-cash income. We will add non-operating expenses or losses, deduct non-operating income or the gain. Then simply we will get the cash flow before working capital. Plus or minus, simply it may be a positive or it may be a negative. We will add working capital, simply it will be a cash flow after working capital. Clear? Okay. And simply minus taxes paid or cash payment not deducted from the net profit before tax plus tax refund. Simply we will get the final answer of the cash flow from the operating activity. Friends, please understand, this direct method and indirect method is only for the reporting of the cash flow from the operating activity. Whatever method you are following, maybe a direct or maybe indirect, under investing and the financing, your answer will be similar. Clear? In your method will be similar. Simply, this is only and only for the operating activity. Now you have to check the special point of the interest and dividend. Because for the financing company, some treatment is different, and for normal company, treatment is different. Let's check for the interest paid. Yes, I am talking about the interest paid. Whenever I am talking about the interest paid, one thing is very clear, it is your outflow. But whenever it's an outflow, can I say you should consider that this interest paid is outflow from the from the operating activity for financing company, but operating cash flow from the operating activities for the financing company, but from the financing activity for the other company. So again I am repeating, if it is an interest paid, then it will be outflow from the financing activity, outflow from the operating activity for the banking company, and outflow from the financing activity for the other company. Is it okay? Next, if we discuss interest and dividend received. Why you are receiving the interest and dividend? Because one thing is very clear, because you are investing your fund. Clear? But interest and dividend received is nothing but the normal routine course of activity for any of the banking company. So it will be considered as the inflow from the operating activity for the banking company, but inflow from the investing activity for the normal company. Dividend paid is an outflow. And that is an outflow from the financing activity for the bank and for the financial institution both. Clear? See if I repeat. For bank, interest paid is an outflow from the operating activity. For other company, it is an outflow from the financing activity. Interest and dividend received, then simple, it's inflow from the operating activity for the bank and the inflow from the investing activity for the other company. Dividend paid, it's an outflow from the financing activity for the bank, but it's an outflow from the financing activity for the other company. Clear? So finally, this is the end of Ind AS 7. It's a very easy. Now, I'm starting new Ind AS, and the name of Ind AS 8 is nothing but the accounting policies, changes in accounting estimates and error. Again, I'm repeating, accounting policies, changes in accounting estimates and error. Please understand what I'm trying to convey. Friends, in the world of accounting standard, we have one accounting standard, and that is nothing but the accounting standard 5. The name of accounting standard 5 is nothing but the net profit or loss for the period, prior period item, and changes in accounting policy. Friends, Ind AS 8 is the only Ind AS which actually provides the disclosure in the statement of the profit and loss. If you ask me, as per Ind AS, your profit and loss, statement of profit and loss is prepared by 4 things. Which 4 things? One is profit or loss due to change in accounting policy, profit or loss due to change in accounting estimate, profit or loss because of the rectification of error, and if it is not fall in the 3 things, then simple, it is nothing but the profit and loss from the ordinary activities. Now friends, please focus what I am trying to convey. Whenever I am using the word the ordinary, as per accounting standard 5, there is one topic called the extraordinary item. That topic is not here in the world of the Ind AS. Under the world of the Ind AS, we have only ordinary item. There is no concept of the extraordinary. But yes, here we have the concept of the exceptional item. No doubt that same concept was there in the accounting standard also. What is the exceptional item? The exceptional item is nothing but just an ordinary item, but the amount or the nature of the transaction is material. And if the amount and the nature of the transaction is material, then simply the transaction is considered as an exceptional item. Now I want to discuss basically 3 things, rather 4 things Accounting policies, changes in accounting estimates, error and ordinary item. Clear? Let's start with the accounting policies. First of all, what is the meaning of accounting policies? Friends, accounting policy is nothing but the principles. And what is the meaning of principle? It is nothing but the defined solution for the defined problem. Before Ind AS 2, or rather before Accounting Standard 2, there was a problem. Whether we should value the inventory or not, answer is very clear. Yes, we should value the inventory. And methods of applying those principles means how to value that inventory. Can I say, so as per Accounting Standard 2 and as per Ind AS 2, we have two methods. One is nothing but the FIFO and second is nothing but the weighted average. Means accounting policy is nothing but the principles, basis. Basis means we are preparing accounts as per the cash basis or the accrual basis. Conventions, historical cost and the going concern. Rules and practices adopted by the entity. Not just only preparing the financial statement, but also in the presentation of financial statement. Clear? So accounting policy is basically accounting principles, basis, conventions, rules and practices adopted by the entity in the preparation and presentation of the financial statement. Clear? Now, friends, how to select accounting policy? If specifically Ind AS is there, then simply we should follow the accounting policy as per that Ind AS. If Ind AS is not there for that particular matter or that for particular transaction, then friends, what should we do? We should check at an international level, is there any IFRS or is there any IAS for accounting of that particular matter or accounting of that particular transaction? If yes, then we will follow that particular guidance. And again, if that is not available, then we will select our accounting policy as per the best industry practices. And for that, we have to check the various concepts. Our financial statement should be true and fair. It's a reliable, it's a relevant. We are following the materiality concept, prudence concept, substance over form concept and all. Clear? Again, I am repeating. If there is some specific Ind AS for that particular matter or that for particular transaction, then we will follow that particular Ind AS only. Like best example for valuation of inventory, we have Ind AS 2, so we will follow that only. If for that particular transaction, if the particular Ind AS is not there, we will check is there any international accounting standard or IFRS for that particular matter. If yes, then we will follow that, or otherwise we will follow the industry based practices. Clear? If there is an Ind AS which specifically provides the accounting treatment of transaction, then we should follow Ind AS. If no applicable Ind AS, then management should use its judgment based on relevance, reliability, prudence, materiality, substance over form, recent pronouncement of other bodies and accepted industry practices. After selection of accounting policy, let's check. Can we change our accounting policy? Friends, please understand what I am trying to convey. One thing is very clear. You cannot change your accounting policies. Why? Yes. Because friends, we are following the consistency concept. And as per the consistency concept, we should follow the same accounting policy year by year for the similar nature of transaction. So if anyone asks you, can we change our accounting policy? Your first answer should be no, we cannot change our accounting policy. Yes, changing accounting policy is only allowed in this two situations. Number one, if it is required by the Ind AS, and number two, if it is rather for better preparation and presentation of the financial statement. Whenever you are changing the accounting policies, because if it is required by the Ind AS, simply it will be considered as a mandatory change. But whenever you are changing your accounting policies for the better preparation and presentation of financial statement, then simply it will be considered as a voluntary change. Friends, please understand. Now we have to check what is the accounting treatment for the changes in accounting policy. It is very simple. If you are changing your accounting policies because it is required by the Ind AS, means it is a mandatory change, then in that particular Ind AS, the people will provide you whether you should follow the prospective effect or the retrospective effect. For November 2020 students, I have the best example. You know very well, Ind AS 116 is introduced, leases, and this is specifically for the first time in your attempt because May 20 attempt was cancelled. In Ind AS 116, they have clearly mentioned you the transition provision because under accounting standard 19 or rather Ind AS 17, we are not recognizing all the assets as, or all the lease as a finance lease in the books of lessee. But can I say now as per Ind AS 116, all the lease will be considered as a finance lease? So simple. First of all, it may be possible under the accounting standard 19 or under the Ind AS 17 that lease was accounted as per the operating lease in the books of lessee. That's why we have not recorded asset. But under Ind AS, now we have to record the asset as a right of use of asset. So now we should provide the prospective effect for that, or we should provide the retrospective effect for that. That is clearly mentioned in Ind AS 116. But yes, till date, let's assume I am following the FIFO method. And now I want to follow the weighted average method. It is not required by Ind AS, but it is for the better preparation and presentation of financial statements, so it will be considered as a voluntary change. And whenever it's a voluntary change, please understand, friends, you should provide retrospective effect. And you should not provide the prospective effect. Friends, you should provide the retrospective effect. Clear? Second change. In a two situation, it will not considered as a change in accounting policy. Number one, if you are adopting something for the first time, and the number two, because of the change, your substance of the transaction is changes. Again, I am repeating, something you are adopting for the first time, and the number two, because of the change, substance of the transaction is changing. So in that two situations, it will not consider as a change in accounting policy. I have an example. First example, till date, I am not paying pension to my retiring employees. But now my company is starting to pay pension to the retiring employees. So simple, this will not consider as a change in accounting policy. Clear? Second example. First of all, one property is nothing but the property, plant and equipment as per Ind AS 16. And you know very well, for subsequent measurement of the property, plant and equipment, you are having a two choice. You can use the cost model or you can use the revaluation model. You can use the cost model or you can use the revaluation model. And let's assume I am following the revaluation model. But now that property is giving on the rent, means that property is now for me, it's a let out property. And if that property is considered as a let out property, can I say this property will be considered as an investment property for me? And if that property will be considered as an investment property for me, and you know very well, as per Ind AS 40, only cost model is applicable for the subsequent measurement of the investment property, and the revaluation of the investment properties are prohibited. So now compulsorily I should convert my accounting policy from the revaluation model to the cost model. Simple. Why I am changing my accounting policies? Because the substance of the transaction is changing. And because the substance of the transaction is changing, one thing is very clear, it will not be considered as a change in accounting policy. Clear? Simple, in a two situation, it will not be considered a change in accounting policy. I already given you about the information of the accounting for the change in accounting policy. If transition effect is given in Ind AS, then we should follow such Ind AS. Best example we have is Ind AS 116. If there is no transition provision, then we should give the retrospective effect. Clear? If I am providing the effect, if I am changing my accounting policy from the FIFO to weighted average, it's a voluntary change, and it's a voluntary change, friends, I should provide the retrospective effect. Friends, now you should understand. What is the retrospective effect? Friends, retrospective effect means you should provide the effect from the day one. So problem is that my company was incorporated in the year 2001 and I am changing my accounting policy in the year 2020. So can I say, as per your information, sir, we have to change our data for the last 19 years. Sir, am I correct? Answer is yes, you are correct. But can I say, as per Companies Act 2013, as per Income Tax Act 1961, it is mandatorily, you should reserve your books of accounts for 8 years. So I am having just my books of accounts for the 8 years and not older than that. So how can I change the accounting policies for the years that is more than 8 years? Friends, one thing is very clear. One thing is very clear. They have clearly given you, if it is impracticable to apply the retrospective effect from the day one, you should provide the retrospective effect from the earliest date from which it is possible. If I am not having the data for the last 19 years, but can I say you have the data of the last 8 years? So simply just provide the retrospective effect for the 8 years. So it is very clearly given. If it is not practicable to apply the effects of changes in policy to prior period, Ind AS 8 allows changes to be made from the earliest period for which retrospective application is practicable. And sir, when we can say that it's impracticable, when the cost and time is very high to determine the retrospective effect, clear, then we can say that it's impracticable. And obviously, like in my example, I am changing from FIFO to weighted average. My closing stock will change. And if obviously closing stock will change, my balance of the retained earning will change. If from the FIFO to weighted average, if my closing stock will increase, retained earning will increase. If my closing stock is decreased, my retained earning will decrease. Clear? So you should give the one effect in the assets and liability and the second effect in the opening balance of the retained earning. Please understand, this is the situation in which you should prepare opening balance sheet. Means sir, what are you trying to convey? I already told you, in your syllabus, you are preparing 3 balance sheet for 3 times. Number 1, whenever you are adopting Ind AS for the first time, whenever you are changing your accounting policy. So in the year 2020-21, if I am changing my accounting policies, then I will prepare the first balance sheet is as on 31st March 21, with compared to 31st March 20, and the with compared to 1st April 19. This 1st April 19 balance sheet will be considered as the opening balance sheet, and clear, and you have to adjust everything. Clear? Now, what disclosures are required? Nature of change in policy, effect on P&L in the current period and the prior period. If retrospective restatement is not practicable, then the reasons should be disclosed why it is not practicable. In case of voluntary change, reasons why new policy provides you the more relevant information. Clear? These are the disclosure. Now I am starting my topic, that is nothing but the accounting estimate. Whenever we are preparing the financial statement, we are taking the number of estimation. Like common example, if I can check, first estimate, that is nothing but the estimate of the scrap value of the property, plant and equipment or the investment property. Useful life of the tangible assets, intangible assets or the investment property. If we are creating the credit loss allowances on the debtor, then simple percentage estimate of the chances of the bad debt. If we are providing some warranty on the goods, then what is our warranty obligation? That's all the estimates we are taking. And as per Ind AS 8, every estimate should be checked once on every reporting date. So on the reporting date, it may be possible if I am changing my accounting estimate. Friends, please understand, whenever you are changing your accounting estimate, you should provide the prospective effect and you should not provide the retrospective effect. Sir, can you give an example? Yes. My value of the asset is 100 and I am taking the life of 10 years, and let's assume I have provided the depreciation of the 4 years. So can I say my total depreciation is 40 and my balance of the asset is nothing but the 60. As per original estimate, my life of the asset is 10 years, but out of 10 years, 4 years is finished, so remaining years is nothing but the 6. So can I say that this value of the asset is 60 should be depreciated over the life of the 6 years. So can I say, friends, my depreciation amount is nothing but the 10. Original depreciation is 10. But now I am changing and I think that my life is not 6 years, it will be just 4 years. And it will be just 4 years, it's considered as a change in accounting estimate. And whenever it's a change in accounting estimate, friends, we should provide the prospective effect only. And if we are providing the prospective effect, the value of the asset is 60 divided by 4, my depre will be 15. Can I say if I am not changing my accounting estimate, then my depre will be rupees 10. But if I am changing the accounting estimate, then my depre is nothing but the 15. Don't you think so? You are providing the 5 rupees more depre, and that 5 rupees more depre is because of the change in accounting estimate. And yes, if it is because of the change in accounting estimate, it should be disclosed separately. Clear? So obviously, one thing is very clear, it should be provided prospectively. And if we check the disclosure, effect of change in accounting estimates in the current and the future period. If it is not possible to estimate the effects of the future period, then fact must also be disclosed. Perfect? Okay. And then now the topic is error. If in the previous year, we forget to record some expense, income, asset, liability, and we are rectifying that particular matter in the current year, then it will be considered as a rectification of an error. Under Ind AS, first of all, let's discuss accounting standard. Under accounting standard, we are providing the prospective effect for the prior period error. But under Ind AS, we are not providing the prospective effect for the prior period error. Friends, under Ind AS, we are providing the retrospective effect. Means, for the year 1920, if there any error is occurred and that error is found in the year 2020, 2021, then we are not giving the prospective effect, we are giving the retrospective effect. Means, no doubt this error is discovered in the current year, but we will not give the effects in the current year, we will give effect in the previous period. But sir, if it is not the error of the previous year, if that error is related to years before the years of the previous year, let's say the error of the year 14-15 if we found in the year 2021, so what should we do? Again friends, you should prepare 3 balance sheet. This error is for the period 14-15. You are finding that error in the year 2021. So first balance sheet is as on 31st March 21 with compared to 31st March 20 with compared to 1st April 19. And the 1st April 19 will be considered as an opening balance sheet, and in that opening balance sheet you should rectify the error. Whenever I am using the word error, error includes fraud, error includes mistake, oversight. Means it may be intentional or it may be unintentional, whatever. Clear? So prior period errors are committed in the previous year but discovered in the current year. Prior period error are omission from and misstatement in the financial statement for one or more prior period arising from failure to use or the misuse the reliable information that was available, could reasonably expected to have been obtained. Example, error in calculation of expense or income, incorrect rate of DAPRI, fraud, oversight, mistake in everyone. And yes, we are giving the retrospective effect that I already given you. Clear? And you should restate the comparative information. Clear? Okay. And I already taken this example. If the error is of the year 2011-12, and if you are finding that error in the year 2016-17, then first balance sheet is as on 31st March 17, second 31st March 16, and the third is 1st April 15. Clear? So actually we covered all the points. Clear? So finally, if we discuss that disclosure, you should write the nature, effect on P&L, and if retrospective restatement is not practicable, then the reason. Clear? And finally, my Ind AS 10 is done. Can I go ahead? Okay, let's go ahead. Ind AS 10. Ind AS 8 is done, and now I am starting with Ind AS 10. So we have covered 4 Ind AS, 1, 2, 7, and 8, and now it's time for Ind AS 10. The name of Ind AS 10 is events after the reporting period. Most easiest Ind AS in your syllabus. Still, we cannot ignore this particular topic. Sir, why you cannot ignore this particular topic? Because the reason is very clear. Institute is asking a question of 5 marks from this Ind AS. Friends, please understand that. What is the events after the reporting period? We have under the world of accounting standard, that is accounting standard 4. Normally, let's assume my year ends on 31st March 2020. But in India, no doubt your year ends on 31st March 20, but you are not preparing the financial statement for the year 1920 on the same date. It will take time. Let's say my financial statement is prepared on 20 May 2020. Clear? My financial statement is approved by the board of directors on, let's say, it's 25th May 2020. My financial statement is approved by the shareholders in the annual general meeting, let's say on the 5th June 2020. And I am filing that financial statement, in MCA, that is called the Ministry of Corporate Affairs. Let's say it is on the 12th June 2020. Friends, my common question is to you. Can I say your year ends actually on 31st March 2020? That will take time up to 20 May for the preparation. Then board of directors will approve and it will be approved by the shareholders in the AGM. And then you are finally submitting to the government, that is called the MCA. In that particular time period, there are various events are occurring. And if you are not reporting that event in that financial year, so simply can I say now you will issue the next financial statement after 1 year. And if we are providing the information on time, then only it will serve the purpose. So 110% after 31st March, but before approval of financial statement, various events took place. It may be possible that events affect the decision of the readers of the financial statement. That's why this Ind AS came in the picture. If any event took place between the date of the financial statement, between the balance sheet date and the financial statement approved by the competent authority, will be considered as the events occurring after the reporting period. Now, problem is that, what is the meaning of the competent authority? Friends, competent authority is nothing but the governing body. And if this governing body, if you ask me, in case of company, it's board of directors. In partnership firm, it's a partner. In proprietorship firm, it's a proprietor. If it's a case of the HUF, then it's karta. But don't worry, Ind AS is only applicable to companies. And if Ind AS is only applicable to companies, one thing is very clear. In your case, approving authority is nothing but the board of directors only. Clear? So if any event took place between the date of the financial statement and the financial statement approved by the competent authority. So from 31st March 20 to here 25th May 20. So if any event took place between the date of the 31st March and the 25th May will be considered as an event occurring after the reporting date. Clear? Friends, you know very well, there are two types of event. One is nothing but the adjusting event and the second is nothing but the non-adjusting event. If any circumstances of the event is available on the date of balance sheet, just that provides additional evidences after the balance sheet but before the approval of the financial statement, then simply it will be considered as an adjusting event. But if any circumstances is not available on the date of balance sheet, that event took place after balance sheet but before approval of financial statement, then that event will be considered as a non-adjusting event. Friends, please understand, if that event is the adjusting event, then you should adjust that particular event in the books of accounts. But if it is a non-adjusting event, then adjustment is not required. So can you give an example? Answer is yes. If the fire took place on the 28th March 2020, but you know the actual amount of the loss after balance sheet, but the before approval of financial statement means let's say on the 2nd April. So on 31st March 20, you know this event was already occurred and you know this event was already occurred. So this will be considered as an adjusting event and you should provide the entire loss due to fire in the books of accounts. But let's assume just the fire occurred on the 2nd April 2020. And if the fire occurred on the 2nd April 2020, on 31st March, you have not any conditions for that event. And if you are not having any conditions for that event, simply it will be considered as a non-adjusting event. And if it is a non-adjusting event, adjustment for that particular event is not at all required. Clear? So simple. For adjusting event, an entity should adjust its financial statement for the adjusting event. Best example is settlement of the court case in the bankruptcy of the customer. Clear? For non-adjusting event, you should not adjust in financial statement for the non-adjusting event. Best example, major business combination, announcement of a plan to discontinue the operation, changes in the foreign exchange rate, then the changes in the tax rate and decline in the market value of investment. Now, in a question they will ask you, your date of balance sheet is 31st March 20. Your financial statement approval date is at 25th May 20. And the event took place on the 1st June 2020. And I am checking the paper. Number of students are writing an answer. This event is a non-adjusting event. Friends, you are writing the wrong answer. Whether this event is adjusting or not adjusting, first of all, that event should be the event occurring after the reporting date. Clear? In this question, if any event took place between the 31st March and the 25th May, is only considered as an event occurring after the balance sheet date. In this question, your event took place on the 1st June 2020, and if your event took place on the 1st June 2020, it will not be considered as an event occurring after the balance sheet date. Clear? Okay. Well, please understand. Adjusting event is always adjusted in the books of accounts, but the non-adjusting event is never adjusted in the books of accounts. But if your non-adjusting event which affects your going concern, then it should be adjusted. And friends, how can we say that this event it affects your going concern? If entity determines to liquidate or to cease trading, or the entity has no realistic alternative to do so, simple, then we can say that it affects our going concern. And when it affects our going concern, then simple, we should adjust the accounts. And friends, please understand, it is a violation of the going concern concept, so your entire account should be prepared on the basis of the non-going concern. Clear? Okay. Now the proposed dividend. There is no difference now in accounting standard 4 and the Ind AS 10, because there is no concept like proposed dividend today. In the year 2016, already accounting standard 4 was also changed. Means, actually for the year 2018-19, we are declaring the dividend in the year 2019-20, but still before 2016, we are recognizing that dividend in the name of the proposed dividend in the financial statement of the 2018-19 only, because it is considered as a statutory liability. Is it okay? But now please understand what is the liability. Friends, liability is nothing but a present obligation as a result of the past event in which you are expecting to have some outflow. That outflow is maybe in a cash or maybe in a kind. Can I say your now present obligation is nothing but just in the year 1920 only? And if your present obligation is just in the year 1920 only, you should not recognize the proposed dividend in the year 1819. You should directly recognize the declared dividend as a current liability in the year 1920 only. Clear? So simple, this is the one topic. Disclosure, it's okay, don't worry. Yes. Distribution of non-cash asset to the owner. This is a new topic which was not there in accounting standard 4. It is just in the Ind AS 10 only. And what is this topic? Please understand what I am trying to convey. In this year, I am giving some goods or some tangible items to my shareholder as a dividend. And I am not giving, that is nothing but what say, it's a cash dividend. Actually, I am giving the option of the cash or if any goods as a dividend only. So simple, if you are paying the cash, then you know exact amount of dividend. But whenever you are giving some goods, then how should determine? Friends, it should be determined at a fair value. Clear? Nothing new in that. So finally my Ind AS 10 is done. And yes, now, most important Ind AS I am starting. That is nothing but the income taxes. Clear? I am trying to cover each and every topic of the income tax. Please focus what I am trying to convey. Friends, why there is a need of this particular Ind AS? Just assume that. This is the data of the account and this is the data of the tax. And if I consider profit before depreciation, in accounts it is 100 and in tax it is 100. In accounts, whenever we are providing the depreciation, can I say friends, we are providing the depreciation as per Schedule 2 of the Companies Act 2013. And whenever we are providing the depreciation in the income tax, our depreciation is as per the Section 32 of the Income Tax Act 1961. So obviously both depreciation as per account and the tax, obviously it will be different. And now friends, if you understand, my depreciation as per account is 10 and my depreciation as per tax is nothing but the 15. Don't you think so? My profit before tax is nothing but the 90, but my as per tax record it's 85. I will pay tax to the government on the income of rupees 85. But as per the accounting record, I should pay tax to the government on the income of rupees 90. Can I say in the current year I am paying less tax? And if in the current year I am paying less tax, it's my liability to pay in the future. And if it is liability to pay in the future, on the differential income of rupees 5, friends, I should recognize the deferred tax liability. Deferred means it's nothing but the postponement. I am postponing my tax liability, so I am paying in that future. That's why it will consider as a deferred tax liability. It may be a reverse situation. Let's assume my profit before tax in the accounting record it's 85, but my profit before tax in the taxation record is 90. Can I say I am paying tax to the government on the income of rupees 90, but actually I should pay tax to the government on the income of rupees 85. So in the current year, actually I am paying little bit higher tax. And if I am paying little bit higher tax, can I say on this income, actually I should recognize the deferred tax asset. Clear? So friends, if you are recognizing the more income in the accounts today, you should recognize the more tax today. So simply, why this particular Ind AS is required? Because of the accrual concept, because of the matching concept, and because of the periodicity. What is the meaning of the periodicity? My current year income should be matched with the current year expenses. Clear? Friends, now please focus. What is income tax? So one thing is very clear. Whenever we are discussing the scope, just only one tax is covered, and that is nothing but the income tax. Other than income tax, we will not cover any tax. If anyone asks you, under the scope of Ind AS 12, we will cover GST, answer is no. We will cover octroi, no. We will cover custom duty, answer is no. We will just cover income tax. But friends, please understand, my company is in India and I am having one branch in the US. Clear? In US, obviously my Indian income tax at 1961 will not applicable. In US, the tax law of that particular country will be applicable, means my US branch will follow the US federal tax laws. Problem is that whenever we are recognizing the deferred tax asset or the deferred tax liability, we are recognizing the deferred tax asset or liability only on the just temporary differences. Other than temporary differences, we are not recognizing any deferred tax asset or liability. And let's assume, as per that US Income Tax Act, some like temporary differences arises. So whether we should recognize the DTA or DTL such temporary differences which was not created under Income Tax Act 1961, but which was generated under, that is nothing but what say US income tax. Answer is yes. That income taxes may be charged under the Income Tax Act 1961 or any other foreign tax. No, clear? Means first thing, we will consider the income tax. Second thing, we will also consider the withholding tax. Withholding tax is nothing but considered as a TDS, and that TDS is payable by either subsidiary, associate or joint venture on distribution to reporting entity. Clear? Then we will cover. Perfect? Okay. Now friends, you should understand the accounting profit. What is the meaning of accounting profit? Accounting profit is nothing but the profit or loss as per the accounts before deducting the tax expense. Simple, I am talking about the profit before tax. Tax profit? Tax profit is nothing but the income or the loss which will be computed as per the applicable tax law. Clear? Please forget account base and the tax base, that I will cover on the later stage, and because I want to convey just that. Then in profit and loss, we are first writing the profit before tax. After profit before tax, we will deduct the tax expense, and simply then it will be the profit after tax. Now what is the meaning of the tax expense? It is a current tax plus deferred tax liability minus deferred tax asset is equal to tax expense. Friends, current tax means whatever tax payable to the government in the current year. It may be possible it is a tax payable or it will be a refund. Deferred tax we are always creating on the temporary difference, and the tax expense is current tax plus DTL minus DTA. Now please understand what I am trying to convey. Whenever you are recognizing the current tax, you should use current year tax rate. Is it okay? But whenever you are recognizing the deferred tax, you should not use the current year tax rate, you should use the tax rate of the future years. Why? Why current year tax rate for the current tax and the future year tax rate for the deferred tax? Because logic is very clear. You are paying current tax today, and today this particular tax rate is applicable, that's why we are using the current year tax rate. But can I say you are recognizing the deferred tax on the temporary differences? And simply, in a layman language, if you ask me, what is the temporary difference? Because actually under the world of the accounting standard 22, there is no word like temporary difference. Under accounting standard 22, they are using the word timing difference. And what is actually the timing difference? Timing difference is nothing but any difference is generated during a particular year, which is expected to be reversed in a one or more future year. In a simple sense, in account we are recognizing the income today, but it will be taxable in the future. But in accounts we are recognizing the expense today, but we will get deduction of that expense in the future, then it will be considered as a timing difference. So can I say this timing or the temporary difference will be reversed in the future? And if that timing or the temporary difference will be reversed in the future, and at the time of the reversal, current year tax rate will not be applicable, at that time the tax rate was different. Simple, that's why we are using the future year tax rate. Clear? Now please understand what I am trying to convey. I have bifurcated entire Ind AS 12 into 9 parts. Number 1. First of all, we will determine the account base, that is also called as a book base. Then we will determine the tax base. After tax base, we will calculate the temporary difference. After temporary difference, you should identify the exception of the temporary difference. Then we will determine the tax rate. After determination of the tax rate, we will check the recoverability of the deferred tax asset. Then we will recognize the deferred tax. After deferred tax, we will check the presentation and the offsetting. And finally, we will check the disclosure. Again, I am repeating. Determine account base, tax base, temporary difference, exception of temporary difference, tax rate, recoverability of the deferred tax asset, then recognize deferred tax, then presentation and offsetting and the disclosure. Now friends, I am starting with the account base and then we will check the tax base. Friends, please understand what I am trying to convey. Friends, account base is nothing but carrying amount of the asset or liability in the balance sheet. It's account base. Simple. If I am purchasing one asset at rupees 1 lakh, let's assume in accounts I am providing the depreciation at the rate of the 10%. Means every year I am providing the depreciation of rupees 10,000. Already 3 years is lapsed. So can I say we have provided the depreciation of rupees 30,000? So simply I can tell you, my account base is nothing but the 70,000. Account base simply means carrying amount or the written down value which is actually there in the balance sheet. Clear? Okay. Temporary difference we will check on the later stage. Now we are determining the tax base of the asset or liability. Friends, first of all, we are determining the tax base of asset. What is the tax base of asset? Tax base of asset is nothing but the amount deductible for the tax purpose against future economic benefit. Amount deductible for the tax purpose against future economic benefit. Clear? Now please understand. That amount is deductible maybe by sale or maybe by use. If I consider I have purchased one asset at rupees 1 lakh, income tax department is providing the depreciation of 25%. So can I say at the end of the first year I am providing the depreciation of 25,000 and my tax base of asset will be considered as a 75,000. I will get deduction of rupees 75,000 in the future when I will generate the future economic benefit. Clear? Can I say the 75,000 is deductible in the form of depreciation? I think you are following me. Clear? Sir, can you give an example for the sale? Yes, I can give an example. Let's assume I am having the inventory and as per Ind AS 2, I have valued that inventory at rupees 1 lakh. Can I say from today, rather from tomorrow, if I sell this inventory at rupees 1 lakh, can I say I am eligible to take the deduction of rupees 1 lakh and I am liable to pay tax on the income of just rupees 50,000. So tax base of asset is nothing but the amount that will be deductible for the tax purpose in the future against any future economic benefit. Now please understand. I am purchasing one asset at rupees 1 lakh. I am not getting any depreciation on this particular asset. Means I am not getting any benefit of this asset, depreciation. And obviously one more thing. If I am selling this asset in the future, then again there is no tax on that profit. So simply, in this case, whatever the future economic benefit is actually not taxable. And if future economic benefit is not taxable, whatever your account base will be considered as a tax base of the asset. In this case, I am recognizing this asset at rupees 1 lakh in my books of accounts. In tax also, it will be considered as a 1 lakh. Simply, this is a tax base of asset. Now we are checking the tax base of the liability. Clear? Yes, here very clearly written. If economic benefit derived from the recovery of asset are not taxable, in this case, tax base of asset is taken at a carrying amount. Entity given a loan of rupees 100, but repayment of the loan has no tax consequences. So simple, my account base of the asset will be considered as 100 and the tax base of asset is again considered as 100. Now, I am determining the tax base of liability. But before determining the tax base of liability, just check the formula. Tax base of liability is nothing but carrying amount minus amount that will be deductible for the tax purpose in the future. So again I am repeating, tax base of liability is nothing but the carrying amount minus amount that will be deductible for the tax purpose in the future. Clear? Now please understand what I am trying to convey. First of all, if I take an example, please understand what I am trying to convey. There is an interest payable of rupees 100 in my books of accounts. But that interest, for that interest I will get the deduction on the cash balance. Means can I say I have not taken any deduction yet? All the deduction is pending. So what is my carrying amount? My carrying amount is 100 minus amount that will be deductible for the tax purpose in the future is entire 100. So my tax base of the liability will be considered as a nil. Clear? That example is given here. Next. Same example, there is an interest payable of rupees 100 in my balance sheet. I have taken the deduction of entire rupees 100. I have already taken the deduction. Can I say, friends, my carrying amount is nothing but the 100. And if I have taken the entire deduction of rupees 100, so amount that will be deductible for the tax purpose in the future is 0. Because I have taken the deduction. So simple, my tax base of the liability is considered as rupees 100. Is it okay? Third situation. Sometimes, if revenue is received in advance, then tax base, its carrying amount less amount of revenue that will not be taxable in the future. Perfect. So you should consider this point. There are items, for that particular matter, there is no carrying amount, but you have a tax base. Sir, can you give an example? Yes, I have based example. And that example is nothing but of the section 35D of the Income Tax Act 1961. You know very well section 35D deals with the preliminary expenses. If I am incurring total preliminary expense of rupees 100, can I say in the accounting record that will be charged to P&L? In accounting record it will be charged to P&L. Is it okay? Just we are in the step number 2. We have already decided the account base. Now we are determining the tax base. Perfect. But yes, in income tax, we are getting the deduction of 1/5 only. In income tax, we are getting the reduction of the 1/5. So can I say we are getting the reduction of rupees 20. So if we decide the account base and the tax base, can I say unamortized preliminary expense. Out of 100 rupees, everything is charged to P&L. So unamortized preliminary expense is 0. But can I say, friends, from 100 rupees, I have taken just the deduction of rupees 20 in the income tax record. So my unamortized income and unamortized preliminary expenses of rupees 20 in the tax record. Is it clear? So simple. Here, there is no carrying amount, but we have only just a tax base. Perfect. Okay. Next point. Items of assets and liabilities where actually tax base is not apparent. Clear? Best example is nothing but actually some amount is taxable in the different heads of income. Like if we are earning the rent, then there is a problem whether we should consider that rent in the business or professional income, or it will be considered as a house property. Clear? So friends, my step number 2 is done. Number 1 is nothing but the account base. Number 2 is nothing but the tax base. And now we are determining the temporary differences. Friends, under the world of accounting standard, we are using the word timing differences. But under the world of the Ind AS 12, friends, we are using the word temporary differences. Accounting standard 22 is based on the P&L approach, but the Ind AS 12 is based on the balance sheet approach. What is a temporary difference? Temporary difference is nothing but the difference between the account base and the tax base. Please understand, there are two types of temporary difference. One is called the taxable temporary difference and second is called the deductible temporary difference. Whenever it is a taxable temporary difference, friend, you should recognize the deferred tax liability on such difference. But whenever it's a deductible temporary difference, friends, you should recognize the deferred tax asset on such difference. Please remember, clear? So simple, this is done. Now some students are asking me, sir, what is the difference between the timing difference as per accounting standard 22 and the temporary difference as per Ind AS 12? Friends, timing and temporary is actually not same, but we can say that temporary difference includes timing difference. So scope of the timing difference is very narrow, but the scope of the temporary difference is very wide. Clear? If we can example, these are the example of the timing difference and the temporary difference both. Like interest income in accounts on a time basis, but in tax on a cash basis, they are preliminary expenses. But these are the different. These are the just an example that is of the temporary difference. If it is a revaluation of asset, we are not recognizing any deferred tax in the revaluation of asset under the world of the accounting standard. But yes, we will recognize the deferred tax in Ind AS. Clear? So simple, this is done. Then friends, now we are recognizing deferred tax. I am just changing the sequence. Just remember my one line. Just remember my one line. You will give any answer of the Ind AS 12. And what are that? Please understand. If account base of the asset, this is an account, this is a tax. If the account base of asset is greater than the tax base of asset, then friends, you should recognize the deferred tax liability. But for liability, if your account base of liability is greater than the tax base of liability, then friends, you should recognize the deferred tax asset. Again I am repeating, for asset, if your account base is greater than the tax base, then we will recognize the deferred tax liability. But for liability, if your account base is greater than the tax base, then we will record the deferred tax asset. If you are not comfortable with this, just remember it's a reverse situation. It's learned by heart. If asset higher, then DTL, liability higher, DTA. Why people are trying to remember all the four things? Yes, I can do. If I think that vice versa. If the account base of the asset is lower than the tax base of the asset, then I should recognize the deferred tax asset. But if account base of the liability is the lower than the tax base of the liability, then simply you should recognize the deferred tax liability. Clear? So this table is the most important table. You should remember that. But if you ask me, I will just remember the 2 points. Next point. That is nothing but the exception of temporary difference. Now please understand. Under accounting standard, they are using the word timing differences and the permanent differences. But under Ind AS, it is a temporary difference and the exception of the temporary difference. Whenever I am using the word, it's an exception of the temporary difference. Friends, please understand, on that exception, you should not recognize any deferred tax asset or deferred tax liability. You should not recognize any deferred tax asset or the deferred tax liability. And what are that temporary difference? Please understand. Initial recognition of goodwill. Here it is a mistake. Just write additional. At the time of business combination, initial recognition of goodwill at the time of the business combination. And the next point, that is nothing but initial recognition of asset or liability, which is actually not a transaction of the business combination, but it does not affect neither accounting profit nor taxable profit. Again, I am discussing the exception of temporary difference. There are two exceptions. First is initial recognition of goodwill at the time of the business combination. And second point, initial recognition of asset or liability, which is not the transaction of the business combination. And at the time of the transaction, it affects neither accounting profit nor taxable profit. Now let's discuss first of all the initial recognition of asset or liability at the time of the business combination. Friends, whenever I am using the word initial recognition of asset or liability at the time of the business combination, you know very well. Whenever we are acquiring any asset or liability in the business combination, in account, we are recognizing that asset or liability at a fair value. But can I say in a tax, it will be considered as a previous owner's carrying amount. So obviously there is a temporary difference. And if there is a temporary difference, it results in the deferred tax asset or the liability. Let's take an example. I am having the example. Friends, this is an account base and this is a tax base. Clear? First of all, if I check for the account, we are recognizing the property, plant and equipment at a fair value, and the fair value is nothing but the 130. So here I am writing property, plant and equipment 130. Inventory, can I say 20? Intangible asset is a 50 minus liability 20. So friends, if I check the net asset, 130 plus 20, it's 150 plus 50, 200 minus 20, it's a 180. But can I say my purchase consideration is nothing but the 200? So can I say my goodwill will be considered as a 20? I am having the tax base. For PPE it's 100, for inventory it's 10, here 0, and here it's exactly 20 only. Can I say for property, plant and equipment, this is an asset, and let's calculate timing difference, 30, 10, and here it's a 50. These all are asset. And all are asset, and for asset, please check your account base is greater than the tax base. For asset, if your account base is greater than the tax base, can I say on this timing difference, this is on the timing difference of 90, I should recognize the deferred tax liability at the rate of 30. So 90 into 30%, can I say I should recognize the DTL 27? Friends, whenever you are recognizing the deferred tax liability, can I say this deferred tax liability is actually generated at the time of the business combination only. And if it is generated at the time of the business combination only, you will not pass an entry, P&L account debit to deferred tax liability. Friends, you should pass an entry, goodwill account debit to deferred tax liability 27 and 27. If I am passing this entry, can I say my original goodwill is nothing but the 20 plus because of the DTL it's 27, so total goodwill is 47. If again I consider this difference of 47, because in my accounts this goodwill is 47, but in a tax it's 0. So if I again recognize the deferred tax on this 47 into 30%, let's say it's a 14.1. Can I say what should I pass an entry? Again I will pass an entry. Goodwill account debit to deferred tax liability, just assume. So can I say if I pass an entry, goodwill account debit to deferred tax liability, my goodwill is again increased by 14.1. So 47 plus 14.1, it is 61.1. And if it is 61.1, friends, rule is very clear. Again, if you recognize the goodwill on such temporary difference of 61.1 at the rate of the 30%, 18.33, again that will add. I think you are now following me. This circle goes on. It's a never-ending process. And if it is a never-ending process, that's why they have prohibited to recognize goodwill at the time of the business combination. Clear? Friends, please understand. This is an initial recognition only. Now, we have to check for subsequent recognition. And that's why number of students are making a mistake here. That's why I have taken one example. Goodwill acquired in a business combination at a cost of ₹100. This above is a tax deductible at the rate of the 20%, starting from the year of acquisition. There is no impairment of goodwill at the end of the year 1. Whether company need to recognize any DTL for amortization of the goodwill. This is the data of account and this is the data of tax. At the time of initial recognition of goodwill, we are not recognizing any of the deferred tax because it is a prohibited. But you know very well, under Ind AS, goodwill is never and ever amortized. Goodwill is only and only tested for impairment. And if I am providing the impairment, in this question there is clearly given that there is no impairment at the end of the year 1. Can I say at the end of the year 1 means at the time of the subsequent recognition, my balance of the goodwill is nothing but the 100 only. But in the tax, I am getting the deduction of the amortization at the rate of the 20%. So 100 minus 20, this is an 80. Can I say if my account base of the goodwill is 100, my tax base of the goodwill is 80, can I say my temporary difference is 20? My question is whether exception is applying this case. What is an exception? Initial recognition of goodwill at the time of the business combination. In this question, it is very clearly given here, it's not an initial recognition, friends, it is a subsequent recognition. And if it is a subsequent recognition, exception will not apply and we should recognize deferred tax on this temporary difference of rupees 20. Clear? So this is an answer. Now I'm going further. Second exception. Initial recognition of asset or liability which neither affects accounting profit nor affects its taxable profit. Base example. Whenever we are recognizing the dividend payable in our books of accounts, it is not affecting my accounting profit and it is also not affecting my taxable profit. So our initial recognition is applied. I have a second example. I have purchased one asset at rupees 5 lakh. Total life of the asset is 5 years. Depreciation is actually not deductible and there is no tax on the difference between the purchase price and the selling price on the disposal of asset. So simple, whatever I am getting the future economic benefit is not taxable. So again, I am not supposed to recognize any deferred tax here. Okay. Friends, you know very well, please understand. If original thing is recognized in P&L, deferred tax is recognized in P&L. If original thing is recognized in OCI, deferred tax is recognized in OCI. If original thing is recognized in equity, deferred tax should also be recognized in equity. Sir, can you give an example? If temporary difference is because of the depreciation, depreciation is recognized in P&L, deferred tax is recognized in P&L. If we are recognizing the deferred tax because of the revaluation, revaluation is recognized in OCI, deferred tax is recognized in OCI. If we are recognizing the deferred tax because of the compound financial instrument and because of the equity component, deferred tax is again recognized in equity component. Clear? There are some measurement issue. And yes, first of all, we are checking this prudence for DTA. Whenever we are recording the deferred tax liability, friends, please understand that deferred tax liability will be okay. But don't you think so? Whenever you are recognizing the deferred tax asset, you are recognizing the future gain from today only. And whenever you are recognizing the future gain from the today only, it's a pure violation of the prudence concept. Pure violation of the conservatism concept. That's why Ind AS 12 suggested that whenever there is a deferred tax asset on the temporary differences, deductible temporary differences, or at the time of the unabsorbed depreciation and the carry forward of losses, you can recognize the deferred tax asset only if it is probable that taxable profits will be available against which deductible temporary difference can be utilized. Clear? And how can we determine that it is a probable? Number one, if you have future profit sufficiency. If you have future profit sufficiency. Number two, if you are not having the future profit sufficiency, you should have, that is nothing but sufficient taxable temporary difference against which you can set off the deductible temporary difference. And the number third, you are planning to apply some tax planning strategy. Then only I can say that it's a probable. Clear? If I discuss the measurement issue, let's assume my account base of the asset is 100, tax base of the asset is 60, my temporary difference is 40. But if I am using this asset, then simple business and profession will be taxable at the rate of the 30%. But if I am selling this asset, then the capital gain. So simple, you have to check your intention. If you want to use this asset, then you should recognize the deferred tax at the rate of 30%. But if you are planning to sell this asset, then you should recognize at the rate of the 20%. Clear? Business combination we have already covered. Perfect. Okay. This is a question related to compound financial instrument. Friends, I am having the zero coupon bond. Whenever it is a zero coupon bond, there is no contractual obligation to pay any interest for the first 3 years. This is the convertible loan. So simple, it's considered the compound financial instrument, and you have bifurcated the proceeds of rupees 10 lakh into the liability and equity. Liability component is 7,50,000 and the equity component is nothing but the 2,50,000. Clear? On 7,50,000 every year we are adding the 10% interest. So simple, if I consider my balance of the liability component, 750 plus 10%, 825 plus 10%, 908, it have 1,000. But tax base will be considered as equal. So simple, whatever the time being difference, on that temporary difference, you should recognize GTL. Clear? So finally, this is the end of Ind AS. No, there are 2 to 3 topics. First of all, presentation. Friends, deferred tax asset or liability is always disclosed on the face of balance sheet. It's always disclosed on the face of balance sheet. It may be possible you are having some taxable temporary differences, and it may be possible you are having some deductible temporary differences. Whenever you are having the taxable temporary differences, you are recognizing the deferred tax liability on such taxable temporary differences. But whenever you are having the deductible temporary differences, friends, you should record the deferred tax asset on such temporary differences. Now please understand. In the current year, you are having the both type of differences. Can you set off the balance of the DTA and the DTL to each other? Answer is yes. If they are created under the same law, and the second, entity has a legally enforceable right to set off. So this is a little bit difficult for us. This is not a difficult. I already explained you that income tax is maybe charged under Income Tax Act 1961 or any other foreign tax law. Clear? So it may be possible that deferred tax may be created under the different types of the tax law. Clear? If it is under the same tax law, then you can set off. Or if entity has a legally enforceable right to set off, then it can be set off. Next point. Deferred tax asset or liability is never and ever discounted. No doubt it will be settled in the future, but discounting of that is prohibited. Clear? Now, there are 3 main important points for CA final. First of all, I am discussing the MAT. Section 115JB of the Income Tax Act, that is called the MAT, and the AMT, Alternate Minimum Tax, Section 115JC of the Income Tax Act. Why this MAT is required? Let's assume my accounting profit is a 5 lakh, my taxable profit is a 50,000, and the MAT profit is nothing but the 4,50,000. Institute will never ask you to calculate the MAT profit as per section 115JB in the FR paper. Please repose trust on me, they will give you a MAT profit. Whenever we are paying tax to the government, it's a rule. We will calculate our tax as per the normal provision. That is nothing but the normal income tax profit into the normal tax rate. Then we will calculate our tax liability as per the MAT, and whatever the higher, we will pay to the government. That is called the current tax. But difference between the accounting profit and the taxable profit is considered as a timing difference. And friends, on that timing difference, you should recognize the deferred tax asset or the deferred tax liability. Now please understand what I am trying to convey. As per the provisions of the Income Tax Act 1961, rule is like this. If in any particular year, you are paying tax to the government under the MAT, then whatever the excess tax over and above the normal tax is considered as a MAT credit, which can be carried forward for the 10 years and can be set off against your future normal tax liability. So for recognizing the MAT credit, we will pass an entry, MAT credit receivable account debit to P&L, and so finally it will reduce the tax. That MAT credit is disclosed under the heading of the loans and advances. It may be a long term or it may be a short term. If you are expecting that, you will reverse your MAT credit within 12 months from the reporting period, then it will be considered as the short term loans and advances. But if you are expecting that it will take them more than 12 months, then it will be considered as a long-term loans and advances, and that will be disclosed under the heading of balance with revenue authority. Clear? So current tax is higher of the regular tax in the MAT. This is MAT credit, I already explained you. Friends, please understand, whenever you are creating the deferred tax asset or deferred tax liability on timing differences, that deferred tax asset or liability will be at a normal rate only. In that situation, we will not use the MAT rate. Clear? Next point. That is called the tax holiday period. Under Income Tax Act 1961, under various sections, they are giving the tax holiday. 80IA, IB, IC, 10A, 10B, 10C to the specific type of business for particular time interval. Logic is that, let's assume there is a 10-year tax holiday and I am in the year 9th. This is my accounting data, this is my taxable data, profit before rent income is 100 rupees. One rent income is accrued. That's why I am passing an entry rent receivable account debit to rent income account. So can I say it will be added? So my accounting profit is 110 and my taxable profit is 100. Ask yourself, on which income you will pay tax to the government? Sir, we will pay tax to the government on the income of rupees 100. Don't you think so? As per accounting record, you should pay tax to the government on the income of rupees 110. So in the current year, we are actually paying the less tax to the government. And if we are paying the less tax to the government, simple, it will create the liability on me. So simple, we should recognize the deferred tax liability. Is it okay? You have made a mistake, I will explain you. Now it's the 10th year. This is the accounting data, this is the tax data, 100 and 100. That 10 rupees which was receivable in the last year, I am receiving in the current year. And if I am receiving in the current year, can I say income tax department will demand the tax from me? My accounting profit is 100 and my taxable profit is 110. Ask yourself, on which income you will pay tax to the government? Sir, we will not pay tax to the government because it is a tax holiday period. Obviously, in the 9th year also, you will not pay tax to the government because it was the tax holiday period. But still, I want to remind that it's a DTL. My point is that if any difference is generated during tax holiday period, which is expected to be reversed within tax holiday period, then it should be ignored. But if any difference is generated during tax holiday period, which is expected to be reversed after tax holiday period, then it should be considered for the deferred tax asset or the deferred tax liability. I think it is clear to you. Clear? Now, because if it is a 10th year and if it is a 11th year, so obviously my difference is generated during tax holiday, but which will be reversed after tax holiday. And if it is reversed after tax holiday, then simply we should consider the deferred tax asset or liability on that temporary differences. Clear? And obviously, whenever you are reversing that particular method, you should always use the FIFO method for the reversal. In the last topic of Ind AS 12. Friends, whenever you are selling any of the residential property after 3 years from the date of acquisition, then you are chargeable under the head of the capital gain, and that will be your long-term capital gain. But whenever you are selling the depreciable asset at any time, it will be your short-term capital gain. Anytime. It is income tax section 50. Now assume, in accounts, what we are doing? In accounts, if we are using some particular asset, and if we are selling that asset, then up to the date of sale, first of all, we are providing the depreciation, and then we are finding out the carrying amount. We will compare that carrying amount with the selling price, and whatever the difference, that difference is considered as a profit on sale of asset. But under income tax, it is not like that. Under income tax, if you are selling any of the asset in the current year, what should you do? First of all, you should deduct sales consideration from the block of asset. If there is any net block is pending, then you should provide the depreciation. But if there is no any block of asset is there, then simply it will be considered as a short-term capital gain. So it may be possible in the current year, in accounts, I am recording the profit on sale of asset today. But in the tax, it will not be taxable today, it will be taxable in the future whenever my block of asset is 0. So simply, it is a timing difference, and on that timing difference, you should recognize the deferred tax. Clear? So for income tax purpose, first of all, we will deduct the sale proceeds from the opening block and find out the depreciation on the net block. But for accounting purpose, first of all, calculate depreciation up to the date of sale of asset and deduct the book value of asset. And then finally, we will compare our account base with the tax base. Simply whatever the temporary difference, and on temporary difference, we will record the deferred tax. Clear? So this is all about Ind AS 12. Now, without drinking water, let's start Ind AS 16. Your favorite Ind AS. Name of Ind AS 16. Property, plant and equipment. In the year 2016, under the world of accounting standard also, old accounting standard 10 was abolished. That was the accounting for the fixed asset. And the new Ind AS 16 was, new accounting standard 10 was introduced. And the name of accounting standard is a property, plant and equipment. Clear? It's a very easy if you learn by concept and simply. Clear? Let's start. First of all, we are discussing the meaning of an asset. Asset means any resource which is owned or controlled by an enterprise as a result of a past event from which future economic benefit is expected. Now, what is the meaning of the fixed asset? Friends, fixed asset means any asset which is not held for sale. Please understand, which is not held for sale. Which is held for use in production of goods and the rendering of services for rental to others or for administrative purpose. And life of the asset is more than one accounting period. Friends, life of the asset is more than one accounting period. They have not written the word more than 1 year. If I consider the situation number 1 and the situation number 2, in situation number 1, I am purchasing the one asset on 1st April 2020. Life of the asset is just 1 year. So can I say my life is up to just 31st March 2021? Second situation. In situation number 2, I am acquiring one asset on the 1st January 20. And the life of the asset is only up to 1 year. So can I say it will last up to 31st December 2020? In first case, it will not be considered as a property, plant and equipment. But in the second case, it will be considered as a property, plant and equipment. Why? In second case, they are fulfilling the criteria of the more than one accounting year. Because I have acquired the asset on the 1st January 2020, that is in the year 1920. And I am disposing the asset on 31st December 2020, that is in the year 2020-2021. So simply, it fulfills my criteria. Clear? So simple, this is the definition of fixed asset. Now you should understand the definition of non-applicability. Any biological asset which is related to agriculture activity other than bearer plant. Now please understand, what is the biological asset? Friends, biological asset is nothing but the any living animal or the any living plant. If that is related to agriculture activity, then Ind AS 16 will not be applicable. But if it is not related to agriculture activity, then Ind AS 16 will be applicable. Sir, can you give an example? Yes, I can give an example. If I am having a dog, that is my pet, Ind AS 16 is not applicable because dog is not giving any future economic benefit to me. But let's assume I am having the horse and I am using that horse in the horse race. Obviously, that horse is considered as a biological asset. But that biological asset is not related to agriculture activity. That's why Ind AS 16 is applicable. Friends, you are not believing me. That horse is a property, plant and equipment. And Ind AS 16 will be applicable. If I am having the bullock and I am using that bullock for the agriculture activity, then simply Ind AS 16 is not applicable because that living animal I am using is for the agriculture activity. Clear? They have clearly given that other than bearer plant. What is a bearer plant? Which produces some fruits or whatever. Clear? Let's take an example. This is a mango tree. Obviously on a mango tree there is a mango. If I am harvesting that mango from the mango tree, that tree has a capacity to produce the same type of mango again and again. So this plant will be considered as a bearer plant. Friends, please understand. Ind AS 16 is only applicable to the mango tree, but it is not applicable to the mango. Ind AS 16 is only applicable to the orange tree, but it is not applicable to orange. And obviously Ind AS 16 will not be applicable to the wheat and rice crop. What is very clearly given that Ind AS 16 is only applicable to the bearer plant, but it is not applicable to the produce of the bearer plant. Mango tree is considered as a bearer plant, but a mango is considered as a produce of the bearer plant. Number 2, any property, plant and equipment which was classified as a held for sale. And yes, if any asset is classified as a held for sale, we have Ind AS 105, non-current asset held for sale and the discontinued operation. So we will account that asset under Ind AS 105. Third, recognition and the measurement of the exploration and the evaluation of the mineral resources. Again, for exploration and evaluation, we have specific Ind AS called Ind AS 106. That is actually not in syllabus. So that's why Ind AS 16 is not applicable. And the fourth, investment property, Ind AS 40. Now, I already covered biological asset is a living animal or plant. Agriculture activity is a management by an enterprise of the biological transformation and harvest of biological asset or sale or conversion into agriculture produce or into the biological asset. Already covered mango tree example. Clear? Now, if that is in the scope of the Ind AS 16, we should determine the recognition criteria. There are 2 recognition criteria. Cost of the property, plant and equipment should be measured reliably. And the second criteria, it is expected that future economic benefits will flow to the entity. Future economic benefits will flow to the entity. If you are fulfilling all the criteria, I can tell you, you can recognize the property, plant and equipment in your books of accounts. Clear? First thing. If you are purchasing the asset, what amount should be capitalized as a fixed asset? We will capitalize purchase price, directly attributable cost, and the present value of the dismantling cost. So if I consider the purchase price, friends, please understand, if in the purchase price, some duty or taxes is included, and if you are eligible to take the credit or refund of that duty or taxes, then it should not be deducted from the purchase price. But if in the purchase price, some duty or taxes is included, and if you are eligible to take the credit or refund of the duty or taxes, then it should be deducted from the purchase price. If in the purchase price, some trade discount is included, obviously it should be deducted from the purchase price. But if in the purchase price, some cash discount is included, then it should not be deducted from the purchase price. It may be possible. You are purchasing the asset today. And if you are purchasing the asset today, then simply you are not making the payment today, but you are deferring your payment. And because of the deferment of payment, if you are paying little bit extra amount, that extra amount will be considered as an interest and that is not added in the cost of asset. Clear? Next. Any cost incurred for bringing the fixed asset to its present location and the condition. Means what I am trying to convey. You know very well. If we are incurring any expense up to the ready to use of asset, forget put to use, it's a ready to use. If any expense is incurred before the asset ready to use of the asset, then all the expenses is capitalized with the fixed cost, fixed asset. Third, initial estimates of the cost of removing and the site restoration at present value by applying the pre-tax discount rate. Friends, one of my favorite example. This is my house, and what often people came at my house, they asked me to install the tower at my terrace for 10 years. I asked Vodafone people, after 10 years, they will dismantle or they will remove the tower. So I asked one question. Whenever you are removing that tower from my terrace will not be in the normal condition. My terrace will be in the damaged condition. And if my terrace will be in the damaged condition, you have to give my terrace in as it is condition. Means you have to restore my terrace. Means in a simple language, they have to incur some repairing expenses on my terrace. And if they have to incur some repairing expenses on my terrace, can I say Vodafone will estimate the amount? And if Vodafone will estimate the amount, let's assume they have estimated 10 lakh rupees. But that 10 lakh rupees is not payable today. This 10 lakh rupees will be payable in the future. And if that 10 lakh rupees payable in the future, we will discount that 10 lakh and let's assume it's a 7 lakh rupees. 7 lakh rupees will be added in the cost of the asset. Clear? Friends, please understand. we will create one provision of rupees 7 lakh. But ask yourself, whether after 10 years, whether I have to pay 10 lakh rupees or 7 lakh rupees. Sir, you have to pay 10 lakh. But can I say I have recorded just 7 lakh? On every year, you should recognize the interest cost. So remember me, your balance of the provision will be increasing day by day, but your balance of the asset is decreasing day by day. Why your balance of the provision is increasing day by day? Because of the interest expense. And why balance of the asset is decreasing day by day? Because of the depreciation. Clear? This is all about the cost of asset. Obviously, we will not capitalize any income because of the incidental operation, advertisement expense, staff training, cost of relocating the operation, and the initial operating losses. Clear? Okay, number of students are thinking that, sir, why staff training is not capitalized? Because rule is very clear. If you are giving training to the employees, then the capacity or the capability of the asset is not increasing. Just the capacity or the capability of the particular person is increasing. In India, we are not recognizing any human resource asset in the books of accounts. Clear? Then next point. Can we record the self-generated asset in our books of accounts? Answer is yes. You can record any self-generated asset in the books of accounts except the self-generated goodwill. What is the meaning of the self-generated asset? If any asset is created by in-house efforts, then it will be considered as a self-generated asset. Whatever your expenses incurring like material, labor, overhead, that all expenses are capitalized. Plus, please remember, if you are making any internal profit at the time of the self-generated asset, that internal profit should be eliminated. Means internal profit we cannot recognize in our self-generated asset. This is a difficult point for the CA final student. Please understand. Sometimes we are doing the barter. Means we are exchanging the asset. Whenever you are exchanging the asset, this rule is equally applicable at the time of Ind AS 38, at the time of Ind AS 40. So please remember what I am trying to convey. Whenever you are actually exchanging of the asset, new asset should be recognized at fair value of asset given or fair value of asset taken, whichever is more clearly evident. Now it's confusing. Whether asset given is more clearly evident or the asset taken is more clearly evident. That's why for a 2 minute we should go in the Ind AS 113. The name of Ind AS 113 is the fair value measurement, and if I discuss the definition of the fair value, friends, fair value is the price that would be received when asset is sold, that would be paid when liability is transferred in an orderly transaction between the market participants on a measurement date. So please remember, fair value is Ind AS 113 is following the exit price approach. So for us, mostly fair value of asset given is more clearly evident and not taken. If in information fair value of asset given is not given, then you can use the fair value of asset taken. Otherwise, if you are having the both data, then fair value of asset given is clearly evident. This is our basic rule. But in a two situation, we are using our exceptional rule. Number one, if the transaction lacks commercial substance, or number two, fair value of the neither of the asset is measured reliably. In that situation, you should use the carrying amount of asset given less cash received, if any. Friends, please understand. Whether you are using the basic rule or you are using the exceptional rule, in the both situation, you should use the value of the asset given. But in a basic rule, we are taking the fair value of asset given. But in exceptional rule, we are considering the book value of asset given. Now I have used the one commercial substance. What is the meaning of the commercial substance? Whether the transaction has a commercial substance or not, that is actually depends on the entity's future cash flow. Whether that cash flows is changing or not. If after exchange of the transaction, if entity's future cash flows are changing, then I can tell you transaction has a commercial substance. But if after exchange of the transaction, if the entity's future cash flows is not changing, then transaction lacks the commercial substance. Clear? Now, I'm starting a new point. Till date, we have learned the initial recognition. Now it's time for subsequent recognition. Friends, for subsequent recognition, you have a two choice. You can use the cost model or you can use the revaluation model. If you are using the cost model, then asset should be disclosed as the cost minus accumulated depreciation minus accumulated impairment loss. But if you are using the revaluation model, whether you want to use the cost model or revaluation model is completely choice of the entity. that is an accounting policy adopted by the entity, but you should follow that accounting policy for the similar class of asset. What is the class of the asset? Asset, group of asset having similar nature, usage and at a similar location. Clear? I cannot use the cost model for one factory but revaluation model for another factory. But yes, I can use the cost model for the factory building but the revaluation model for the office building. Whenever you are doing the upward revaluation, the maximum revaluation should be up to the recoverable amount. Clear? And whenever you are doing the upward revaluation, entry should be property, plant and equipment account debit to revaluation reserve. That revaluation reserve is recognized in OCI, for which reclassification to P&L is not possible. But if it is a downward revaluation, then simply you should recognize the loss in the P&L and you will pass an entry P&L account debit to asset. If it is a first time upward, then downward, entire loss is not transferred to P&L. First, that loss is adjusted against the balance of the revaluation surplus. Remaining, if there is any loss, then it should be transferred to P&L. But if it is a first time downward and then upward, entire gain is not credited to revaluation. First of all, gain is credited to P&L. How much? Difference between the book value with downward revaluation and the book value without downward revaluation, excess if any, will be credited to revaluation reserve. Clear? This class I already explained to you. Yes. Friends, whenever you are doing the revaluation, you should adjust the balance of the accumulated depreciation. And for that, you have a two method. Number one, the balance of the gross block and accumulated depreciation is changing proportionately. And number two, eliminate the balance of the accumulated depreciation. Clear? I have taken example. If my gross block is 1 lakh, accumulated depreciation is 20. So can I say my net block is 18? I want 1,10,000. So first of all, I am making the proportion. And in the second method, we will do the elimination of the accumulated depreciation. Clear? If you are taking any of the asset at a higher purchase, you should recognize that asset at a cash price. If there are jointly held assets, then it will be recorded at a pro rata cost or at a consolidated price on a fair value basis. It's a very simpler. Clear? Okay. Next point. Friends, this is the most important. Whenever you are changing your dismantling cost, there are two examples in your module, you cannot ignore that. Then simple, if you are following the cost model, then what should you do? If you are following the cost model, please remember, if your provision balance is increasing, you should pass an entry asset account debit to provision account. If the amount of the provision is decreasing, you should pass an entry provision account debit to asset account. But you should ensure that if your provision is increasing, your balance of asset is increasing. But it should not be increased by more than the recoverable amount of the asset. And if it is increased more than the recoverable amount of the asset, then the excess amount is transferred to P&L. If provision amount is decreasing, your balance of asset is also decreasing. But you should ensure that your balance of the asset should not be in the negative. If it is like that situation, then it should be credited to P&L. If you are following the revaluation model, if your balance of the provision is increasing, you should pass an entry revaluation reserve account debit to provision. But if your balance of the provision is decreasing, you should pass an entry provision account debit to revaluation reserve. Clear? This is the entry. Depre. Yes, friends, understand, please, if you are changing in the depreciation method, it should not be considered as a change in accounting policy, but it is considered as a change in accounting estimate and it should be provided prospectively. Clear? So finally, this is end of Ind AS 16. Friends, after Ind AS 16, let's start now Ind AS 19. And the name of Ind AS 19 is nothing but the employee benefits. This is the one of the most important Ind AS in your syllabus. Friends, please remember what I am trying to convey here. Under the world of accounting standard, we have one specific accounting standard for accounting of the employee benefits, and it is nothing but the accounting standard 15. But yes, there are some differential points between the accounting standard 15 and the Ind AS 19. We will discuss that point also. First of all, why this Ind AS is needed? Please remember, in this case, we are doing the accounting of the employee benefits. So this Ind AS is only applicable to the employer and not applicable to the employee, because for employee it is an income, and whenever it's an income, it is not accounted as per the Ind AS 19. So this Ind AS is only and only applicable to, that is nothing but the employer. Clear? First of all, friends, you have to consider that what is the meaning of employee. Friends, please remember, employee may be a part-time, employee may be a full-time, it may be a skilled, it may be unskilled. Friends, including managing director, and the whole-time directors is considered as an employee. Again, I am repeating, it may be a part-time, full-time, skilled, unskilled, including managing director and the whole-time director will be considered as an employee. Clear? So simple, this standard addresses only the accounting of employee benefits by the employer. Standard applicable to benefits provided the all type of employee. It may be a full-time, part-time or the casual staff. Clear? Friends, benefit can be paid in cash or in kind, or it can be paid to the employee or their dependent, whatever. Because whenever it's a salary, we are paying salary to our employee. But whenever it's a game of the pension, we are not paying the pension to our employee, but we are paying the pension to the dependents of employee. Clear? Now, friends, please understand what is the meaning of employee benefit. Friends, the meaning of the employee benefit is very clear. Whether you are paying to employee or his relative, either in the cash or in a kind, it may be possible during the term of employment or the after employment, that all thing will be considered as an employee benefit. Again, I am repeating, whether you are paying to employee or its relative, either in the cash or in kind, during the term of employment or the after employment will be considered as an employee benefit. Friends, you know very well, salary is payable to the employee, but the pension is payable to the relative of employee. It may be possible we are making the payment in cash, salary, wages, bonus, leave encashment is making the payment in the cash. Or it may be possible we are making the payment in kind. It may be possible we are providing the furnished accommodation to my employee. We are providing the car to my employee. So simple, that is nothing but that employee benefits are in kind. During the term of employment or after employment? During the term of employment, we are making the payment of the salary, wages, bonus, leave encashment, or it may be possible at the time of retirement, we are making the payment of the VRS. But in the after employment, pension is actually giving after employment. Clear? So my definition, two definition is very clear. First of all, the definition of employee. Employee may be, it means it may be a full-time, part-time, skilled, unskilled, including managing director and the whole-time director. But yes, friends, please understand, if there is any casual labor also, it will be considered in the definition of employee. But if we are giving the contract to the manpower agency, like if I discuss, in our Navkar Institute, we have the number of securities. Clear? They are at all premises, we have approx 4 to 5 securities person. But friends, please remember, we are not appointing security. We have done the contract with the manpower agency. That manpower agency will appoint securities at our different premises. We are making the payment to the manpower agency, and the manpower agency will give payment to that particular security person. I think you are getting me. In that situation, that security person is not my employee, but that security person will be considered as an employee of the manpower agency. That should be keep in your mind. Clear? And the next definition is nothing but the employee benefit. Whether you are making the payment to the employee or its relative, either in the cash or in kind, it may be possible during the term of employment or the after employment will be considered as the employee benefits. Clear? Simple. There is a two different thing. Please understand. One is nothing but contract of service, and the second is nothing but contract for service. If there is an employer-employee relationship, then only it will be covered under the definition of Ind AS 19. Otherwise, it will not be covered in the definition of the Ind AS 19. Clear? In particular, Ind AS 19, we are just considering the contract of service and we are not considering the contract for service. Clear? Okay. Next type, simple, there are 4 types of employee benefits. One is nothing but the short term, long term, termination and the post-employment. If any benefit is payable within 12 months from the reporting date, then it will be considered as the short-term employee benefit. If any benefit is payable after 12 months from the reporting date, then it will be considered as a long-term employee benefit. If any benefit is payable exit at the time of the retirement, then it will be considered as a termination of benefit. And if any benefit is payable after retirement, then it will be considered as a post-employment benefit. If you ask me, best example of the short-term employee benefits is nothing but the salary, wages and the bonus. Long-term employee benefits is nothing but the retention bonus. Like if I'm giving an opportunity to my employee, if you are with me for minimum period of 2 years, then I will give you a lump sum bonus. Then it will be considered as a retention bonus. Next is termination benefit. Exit at the time of retirement, it is payable, and the best example of the termination benefit is a VRS, that is nothing but the voluntary retirement scheme payment, and the pension is the best example of the post-employment benefit. Friends, please understand, we are not considering share-based payment. Means even if I discuss in a specific point, we are not considering ESOP in the Ind AS 19. Reason if I consider, under the world of accounting standard, friends, we have specific guidance note for accounting of the ESOP, But under the world of the Ind AS, friends, we have one specific Ind AS called the 102 share-based payment. So ESOP is never and ever considered. Clear? Now I am starting with the accounting of the short-term employee benefits. Friends, what is the meaning of the short-term employee benefits? If any benefit is to be payable within 12 months from the end of the reporting period, then it will be considered as a short-term employee benefit. Base example is salaries payable, bonus payable, wages payable. Even I am considering the short-term compensated absences. Short-term compensated absences, in a simple language, it will be considered as a leave encashment. Clear? Friends, please understand. Forget Ind AS 19. Just remember your office. What you are passing the entry for the salary expense. If the salary is paid, we are passing an entry salary expense account debit to bank account. If salary is payable, we are passing an entry salary expense account debit to salary payable account. It may be possible, my employee is in need of money. If my employee is in need of money, we are making the payment. We are even making the payment of the advance salary. In that situation, we are passing an entry that is called the advance salary account debit to bank account. Even short-term employee benefit expense is payable after 12 months. We are not doing the discounting, means we are not calculating any present value for that. Clear? Normally, every short-term employee benefit expense is charged to P&L. But yes, if specific Ind AS suggests some specific accounting treatment, then we should follow that accounting treatment only. I have a base example. That is nothing but Ind AS 16, property, plant and equipment. You know very well, we have learned one topic called the self-generated asset. Yes, we can record every self-generated asset in the books of accounts except the self-generated goodwill. What is the meaning of the self-generated asset? If any asset is created by in-house efforts, then it will be considered as a self-generated asset. If we are using any of our employee for the self-generated asset, then whatever we are making the payment in the form of the salary, wages or bonus, then it should not be charged to P&L. It should be capitalized with the cost of the fixed asset. Clear? So normally charged to P&L, but if some specific Ind AS suggests some specific accounting treatment, then we should follow that particular accounting treatment only. Clear? Next point if I discuss, friend, there is one topic and that is nothing but, just a minute. Okay. And that topic is nothing but the short-term compensated absences. Friends, please understand. Short-term compensated absences. In my simple language, it will be considered as a leave encashment. There are two types of the short-term compensated absences. One is nothing but it may be a wasted, and the second is nothing but it may be a unvested. Friends, what is the meaning of the wasted and the unvested? If your leaves are non-accumulating, then don't worry at all. But if your leaves are accumulating, and if you are making the payment of cash for the unused leave, then it will be considered as a vested absences. But if any leaves are accumulating and if any leave is not utilized, you are not making the payment of cash, but you are giving one more leave against the unutilized leave, then it will be considered as unvested short-term compensated absences. Again, I am repeating. Vested means you are receiving the cash for the leave, but the unvested means you are receiving the one more leave against unutilized leave. As per Ind AS 19, if it is a vested short-term compensated absences, friends, you should do the accounting at the, means 100% expense will be recorded in the books of accounts. But yes, whenever it is unvested, friends, you should consider the past experience of the employee. Why it is like that? Because in the vested short-term compensated absences, you are receiving the cash, and as a rational people, if you are thinking, if you are receiving the cash, no one will ignore it. Everyone will take it. That's why we are recording the 100% expenditure. But yes, whenever it's unvested absences, we are not receiving the cash, but we are receiving a one more extra leave. And that is totally depends on the nature of the employee. It may be possible your employee will utilize that leave, or it may be possible your employee is not utilizing that leave. Clear? Friends, then I am starting with the new topic that is called long-term employee benefit accounting and the post-employment benefit accounting. Friends, what is the meaning of the long-term first of all? If any benefit is payable after 12 months from the reporting date, then it will be considered as a long-term employee benefit. Or if any benefit is payable except at the time of the retirement, then it will be considered as a termination benefit. But if any benefit is payable after 12 months from the reporting date, then it will be, after the retirement, then it will be considered as a post-employment benefit. I have the best example. Friends, for the long-term employee benefit, I have the best example of the retention bonus. VRS payment is the best example of the termination benefit, and the pension is the best example of the post-employment benefit. Clear? Please understand. For long-term employee benefit, actually there are two types. That plan is maybe considered as a DCP, or that plan is maybe considered as a DBO. What is a DCP? It is nothing but the defined contribution plan. And what is the meaning of the DBO? It is considered as a defined benefit obligation. Now please understand about the defined contribution plan. Name clearly suggests that you have to just contribute a particular amount. And I am having the best example, and that example is nothing but the PF. Please understand. My salary of the employee is 100 rupees. Actually, I am deducting 12 rupees from him. And simple, I am giving just 88 rupees to my employee. This 12 rupees is not my profit. So I will deduct the salary of rupees 12, but that 12 rupees will be payable to the government. And I will add 12 rupees also. Once I have contributed into the PF trust, my responsibility is over. Clear? So simple, this is nothing but, please remember my one word. Defined contribution plans accounting is exactly similar to short-term employee benefits. Clear? Exactly similar to short-term employee benefits. Once you have contributed, you should pass an entry expense account debit to bank account. If it is a payable, then you should pass an entry expense account debit to payable account. If you have paid something extra amount, then it will be considered as a prepaid expense account debit to bank account. Clear? Obviously, that expense should be charged to P&L. But one more important thing is that in defined contribution plan, investment risk and actual risk is not of the employer, it is the risk of the employee. Means that what you are trying to convey is after some particular years, let's say my employee demand the rupees of the PF, then he will not demand the rupees of PF from me, but he will demand the rupees of provident fund from the trust. And if trust is not able to pay that rupees, then it is the responsibility of the trust. Then it is a matter between the employee and the trust. My responsibility is over. That's why once we have contributed, our responsibility is over. Perfect? Clear? Okay. And the next plan, actually there are three types of the defined contribution plan. State plan, multi-employer plan, and the insured benefit plan. State plan is basically governed by any of the central government or the state government or any of the local authority. Means it should be governed by the government. Multi-employer plan, name suggests that two or more employers will come together and make a private trust, and that will be covered by the two or more employer. But please remember my one line. If any two company is belonging from the one group, they cannot start their private trust, private PF trust. Clear? That it must be an unrelated party, then only they can start. And the last one is nothing but the insured benefit plan. Name is very clear. We are taking the insurance policy from the company for making the defined contribution plan. We will make contribution to the insurance company, and after some time interval, whenever my employee will demand, then he will not demand from me, he will demand directly from the insurance company. And it's a matter between the insurance company and the employee. Clear? This is the defined contribution plan. Now this is the most important. Defined benefit plan. Actually, I am committing to pay to my employee. I will pay to your last drawn salary into, let's say, 25% into completed year of services. This benefit is defined in advance. And if this benefit is defined in advance, let's assume I am estimating that I am able to pay 100 rupees. 100 rupees at the rate of the 25%, and let's say I am expecting that my employee will with me for 5 years. Can I say I have to pay rupees 125 rupees after 5 years? Don't you think so? This 125 rupees is not actually the expense of the 5th year. This is the expense for the all 5 years. And if this is the expense for all the 5 years, we have to record such expenses. Clear? For accounting of these expenses, friends, you have a two choice. You can take actuary report, or you can use the one method. That method name is nothing but the PUCM, projected unit credit method. If you are taking the actuary report, you have not to estimate. But if you are using the projected unit credit method, then you have to make the various estimates. First of all, if you consider this, from this three factor, only one factor is fixed, and that is nothing but the 25%. I don't know the last drawn salary, I don't know the completed year of services, and for that I have to make an estimate. And for that estimate, I will use the actuarial assumption. We will check the gender of the employee, we will check the marital status of the employee, we will check the health condition of the employee, we will check the industry growth rate and all. And after that, we will determine what is my last drawn salary and what is the completed year of services. Clear? Let's assume we have determined we have to pay rupees 125. After that, we will find out the unit. Unit is nothing but my total expenses divided by total number of years. Can I say I am liable to pay rupees 125 after 5 years? So 125 divided by 5, every year I have to provide expense of 25. But yes, this 125 is nothing but my future value. But can I say I am doing the accounting today? And whenever I am doing the accounting today, obviously friends, we should find out the present value. And obviously whenever we are finding the present value, we will use the discounting rate and we will find the present value, and whatever my present value will be considered as my current service cost. Please remember, this is not a normal discounting. It is a reverse discounting. If I check the conditions of the 5th year, it is very clear. If it is very clear, from the 5th year P&L, I will withdraw the fund and I will make the payment to the employee. So my discounting factor is exactly 1. Clear? But in the 4th year, I will take the amount from the P&L in the 4th year, but I will make the payment in the 5th year. So simply, I am making the payment after 1 year, and if I am making the payment after 1 year, so I will take the discounting rate for the 1st year. If I discuss for the 3rd year, I am taking the amount from the P&L in the 3rd year, but I am making the payment in the 5th year. And if I am making the payment in the 5th year, means I am making the payment after 2 years. And if I am making the payment after 2 years, I should use the discounting factor for the 2nd year. So please remember, it's not a normal discounting, it's a reverse discounting. After current service cost, at every year, we will use the unwinding of discount. And we will add interest expense every year, and finally at the 5th year, in this question, my balance should be 125. Clear? So simple. Okay, one more thing. What is the difference between the defined contribution plan and the defined benefit plan? In defined contribution plan, actual risk and investment risk is not of the employer. But in the defined benefit plan, actual risk and the investment risk is of the employer. Means after 5 years, if anyone demand the payment from me, it's my responsibility how to make the payment. Clear? Simply, if I'm not managed payment, then simply my employee will file the case against me in any of the court. Clear? Okay. So simple, under this type of benefits, employer is not required to make any of the contribution. These are the defined to employees and should be accounted in each year of services. This benefit should be accounted for using the projected unit credit method. This benefit should be accounted using the present value factor. Clear? Perfect? Okay. Friends, what assumptions we will use? We will use demographic assumptions that deals with such as mortality, rate of employee turnover, disability, early retirement, health, and etc. We will use the financial assumption like the discount rate, future salary, expected return on the plan assets, and etc. Clear? Now friends, this is the method how to calculate the expense for the defined benefit obligation that I have clearly explained. First of all, make a projection at an absolute amount. Clear? Then we will find out the unit expense. That is nothing but the total expense divided by number of years. Then we will find out the present value. After present value, we will recognize the liability. And after liability, we will recognize the interest cost, etc. Clear? Now please understand. This is a last drawn salary. This is a 25% and this is a completed year of services. Can I say this last drawn salary is completely assumption only? This completed year of service is again an assumption. And can I say my assumption is changing like anything? If my assumption is changing, one thing is very clear, my liability may be increased or my liabilities may be decreased. But don't you think so? This liability is increased or decreased is because of the wrong assumption. Again I am repeating. It's because of the wrong assumption. So what are the wrong assumptions? I am expecting that I am paying the 10% growth rate in salary. But due to the market reason, I have to pay the 15%. And if I am paying the 15% growth rate, obviously one thing is very clear, my last drawn salary will change. If my last drawn salary will change, my total expense will change, the entire calculation will be changed. And my liability is increasing. But can I say my liability is increasing because of the change in the actuarial assumption? And obviously, if your liability is increasing, don't you think so? It is a loss for you. And if it is a loss for you, then simply it will be considered as a actuarial loss. It will be considered as a actuarial loss. But yes, I am expecting for a growth rate of 10%. But as per the market conditions, if I am paying the 7% growth rate, then it will be okay. So can I say obviously my last drawn salary will be lower. If my last drawn salary will be lower, I have to make the lower payment. And simple, if I am making the lower payment, then it will be considered as actuarial gain. Means if your actuarial assumption is changing, and because of the change in actuarial assumption, if your liability is increasing or if your liability is decreasing, then it will be considered as an actuarial loss or the actuarial gain. And that actuarial loss or gain is directly recognized in OCI, other comprehensive income, for which reclassification to P&L is not possible. For which reclassification to P&L is not possible. Clear? Okay. Second thing. Don't you think so? This amount is payable after 5 years. No doubt you are recognizing the expense every year, But if you are failed to manage cash, then it is little bit difficult for you to make a payment after 5 years. Then what should you do? Actually, whatever amount you are debiting to the P&L, don't you think so that amount is invested at anywhere? So whenever you are making the payment, you have a one option. You can sell the asset, you can generate the fund, and from that fund, you can make the payment to the employees. So simple. There are two types of obligation. One obligation is considered as a funded obligation and second obligation is considered as a non-funded obligation. If your obligation is supported by some fund, then it will be considered as a funded obligation. But if your fund is supported, if your obligation is supported by not any of the fund, then it will be considered as a non-funded obligation. From my line, it is very clear whether you have to make an investment or not. It's a completely choice of the entity. It's not a mandatory. If you want to make an investment for the safer side, you can do. But you want to take a risk, you can. Don't worry at all. So simple, investment is not mandatory. But if you ask me, it is an advisable. If you are making an investment in a safe securities like a bank FD and whatever government securities, so simply, whenever this amount is payable after 5 years or 7 years or the 10 years or the 15 years, you have that asset. You can realize the fund from that asset and it will be great benefit to the entity. So simple, it's an advisable. Clear? So entity can provide for the funds for the requirement of the present value of the DBU. In case funds being accumulated, then it is called the funded obligation. Simple, this is not mandatory under accounting standard 15 and under accounting standard 19 only. Whatever you are making the payment, whatever you are making an investment, that actually investment is not considered as an investment. It will be considered as a plan asset. So your balance sheet will be like this. Here you will disclose one liability in the name of the defined benefit obligation. Let's say that liability is nothing but the 150. If investment is not mandatory, then how much amount should invest? That is again not mandatory. It is not like that if I am debiting my P&L by rupees 150, I have to make the contribution of rupees 150 to the plan asset. I can do one thing, that is nothing but I am just investing 100 rupees. But whatever your investment, this is not called as an investment, this is called as a plan asset. And a plan asset is actually not disclosed on the balance sheet asset side. It is deducted from the balance of the defined benefit obligation and you will disclose the net liability of rupees 50. Logic is that if you are making an investment for the payment of the defined benefit obligation, it should be clearly mentioned on the face of the balance sheet that your stakeholder will think that you are just liable to pay rupees 50. 100 rupees is don't worry, we will sell the investment, we are generating the fund and we will make the payment of the defined benefit obligation. Clear? Next question, that is nothing but whenever you are making the investment in the plan asset, first of all, friends, you should consider the expected return. You should consider the expected return. Clear? This is considered as an expected return. Let's say I am investing in any of the fund and I am expecting the return of the 10%. But please understand, how to calculate expected return for academic purpose. We are taking basically three assumptions. Number one, contribution and the benefits payment are making exit in the middle of the year if nothing is given. Number two, given the rate is always an effective rate of return. And from that effective rate of return, we are calculating the normal rate of return. And the number three, compounding is for the 2 times. Means we are getting the interest payment at every 6 months, means my compounding is for the 2 times. Again, I am repeating. That is nothing but the contribution and the benefits payment are exactly in the middle of the year. If in the question they are giving the specific information, then you should use the specific information. Number two, given the rate is an effective rate of return and from that effective rate of return, we will calculate the normal rate of return. And the number three, that is nothing but the compounding is for the 2 times. From this expected return, now we will calculate the actual return. There are 3 possibilities. If my expected is 10 and I am actually getting 10, so don't worry. But if I am expecting 10 but I am receiving just 8%, don't you think so? If you are expecting the 10% but if you are receiving just the 8%, means your expectation is wrong. And if your expectation is wrong, you are receiving the less amount because of the wrong actuarial assumption. This is a loss for you, but this loss is generated because of the wrong actuarial assumption. So simply, it will be considered as an actuarial loss. If my expected return is 10%, but it may be possible in the current year I am receiving the 12%. So can I say, don't you think so? I am receiving little bit extra amount. And if I am receiving the little bit extra amount, then simply it will be considered as an actual gain. Please remember, we are receiving the actual gain or loss on the balance of the defined benefit obligation also and on the plan asset also. Clear? If liability is increasing, then actual loss, liability decreasing, actual gain, plan asset increasing, actual gain, plan asset decreasing, actual loss. If you are setting off the balance of the DBO with the balance of the plan asset, so obviously whatever the actual gain or loss on the defined benefit obligation is netted off with the balance of the actual gain or loss on the plan asset, and the net actual gain or loss is transferred to OCI, for which reclassification to P&L is not possible. Second thing, on the balance of defined benefit obligation, we are recognizing interest expense. So on the balance of the plan asset, we are recognizing the interest income. If in balance sheet, if we are setting up the balance of the defined benefit obligation with the plan asset, so obviously in the statement of profit and loss, we should set off interest expense with the interest income. Clear? Perfect. This is all about expected return. Sometimes we are doing the curtailment in the settlement. Means we are giving the top level management benefit, some middle level management benefit, and some bottom level. But due to our financial condition, we are not now giving the benefit to the bottom level management. This is called the curtailment in the settlement. Obviously, due to curtailment and settlement, you are having the gain. That gain is because of the rather three things. One is nothing but any change in the present value of the DBO, any change in the fair value of the plan asset, and the unamortized past service cost. Clear? So this was all about Ind AS 19 employee benefit. Now we are starting with Ind AS 20, that is accounting for the government grant and the disclosure of government assistance. Please remember what I am trying to convey here. We have one specific accounting standard that is called the Accounting Standard 12. And the name of Accounting Standard 12 is nothing but the accounting for the government grant only. In this Ind AS, we will not just discuss for the government grant, but we will also discuss the government assistance. Please keep one thing in your mind. For government grant, you should do the accounting. But for government assistance, accounting is not required, just a disclosure is enough. So before starting the Ind AS, you should consider that what is the basic difference between the grant and the assistance. Whenever I am using the word grant, that value is readily measurable in the money, is easily measurable in the money. But whenever I am using the word assistance, it is a help by the government, but the value of such help I cannot measure in terms of money. And if you are not measuring that amount, then obviously accounting is not possible. You should do just disclosure only. Just a disclosure only. Clear? So first of all, we are discussing the meaning of the government. Government includes central government, state government, local authority, national body, and the international body. Clear? Again, I am repeating: central, state, local authority, national, and the international body. Then we should consider what is the meaning of the grant. But before grant, I should tell you. Let's discuss the exemption later on. Grant matlab what? Grant is nothing but anything received either in a cash or a kind. For what? It may be possible if you have fulfilled some past condition, or if you are expecting to fulfill some future condition. And the value of that grant is easily measurable in terms of money. Again, I am repeating, what is the meaning of the grant? Grant is nothing but anything received either in a cash or in a kind. For what? It may be possible if you have fulfilled some past condition, or if you are expecting to fulfill some future condition, and the value of such grant is easily measurable in terms of money. Clear? That is called the grant. But yes, friends, if you are receiving any tax exemption or any tax deduction or any of the tax holiday, or any government participation, or any of the government grant which is covered under the Ind AS 41, that is called agriculture, then simply Ind AS 20 is not applicable. Sir, can you give an example for the tax exemption? Yes. If you are receiving any exemption under section 10 to 13 of the Income Tax Act 1961, or if you are receiving any deduction under section 80C to 80U of the Income Tax Act 1961, or if you are receiving any tax holiday period like 80IA, 80IB, IC under the Income Tax Act 1961, then simply it will not be considered as a government grant. Government participation means my company is nothing but the ABC, and the central government is investing some, let's say 25% in my company, then it is called the government participation. That government participation is again not considered as a government grant. And yes, there is some specific accounting treatment for the government grant for the agriculture activity, and that treatment we will cover in Ind AS 21. And friends, believe me, in the November 19 paper, they've asked one question, merging of the Ind AS 20 with Ind AS 41. So if this non-applicability point is clear with you, then only you had appeared this question. Otherwise, you should ignore that question. Clear? After that definition and non-applicability and the definition of the grant also, we have to check how can we recognize the grant in our books of accounts. In every Ind AS, there are some recognition criteria. And which are that recognition criteria? We can recognize the government grant in our books of accounts only and only if we are fulfilling two conditions. Number one, the collection of the grant is certain. The collection of the grant is certain. And the number two, it is expected that we will fulfill the future condition, future attached condition with the grant. Whenever I am using the word, the collection of the grant is certain, please friends concentrate here. If government has sanctioned 10 lakh rupees of grant, but out of 10 lakh, they have just disbursed 3 lakh rupees. In that situation, we will not recognize the government grant of rupees 3 lakh only, we will recognize the government grant of 10 lakh. Because friends, we are following the accrual concept. And as per the accrual concept, this grant is certain, and if this grant is certain, we should recognize the entire grant of rupees 10 lakh in the books of accounts. Clear? Second thing. It is expected that you will fulfill the future conditions. Friends, only one condition is not that. If you are fulfilling all the two conditions, then only you can recognize the grant in the books of accounts. Clear? Now I am starting with the accounting part. You know very well, there are two types of grant. One is nothing but the non-monetary grant, and second is nothing but the monetary grant. Non-monetary means something you are receiving in kind. But the monetary means something you are receiving in cash. I want to explain total 10 types of grant for accounting purpose. First of all, we are discussing about the non-monetary grant, and that non-monetary grant is specifically for the non-depreciable asset. Means you are receiving some portion of land at a free of cost. And if you are receiving some portion of land at a free of cost, can I say you should recognize that land in our books of accounts? We will pass an entry. Land account debit. 2. Deferred government grant. Clear? Now the problem is, what is the amount? You can select the option of the fair value, and after amendment you have a second option, and that option is nothing but you can recognize this grant as a nominal amount also. But if you ask me, it's advisable to follow the fair value. Now one problem is that when any amount is transferred into the deferred government grant, that balance will not be as it is for the lifetime. We have to transfer the amount from the deferred government grant to the P&L every year. But sir, we know very well, under accounting standard 12, we are also using this particular concept. But whenever any amount was transferred to the deferred government grant, that amount is transferred to P&L in the ratio of the depreciation. But sir, this asset is a non-depreciable asset. Then in which ratio we should transfer that amount? Logic is very clear. If it is a depreciable asset, then in the ratio of the depreciation. But if it is a non-depreciable asset, the amount of the deferred government grant should be transferred to P&L in the ratio of future expenses. So what you are trying to convey? Obviously, you are receiving the grant with some future condition. Can I say for fulfillment of that future condition, you have to incur some expense in the future. So whatever the balance of DGG, that is called the deferred government grant, is transferred to P&L in the ratio of that future expenses. Can I go ahead? Next. For a depreciable asset, again I am discussing the non-monetary grant only. Whenever it's a depreciable asset, we will pass an entry property, plant and account debit, property, plant and equipment account debit to deferred government grant. Obviously that deferred government grant is transferred to P&L. But can I say this is a depreciable asset? And if this is a depreciable asset, then it should be transferred in the ratio of the depreciation. For a non-monetary grant for the revenue purpose, means our routine activities, our routine items we are receiving in kind. Simple. In that situation, we will pass an entry, inventory account debit to P&L. Please understand. Here it is deferred government grant. Here it's deferred government grant, but here it's not a deferred government grant, it's a P&L. Clear? Now, I am starting with the monetary grant. Friends, whenever you are receiving any monetary grant for the non-depreciable asset, after amendment, you have two options. You can adjust that amount of the grant with the balance of the asset, or you can transfer the amount of the grant in the deferred government grant. Means we will pass an entry, bank account debit to deferred government grant, or if we want to deduct from the cost of the asset, then to land account. Clear? If it is for the depreciable asset, then again we have two options. The amount of the grant is deducted from the cost of the asset, or we can transfer into the deferred government grant. So bank account debit to deferred government grant or the property, plant and equipment. Obviously depreciation in the both situation, it will be different. For revenue purpose, again you have two options. You can adjust the amount of the grant with the balance of expenses, or you can transfer to the P&L. So we will pass an entry, bank account debit to P&L or the expense account. Clear? Now the most important point, please understand. Any amount is transferred in the deferred government grant is recognized as an income by using a systematic and the reasonable basis. Clear? But if you are receiving any of the grant in a two situation, if you have fulfilled the past condition, or you are receiving the grant without any of the condition, then amount of the grant is immediately credited to P&L, whether it is for asset or for the revenue purpose or whatever. If you are receiving any of the grant without any purpose, then it should be transferred to P&L. Don't worry at all. Clear? Problem is for the deferred government grant, I already explained you. If it is a transfer to the deferred government grant, then it should be transferred to P&L in the ratio of the depreciation if it is a depreciable asset, and in the other case it will be transferred to P&L in the ratio of the future expenses. Clear? Okay. 6 types grant is done. With 6, number 1, non-monetary, total 3 grant, depreciable, non-depreciable revenue. Monetary, again 3 grant, depreciable, non-depreciable revenue. 6 done. 7th. If you are receiving any of the grant for establishing the business in a backward area, if it is a without any condition, then simply it is transferred to P&L, bank account debit to P&L. But if it is a with any condition, then it should be transferred to bank account debit to deferred government grant. If you are receiving any forgivable loan, means you are receiving the loan but you are not making the repayment, simply it will be gain, it will be transferred to P&L. Clear? But one more example, please understand. If you are receiving any of the loan at concessional rate of interest, if you are receiving any of the loan at a concessional rate of interest, then friends, simple, it is our financial liability as per Ind AS 109, and we have to follow the amortized cost concept for accounting of that. We have to follow the amortized cost concept. Clear? Now I am starting the point that is called the refund of the grant. Please remember my one line. At the time of the receipt of the grant, whatever account was credited, at the time of the refund of the grant, same account is debited. Again I am repeating. At the time of the receipt of the grant, whatever account was credited, so at the time of the refund of the grant, that account is debited. There is only one problem. If I am receiving, I am purchasing the asset of ₹100, but I am receiving the grant of ₹20 and I am selecting the option of the deferred government grant. Let's assume this is a depreciable asset. The life of the asset is 10 years, so every year we will provide the depreciation of ₹10. Total for the 3 years we have provided the depreciation of ₹30. So now the total is 70. The balance of the deferred government grant is nothing but the 20. If we are transferring the amount to the P&L, every year it's a ₹2. So for total 6, and then now the balance is nothing but the ₹14. Is it okay? I explained you at the time of the receipt of the grant, I have credited the deferred government grant account. So at the time of the refund of the grant, I have to debit the deferred government grant account. But can I say now I have just the balance of the deferred government grant is just ₹14. But actually I am liable to pay ₹20 entirely. So what I will pass an entry, deferred government grant account debit ₹14, P&L account debit ₹6 to bank account ₹20. Clear? Second thing. This was not there in accounting standard 12, but under Ind AS 20 they have clearly mentioned you. Whenever you are purchasing an asset, can I say this is nothing but an outflow? But that outflow will be considered from the investing activity as per Ind AS 7 statement of cash flow. But whenever you are receiving any grant for the purchase of the asset, don't worry, it will be considered as an inflow. And that inflow is considered from the financing activity. Let's assume I am purchasing the asset of rupees 100 and I am receiving the grant of rupees 30. I cannot set off with each other. I have to disclose the outflow from the investing activity of rupees 100 and the inflow from the financing activity of rupees 30. I cannot set off to each other. Clear? These are the disclosure not required at all. So finally my Ind AS 20 is also done. Clear? Next. Ind AS 21, that is effects of changes in foreign exchange rate. One of my favorite Ind AS. Number of students are confused here. Friends, under the world of accounting standard, we have accounting standard 11. But if you ask me, accounting standard 11 was very easy. Because under accounting standard 11, there was no concept of the functional currency. Now we are having only one concept, that is nothing but the foreign currency only. If I discuss the scope of Ind AS 21, basically in this particular Ind AS, we are covering three things. First of all, we will learn accounting of the foreign exchange transaction. Accounting of the foreign exchange transaction except derivative transaction. Because friends, you know very well, derivative transaction is covered under the chapter of the financial instrument. So it is not covered here. Second thing, translating the results and financial position of the foreign operation and translating the entity's results and the financial position into the presentation currency. Number of students are confused in point number 2 and the point number 3. Friends, point number 2 is talking about if I am in India, if I am having the branch, subsidiary, associate or joint venture, let's say in the US, problem is that I am preparing my standalone financial statement, let's say it's for Indian rupees. My US branch, subsidiary, associate or joint venture are preparing their standalone financial statement in the US dollar. But in India, I want to prepare the consolidated financial statement. The problem is that my transactions are in Indian rupees, but transaction of the subsidiary, associate or the joint venture means transaction of the foreign operation are in the US dollar. So now what I will do, I will demand the trial balance from my foreign operation. They will make a trial balance in the US dollar and I will convert their entire trial balance into Indian rupees. This is called translation of the financial performance and the financial position of the foreign operation. But whenever I am talking about the point number 3, when my functional currency, it's let's say dollar, I am in India, can I say I have to make the financial statement in the Indian rupees only? I will prepare my books of accounts in dollar, but whenever I am presenting my financial statement, it should be in the Indian rupees. So in the point number 3, we are converting our own financial statement from the functional currency to the presentation currency. Clear? But first of all, you should understand that under Ind AS, they are talking about 3 currency. One is functional currency, second is the foreign currency, and third is the presentation currency. Why this 3 type of currency? As per Ind AS 21, every transaction initially recorded in the functional currency only. And the number of students are thinking that for every Indian company, their functional currency is the Indian rupees only. It's not like that. Your functional currencies maybe are different from the Indian rupees. Let's assume, what is the meaning of the functional currency? Friends, functional currency is the currency of the primary economic environment in which your business is operating. Normally, it is the currency in which you are generating the cash from the market and you are doing the expenditure in that currency only. No doubt, for 90% Indian companies, it may be possible their functional currency is the Indian rupees, but it is not a thumb rule. There are some factors how to determine the functional currency. I will discuss that factor, then you will get the better clarity. Other than functional currency, everything will be considered as a foreign currency. And the presentation currency is actually the currency in which your financial statement are presented. I already explained you. You should determine the functional currency by using some factors. I am discussing that factors. And let's assume by following that factor, I am determining my functional currency is a dollar. No doubt I am in India. Still my functional currency is a dollar. Other than dollar, friends, everything is considered as a foreign currency. So no doubt I am in India. If I am determining my functional currency is a dollar, So if dollar is a functional currency, rupees will be considered as a foreign currency. And you know very well, in India, we have to present the financial statement into the Indian rupees only. It may be also possible, your functional currency is a rupees. Then in that situation, if dollar is nothing but your foreign currency, and if you are in India, then simply you have to present the transaction into the rupees only. I want to speak one line. Functional currency and the presentation currency may be the same currency. Foreign currency and the presentation currencies may be the same currency, but the functional and the foreign currency is never and ever similar. Because the definition of foreign currency is like this: other than functional currency, everything is considered as a foreign currency. So it is not like labor equal. Clear? Now, we are determining how to determine the functional currency. Friends, there are two primary factors, there are two secondary factors. If I discuss the primary factor, the currency in which your sale is denominated, it is not determined, it is a denominated. And the second is nothing but your purchases, expenses are the denominated or the determined. This is the currency. Clear? And the secondary factor is that, if I discuss secondary factor, the currency in which your funds are raised, whenever I am using the funds, I am talking about the debt or equity, and the currency in which your earnings are retained. Again, I am repeating, there are two primary factors. First, currency in which your sale is denominated, and number two, currency in which your purchases or expenses are the denominated or the determined. Number two, secondary factors we will check, that is currency in which we are raising our fund, and whenever I am using the word fund, means I am talking about the debt or the equity. And the number two, currency in which actually our earnings are retained. Obviously, our first priority is with primary factor, and our second priority is with the secondary factors. These are the factors for determination of the functional currency of any of the entity. But now please remember, if you are having some foreign operation, then how to determine the functional currency of that foreign operation, that I am trying to discuss you. For determination of the functional currency of the foreign operation, friends, please remember, there are some specific factors they are given, and which are that factors if I discuss. So friends, first of all, you should check the design of the foreign operation. You should check the design of the foreign operation. What is the design of the foreign operation? If your foreign operation is just an extension of the reporting entity, then the functional currency of the foreign operation will be the, functional currency of the reporting entity will be the functional currency of the foreign operation. Clear? But yes, friends, please remember, if my foreign operation is working independently, then simply by using the primary and the secondary factor, we have to determine the functional currency of the foreign operation. Number two, we will check the proportion of transactions between the foreign operation and the reporting entity. If the proportion of the transaction between the reporting entity and the foreign operation is high, then I can say that the functional currency of the reporting entity will be the functional currency of the foreign operation. But if the transaction proportion is very low, then we have to separately determine the functional currency of the foreign operation by using the primary and the secondary factors. Clear? Number third, we will check, is there any direct connection of the cash flows of the foreign operation with the cash flows of the reporting entity? If yes, if my answer is yes, then I can tell you, simple, the functional currency of the reporting entity will be the functional currency of the foreign operation. But if there is no direct connection between the cash flows of the reporting entity with the cash flows of the foreign operation, then yes, we will separately determine the functional currency of the foreign operation by using the primary and the secondary factor. Number four, we will check whether our cash flows are actually sufficient, rather whether the cash flows of the foreign operation is actually sufficient to meet its own expenses and the obligation. If answer is yes, then we will separately determine the functional currency of the foreign operation by using the primary and the secondary factor. But if answer is no, then simple, functional currency of the reporting entity will be the functional currency of the foreign operation. Clear? Simple, we have one example. Entity A operates is actually oil refinery in the Saudi Arabia. Entity's income is denominated and settled in US dollar. My first primary factor answer is dollar. Oil price is subject to worldwide supply and the demand. Crude oil is routinely traded in the US dollar around the world. Around 45% of the entity's cash costs are imports and the expiring salary denominated in US dollar, means again my expenses proportion is dollar. Remaining are incurred in the Saudi Arabia and denominated and settled in Riyal. Non-cash costs obviously in the US dollar, we have made an investment, means funds are written in US dollar. Simply by using the primary and the secondary factor, I can tell you my functional currency is a dollar. Let's assume this company is an Indian company. If their functional currency is US dollar, initially they will record the entire transaction in the dollar. Other than dollar, everything will be the foreign currency. And obviously in India, we have to present our financial statement into the Indian rupees only. Clear? Okay. Now I am starting this particular point. This point we have already covered. Okay. Now, recognition of transaction. Friends, every foreign currency transaction is initially recorded in the functional currency at the transaction date at a spot rate. Means it may be possible I am in India, my functional currency is a dollar. I will record entire transaction first of all in dollar. That is considered as I am preparing my books of accounts in dollar. Is it okay? On balance sheet date, means on the reporting date. If there is any non-monetary item which is carried at a historical cost, should be continued at a historical cost. So can you give an example? Yes. Property, plant and equipment is recorded at historical cost, so it will be continued at historical cost. If there is any non-monetary item which is carried at a fair value, will be continued at a fair value on the reporting date. But this most important line, if there is any monetary item, and that monetary item should be converted at a closing rate. Now you have to understand what is the meaning of the foreign currency monetary item. Foreign currency monetary item is nothing but any asset or liability which is to be received or paid in a fixed or the determinable amount of currency. If I can take an example, debtor, creditor, bill receivable, bills payable, loan and the borrowing. Now please understand what I am trying to convey. If you have let's assume your functional currency is a rupees, means you have recorded transaction in the rupees. But on 1st January, you are entering into one transaction that is nothing but for the purchase, and you have purchased the goods worth $1, and at that time the rupees is nothing but the 70. And you have to make a payment after 6 months, 1st July. Whenever we are making the payment, let's assume your rate is nothing but the 75. But can I say in this between, we have 31st March, and in our balance sheet there is a one liability in the name of the creditor that is considered as a foreign currency monetary item, and that foreign currency monetary item is converted at the closing rate, and let's say on this date my rate is 73. So friends, you have recorded initially transaction at 70, but on 31st March you have to convert at a closing rates. Now your answer is nothing but the 73. So can I say 3 rupees will be considered as a foreign exchange loss, and this 3 rupees is considered as a foreign exchange loss because of the conversion of the foreign currency monetary item. Because of the conversion of the foreign currency monetary item. Clear? Okay. And if we are making the payment from the 73 to 75, then simple. Again, it is a loss of rupees 2. And again, if it is a loss of rupees 2, simply friends, please remember, this is a foreign exchange loss because of the settlement of the foreign currency monetary item. Means your foreign exchange loss or gain is because of the two reasons. One is conversion of the foreign currency monetary item, and second is nothing but the settlement of the foreign currency monetary item. As per Ind AS 21, whatever the foreign exchange gain or loss is directly transferred to P&L. Directly transferred to P&L. Clear? Perfect. I will take this on the last stage. Now, most important portion I am starting. I am merging Accounting Standard 11, Ind AS 21 and the Ind AS 101. You know very well, under the Accounting Standard 11, there was a topic called Para 46 or 46A of Accounting Standard 11. And what was that para? And for that, we have to go into history. Friends, before 2016, we have Companies Act 1956. And under Companies Act 1956, we have Schedule 6, and against that we have Accounting Standard. If there is any contradiction between the Accounting Standard and the Schedule 6, and at that time, Schedule 6 prevails the Accounting Standard, means we have to follow Schedule 6. Today, it's a little bit reverse situation. Today, if there is any contradiction between the Companies Act 2013 and the Ind AS, then my Ind AS prevails on Companies Act 2013, and we have to follow Ind AS only. Problem is that as per the Schedule 6, if you are having any foreign currency loan for the purchase of the fixed asset, then whatever the gain or loss should not be transferred to P&L, that gain or loss should be transferred to the fixed asset. But at that time, as per Accounting Standard 11, foreign exchange gain or loss should be transferred to P&L. So can I say this is a contradiction? And if this is a contradiction, rule is that my Schedule 6 prevails accounting standard. So this is an hero and we have to follow the accounting treatment mentioned by Schedule 6. But suddenly, on 7th December 2006, NACAS has issued one notification. NACAS has issued one notification, and as per that notification, now every company have to follow accounting standard 11 and not Schedule 6. Means now, as per the NACAS notification, if you are having any foreign currency borrowing, then that whatever the gain or loss should not be transferred to the fixed asset. Whatever the gain or loss should be transferred to the P&L. Is it okay? Problem is very clear. In the year 2007-8, my dollar rate is reduced from 50 to 38. And if dollar rate is reduced from 50 to 38, if you are having the foreign currency borrowing, can I say you have a gain, foreign exchange gain? And if you are following the respecting the NACAS, as per NACAS notification, that gain should be transferred to P&L. Is it okay? But the days of life is not same. Suddenly in the year 2008-2009, my dollar rate is increased from 38 to 52. And now if it is increased to 38 to 52, we are having the foreign exchange loss. And if we are having the foreign exchange loss and if we are following the NACAS notification, can I say this foreign exchange loss should be transferred to P&L? And if this foreign exchange loss should be transferred to P&L, friends, believe me, Reliance Industries Limited has reported a loss of rupees 3,200 crore. Reliance Communication is directly converted from the profit into the loss. If Reliance is not debiting this loss into the P&L, their profit may be at that time it's 4,800 crore. But clear? So people think that NACAS is just a body. And in today's scenario, we will not follow NACAS. Now there is a question mark on the existence of the NACAS. So NACAS is angry. When it was the foreign exchange gain, people are respecting me and they are crediting their foreign exchange gain into the P&L. But when it's a foreign exchange loss, people are ignoring me. And now they are not debiting that foreign exchange loss into the P&L. And they said, who is NACAS? So NACAS has retrospectively introduced Para 46 or 46A officially in accounting standard on 31st March 2009. When that para was introduced, that para had a shelf life up to 31st March 11, means benefit is given up to 31st March 11. Then on 31st March 11, benefit is given up to 31st March 12. Then on 29 December 11, they've again opened the door and the benefit is given up to 31st March 20. Obviously, if NACAS is introducing, this was only applicable to companies. No doubt afterwards, ICAI has introduced the same paragraph and now it's applicable to all entities. But remember that Para 46 or 46A is only and only applicable to long-term foreign currency monetary item. And now problem is that, what is the meaning of the long-term foreign currency monetary item? Long-term foreign currency monetary item is nothing but whose settlement is beyond 12 months. Second most important thing is that this para, when introduced, it was an optional. It's not a mandatory. Means if you want to follow para 46 or 46A, you can. But if you don't want to follow, just transfer whatever the foreign exchange gain or the loss, that amount should be transferred into the P&L. Problem is very clear. And there are two options given. If you are having any foreign currency monetary item related to purchase of the fixed asset, rather related to purchase of the depreciable fixed asset, then loss or gain should not be transferred to P&L. That loss or gain should be transferred to the carrying amount of the property, plant and equipment. Obviously, whenever it was a loss, it should be added in the cost of the asset. But whenever it's a gain, it should be deducted from the carrying amount of the asset. That's why I have clearly written you, capitalization can be negative. And you should provide depreciation with a prospective effect and not with the retrospective effect. But if you are having the foreign currency borrowing, but if that foreign currency monetary item is not related to purchase of the fixed asset, then you have to transfer the gain or loss into the FCMITDA. And full form of FCMITDA is foreign currency monetary item translation difference account. This was in accounting standard and not in the Ind AS. But can I say, friends, you know very well they are giving the benefit up to 31st March 20, and suddenly in between we are came up with the Ind AS. So what should the accounting treatment in Ind AS? You know very well under Ind AS 21, whatever the foreign exchange gain or loss is immediately charged to statement of profit and loss. Whether it's a long term, short term, notional, actual, and whatever the amount is transferred to P&L. And that's why we need to approach Ind AS 101. That is called the first time adoption of Ind AS. And as per Ind AS 101, rule is very clear. If before adoption of Ind AS, if you had followed para 46 or 46A, then on that particular borrowing, you can continue with the para 46 or 46A. Again, I am repeating. Before adoption of Ind AS, if you had followed the para 46 or 46A, then on that particular borrowing, you can continue with the para 46 or 46A. Otherwise, on the new borrowing, benefit is not available. You can, means it's not a mandatory. If you want to continue with para 46 or 46A, then you can. Otherwise, whatever the balance is lying in the FCMITDA is directly transferred to retained earning. Clear? So simple. A first time adopter may continue with the policy adopted for accounting for the exchange differences arising from the translation of the long term foreign currency monetary item recognized in financial statement for the period ending immediately before the beginning of the first Ind AS reporting period as per the previous year. Clear? Friends, please understand. If loan was sanctioned before adoption of Ind AS, but loan is receiving after adoption of Ind AS, then again the benefit of the para 46 is not available with you. Next most important thing is that under the world of accounting standard 11, there was no concept of the functional currency. Means, can I say in that situation my dollar is a foreign currency? I have taken the long term borrowing, that's why I am following the para 46 or 46A. But now in Ind AS 21, it may be possible dollar is not now my functional currency, dollar is not now my foreign currency, but dollar is a functional currency. And if you are doing a transaction in the functional currency, then there is a no foreign exchange gain or loss. Problem is that before adoption of Ind AS, dollar was the foreign currency, and that's why you are having the foreign exchange loss or gain. But after adoption of Ind AS, dollar is now your functional currency, so there is a no foreign exchange gain or loss. So before adoption of Ind AS, if you had applied the para 46 or 46A on such dollar borrowing, that para 46 or 46A cannot be continued on that particular method. Clear? Can I go ahead? Perfect. Okay. Next point, I have an example. ABC Limited applied Ind AS voluntary from the 1st April 15. So its transition date is 1st April 14. They are having the two loan. It had taken a foreign currency loan of euro 300 for working capital. They have applied para 46 of accounting standard 11, repayable after 3 years. Today the balance is nothing but lying is 40 rupees credit balance, and the next foreign exchange gain is 20. So okay, you can continue with the FCMI TDA balance, don't worry at all, because this loan was taken before adoption of Ind AS. But now you are taking a one new loan on 1st April 15 for the purchase of the plant of euro 120. On that date, the rate was 100 and the closing it's a 110. So per euro, my 10 rupees is increasing. So my total foreign exchange loss is nothing but the 1200 rupees. And if my total foreign exchange loss is nothing but the 1200 rupees, entire foreign exchange loss should be immediately charged to P&L. You are not having the balance of, you cannot use the balance of the foreign exchange, you cannot use the para 46 or 46A. Clear? Now I am starting two combined topic. One is nothing but the translation of the foreign operation, and second is nothing but the translation of the entity's financial statement from the functional currency to presentation currency. You are having trial balance and you have to convert in one currency. If it is asset or liability, then it will be converted at a closing rate. Income and expenditure, average rate. Sometimes they are not giving the income and expenditure, they are directly given the profit for the year. And if they are directly given the profit for the year, then again it's an average rate. Clear? If it's a retained earning or the share capital, it may be possible in the question it's a pre-populated, means it's a pre-calculated or not given, then simply you should consider the date on which your control is obtained. And if there is an intergroup transaction, then it's an actual debt because you have to eliminate. Obviously, after conversion of trial balance, if you check the total, your total will not be matched. So whatever the balance, whatever the foreign exchange gain or loss, it is considered as a balance of the FCTR, foreign currency translation reserve. It should be transferred into the OCI, and for which reclassification to P&L is possible at the time of the disposal of the foreign operation. Clear? Friends, if original thing is recorded in OCI, its foreign exchange loss or gain is also recognized in OCI. Let's assume I have purchased one asset on the 1st January of $100 and the rate is 70. That's why we have recorded the property, plant and equipment of 7,000. For subsequent measurement of the property, plant and equipment, we are using the revaluation model. And now the fair value of this asset is $120. But on 31st March, my rate is nothing but the 75. So 120 into 75, it's nothing but the 9,000. Is it okay? So obviously I have to increase the value of the asset by rupees 2,000. But don't you think so? Actually this 2,000 is increased because of the two factor. One is nothing but my fair value of the asset is increasing from $100 to $120. And the second is nothing but my foreign exchange rate is increasing from 70 to 75. But don't worry. Can I say this gain is transferred into the revaluation reserve? And the revaluation reserve is recognized in OCI. And if the revaluation reserve is recognized in OCI, obviously foreign exchange gain or loss is also recognized in OCI. Clear? Now I am starting the Ind AS 21 applicability in the consolidated financial statement. Please remember my one line. If any amount payable or receivable within the group, whenever we are preparing the consolidated financial statement, then all amount are eliminated. But if we are not entering into the transaction in our functional currency, then it may be possible in the financial statement of the parent or in the financial statement of the subsidiary, associate or joint venture, there is some foreign exchange gain or loss. Payable or receivable will be set off to each other. But whatever the foreign exchange gain or loss, that foreign exchange gain or loss will be continued in the consolidated financial statement also. That keep in mind. Number two, if holding company is giving some loan to the subsidiary and there is no repayment plan in the foreseeable future, then if I am following the concept of the substance over form, one thing is very clear. It is nothing but the investment by a holding into the subsidiary. And if it is an investment by a holding into the subsidiary, obviously the receivable or the payable will be set off to each other. But yes, if you are not entering into the transaction in your functional currency, then it may be possible there is some foreign exchange gain or loss in the financial statement of the parent or the subsidiary, associate or joint venture. That is recognized in the P&L whenever you are preparing the standalone financial statement. But that will be considered as the foreign exchange operation gain or loss. So simple, at the time of the preparation of the CFS, it will be recognized in OCA. Again, I am repeating. If it's a generally repayable planned in the future, then foreign exchange gain or loss is recognized in P&L in SFS and the CFS both. But if the repayment is not planned in the future, then foreign exchange gain or loss is recognized in P&L in the standalone financial statement. But in CFS, it will be recognized in OCA. Clear? This is the topic. Perfect. So simply my Ind AS 21 done, but before Ind AS 21 is done, I want to clarify that normally all foreign exchange gain or loss is recognized in P&L, but the problem is that there are 3 to 4 losses which are not recognizing in P&L. Number one, if you are already adopting the para 46 or 46A. Second thing, if it original thing is in OCI, then the gain or loss should also be recognized in OCI. Or if it is a part of the net investment in the foreign operation, in this situation, your foreign exchange gain or loss should not be recognized in P&L. It should be recognized in OCA. Clear? Now we are starting Ind AS 23 borrowing cost. Under the world of accounting standard 16, there was a borrowing cost only. First of all, you should understand the meaning of the borrowing cost. Number one, interest expense. But friends, please understand, here we are considering the interest expense by using the effective interest rate. Means friends, if you are taking the loan of rupees 100 at the rate of the 10% for 3 years, and for that you are incurring the processing charges of rupees 5, then simply I can tell you, your effective rate of interest is not 10%, your effective interest rate will be little bit higher. And for that, we have to determine the effective interest rate by using the trial and error method. This is my year 1 to 3. In the first year as an entity, my cash outflow is of rupees 10, that is of the interest. For the second year, it's 10. And the third year, it's 110. We will assume the discounting factor and we will find out the present value. And I need present value is 95. Why it's 95? Because today you are taking a loan of rupees 100. But for loan of rupees 100, you are incurring the processing charges of rupees 5. So effectively, if you can check, simply your current year loan amount will be considered as a 95. Second, we will consider that is nothing but the commitment charges. Commitment charges is nothing but specifically incurred for borrow the fund. Third is nothing but the cost of maintaining a loan. And the fourth is exchange difference. I will cover exchange difference on a later stage. Clear? Okay. Friends, you know very well, normally all of your borrowing cost is charged to P&L. But if any of the borrowing cost is incurred on the qualifying asset, then it should be capitalized. Now the problem is that, what is the meaning of the qualifying asset? Qualifying asset means any asset which take substantial period of time for ready to use. What is the substantial period? That was not mentioned anywhere. But for academic purpose, we can take 12 months or more will be considered as a substantial period. Friends, Ind AS 23 is not applicable when any of the asset is measured at a fair value less cost to sale. And I am having the best example, that is nothing but the under Ind AS 41, biological assets and agriculture produce at the point of harvest are measured at a fair value less cost to sale. In this situation, we will not use the Ind AS 23. Clear? Okay. So simple hyperinflationary economy, Ind AS 29 is not in your syllabus. Next point is nothing but, whenever you are determining the borrowing rate, please understand that borrowing cost capitalized should not exceed actual borrowing cost. Clear? Incurred. Because one thing is very clear, if we cannot capitalize any of the notional interest with the cost of the asset, if actual borrowing cost is incurred, then only we should capitalize, otherwise we cannot capitalize. Next important point is that, in a practical life, we are borrowing the fund from the day one only. But we are not incurring all the fund on the first day. We are incurring expenditure on a time to time period. So whenever we are incurring the expenditure on a different time period, first of all, friends, please understand that you are having some idle fund. And as a commerce people, whenever we are having the idle fund, we are investing that fund for a temporary period. And if we are investing that fund for the temporary period and if we are earning some income, then that income is not directly credited to P&L. That income is first of all adjusted with the interest expense. And we will capitalize just the net borrowing cost. Clear? So this is the now I am discussing the steps. It may be possible you are developing two or more assets together. So first of all, you should determine the expected cost. From that expected cost, it may be possible. Please understand, whenever we are discussing the borrowing, there are two types of borrowing. One is nothing but considered as a specific borrowing, and second will be considered as a general borrowing. Specific borrowing means we are informing to the bank we are taking this fund for construction of this particular asset only. And the general borrowing is like considered as a bank overdraft or the cash credit or whatever. Clear? So simple. From the total expected cost, please deduct if you have borrowed any specific borrowing. Then consider your requirement of general borrowing, and it is not a rule. Then it is not like a rule that whatever fund is required that we have to borrow only. It may be possible we are not borrowing that fund because we are using our own fund for the construction of the asset. Simply, then friends, if we are having the general borrowing at a two different rate, then we will consider the effective rate. We will consider the weighted average borrowing rate, and that weighted average borrowing rate is actually capitalized. But please understand, if your requirement is higher, but if you are borrowing the less amount, then you should understand that whatever the borrowing cost is apportioned into the two assets in the ratio of their requirement. Clear? We have done many examples in our class. Now I am discussing three topics together. That is nothing but the commencement of capitalization of the borrowing cost, suspension of the capitalization of the borrowing cost, and the cessation of the capitalization of the borrowing cost. When you can start the capitalization of the borrowing cost? First, if the borrowing cost is actually incurred and the actual development is took place. If due to any abnormal reason, we are not doing the construction for the temporary period, for that period we cannot capitalize the borrowing cost. This is called the suspension of capitalization. But whenever asset is ready to use, simple, or it may be possible we have repaid all the borrowing, afterwards we cannot capitalize any of the borrowing cost. So commencement means to start for the capitalization. If for a temporary period we are not capitalizing the borrowing cost, then it will be considered as a suspension of the borrowing cost. And when our asset is ready to use and afterwards we are not capitalizing any of the borrowing cost, then it will be considered as the cessation of the capitalization. Clear? Friends, please understand. If there is any temporary delay, which is your necessary part of production process, then interest should be capitalized. Suspension of capitalization is not required. Again, I am repeating, if any temporary delay, which is a necessary part of production process, then interest should be capitalized. Suspension is not required. Clear? Now, this is the most important point, that is nothing but the exchange difference. And if I want to discuss the exchange difference, then friends, please understand what I am trying to convey. Let's assume I have borrowed $1 lakh at the rate of the 5%, and at that time in India, on the closing, rate is nothing but the 48. So simple, if we consider, can I say in Indian currency, my rate of interest is nothing but my interest expense is nothing but the 2,40,000. They are considering that if this amount is not borrowed from out of India, if this amount is borrowed in India, then consider your borrowing cost. If this amount is borrowed in India, then it's $1 lakh, and let's check, at that time rate was 45, and in India rate is nothing but the 11%. Can I say, friends, my borrowing cost is nothing but the 4,95,000. At the time of borrowing, my rate is nothing but the 45, but in the closing, my rate is nothing but the 48. Can I say I will record the foreign exchange loss, that is nothing but the 3 lakh. As per Ind AS 23, this is not considered as a foreign exchange loss. If you are borrowing the fund out of the India, then your interest expense is 240. But if you are borrowing the fund in India, then your interest expense is 495. So simple, if I calculate the difference, then 2,55,000 will be considered as an interest cost only. And friends, the remaining 45,000 is considered as a foreign exchange loss. This topic was there in Accounting Standard 16, but there is one new topic. For same loan, if in the next year we are having, let's say, the foreign exchange gain, then it will not be considered as the foreign exchange gain. In a previous year, out of foreign exchange loss, if we have considered some portion as the interest, in the next year, if we are having the foreign exchange gain, then it will not be considered as a foreign exchange gain. First of all, this amount is adjusted with the current year interest expense. So if we read the theory, then you will get the better clarity. The adjustment should be an amount which is equivalent to extent to which the exchange loss does not exceed the difference between the cost of borrowing in the functional currency when compared to the cost of borrowing in the foreign currency. Where there is unrealized exchange loss, which is treated as an adjustment to the interest, and subsequently there is a realized or unrealized gain in respect of settlement or translation of the same borrowing, the gain to the extent of the loss previously recognized is an adjustment should also be recognized an adjustment to the interest. Clear? So simple, this thing should be clear in your mind. Friends, after that, I want to clarify that in this particular Ind AS, this definition is important, that all the three concepts is important, commencement, suspension and the cessation, and this foreign exchange is important. Clear? So finally, we end our Ind AS 23 here. Now friends, we are starting with Ind AS 24, that is nothing but the related party disclosure. Actually, in the world of accounting standard, we have one specific accounting standard, and that is nothing but the Accounting Standard 18. The name of Accounting Standard 18 is nothing but the related party disclosure only. If I discuss why this particular Ind AS is required, because it may be possible, whenever we are doing the transactions with the related party, that transaction lose the features of the arm's length price. It may be possible we want to increase the profit, we are selling the goods to the related party at a little bit higher price, but if we want to decrease the profit, it may be possible we are taking the service at the higher cost, or if we are selling the goods at the lower price, whatever the case. Problem is that if that related party transactions lose the features of the arm's length transaction 110%, one thing is very clear, my financial statement is not much more reliable. And if so, that's why the logic is that if we are entering into any transaction with a related party, it's our responsibility to disclose in the notes to accounts. Friends, Ind AS 24 is applicable to both consolidated financial statement and the standalone financial statement. But please understand, whenever you are preparing the consolidated financial statement, it is not include the disclosure transaction with the parent and the subsidiary, or rather the parent and associate or the parent and the joint venture. Because you know very well, whenever we are preparing the consolidated financial statement, that transaction is eliminated at the time of the preparation of CFS. So it should be eliminated. So that's why disclosure is not required. Clear? Simple. I already considered the objectives. Now, related party relationship is, friends, because of the two reasons. One is nothing but the because of the control, and the second is nothing but the because of the significant influence. Whenever I am using the word control, control is possible because of the three ways. Number one, if you are having more than 50% of the shares of the reporting entity. Second case is nothing but if you are having the control over the composition of the board of directors. And the number third, you are having the substantial interest. And for the substantial interest means nothing but you are having the more than 20% shares of that other entity. Not only just 20% share, you are participating in the operational and financial decision making process. Then I can tell you, you are controlling that particular entity. Friends, please understand that this is the three conditions. All the fulfillment of all the three conditions is not required. If you are fulfilling just one of the conditions, I can tell you simply, this is nothing but you are controlling that particular entity. Next point. Next, related party is because of the significant influence. How can we significantly influence to the another party? By representation of the board of directors, participation in the policy making process. It may be possible material intercompany transaction, interchange of the personnel, and the dependence on the technical information. Clear? This is not the definition of the related party. We have just discussed the definition of the control and the significant influence. Now, one of my reporting entity, and I am finding the related party to the reporting entity. For reporting entity, related party may be a person or maybe it's an entity, whatever the situation. How can we say that a one person is related to reporting entity? There are three conditions. If you are fulfilling one of the three conditions, then I can tell you, you are related party to that reporting entity. Number one, that person has a control or joint control over the reporting entity. Number two, person has the significant influence over the reporting entity. And the number third, person is a key management personnel of the reporting entity or a parent of the reporting entity. Number one, control, joint control. Number two, significant influence. Number three, you are a KMP of the reporting entity or you are the KMP of the parent of the reporting entity. If that person is the related party, friends, please understand that close member of that person is again considered as a related party. And in the definition of the close person, whom we will cover, father, mother, brother, sister, spouse and the domestic partner. I already told you this domestic partner is a pure Western concept. They are talking about the live-in relationship. Children of that person, children of person's spouse, and the children of domestic partner. Clear? Means they are including a stepson and the stepdaughter also. Dependent of that person or that person's spouse or the domestic partner. Clear? So in the definition of the close member, we are covering father, mother, brother, sister, spouse, domestic partner, children of that person, person's spouse and the person's domestic partner, dependent of that person, person's spouse and the domestic partner. Clear? Simply. Okay. Next. Now we are covering how can we say that a one entity is related to reporting entity. If that entities are member of the same group, and whenever I am using the word group, which entities we are covering? Parent, subsidiary and the fellow subsidiary. So in the first clause, we will cover the parent, subsidiary and the fellow subsidiary. In the second clause, one is the associate or the joint venture of the another. And that includes the associate and joint venture of the same group where the other party is a member. Clear? So simple in the second number point, one is the associate and second is the joint venture. Number third, fellow joint ventures. Whenever I am using the word fellow joint venture, means friends I am talking about the both parties are considered as a joint venture or the same third entity. In the clause number 3, they are the fellow joint ventures, means they are the joint venture of the some third entity. Number 4, one entity is a joint venture of the third party and the other is the associate of that third party. Friends, please understand. If there are two joint ventures, then it's a related party. One joint venture, one associate, then again the related party. But if there are two associate, then it will not be considered as a related party. That should be clear in your mind. Clear? Next point. Entities controlled and jointly controlled by person mentioned in A, 1, 2 or 3. Means what? If that person is a control, joint control, that person has a significant influence, or that person is a KMP or the KMP of the parent, and that person is having the control or joint control over the entity, then that entity will be considered as a related party to the reporting entity. Entity over which person in A1 has a significant influence or KMP. So if person is having the control or joint control, and further on any entity that person is having the significant influence, or that person is the KMP or the KMP of the parent, then that particular entity will be the related party to the reporting entity. Clear? And the next, entity provides KMP services to the reporting entity or the parent of the reporting entity, and the entity is a post-employment benefit plan. Clear? Friends, now please understand. If you want to make a summary, for a person, if you are having the control or joint control, then further everything will be okay. Means further on any of the entity that person has the control, joint control, significant influence or the KMP, all entities are the related party to the reporting entity. But if that person is having the significant influence or the KMP in the reporting entity, then further on another entity that should have compulsorily control or joint control, then only that entity will be the related party to the reporting entity. Clear? For entity, if you are having the subsidiary, further everything will be okay. Means associate joint venture or the associate joint venture or the subsidiary of the subsidiary will be the related party to the reporting entity. But if you are having the associate or joint venture, then compulsorily further you need subsidiary. Clear? So these are the related party. Next, if just because of the common directors between the two companies, we cannot say that these two companies are the related. Two venturers are not considered as a related. If any bank is providing finance to you, so we cannot say that that bank is a related party to you. If you are a part of the trade union or the public utilities, government agencies, single supplier or the single customer, then we cannot say that these are the related party to you. Clear? So simple, it should be clear in your mind. Now we are asking for the disclosure. Just concentrate here. If related party is because of the control, and if you are not entering into any transaction in the current year, then also you should disclose minimum two things, that is name of related party and the nature of the relationship. If related party is because of the significant influence or the KMP, and in the current year, if you are not entering into any of the transaction, then disclosure is not required. But if you are entering into transaction with the related party, then following disclosures are required: name of related party, nature of relationship, nature of transaction, amount of transaction, outstanding balance if any, and the amount written of any. Clear? Simple. If you are having the control, not entering into transactions, still you have to disclose two things. But if you are having the significant influence or the KMP and you are not entering into any transaction, then disclosure is not required. Second thing, most important, if in some cases disclosure of the related party is prohibited because that information is actually confidential, it is required. In that situation, if you are not disclosing the related party transaction, then it will be okay. Let's assume I am having the share 55% of another entity on 1st April, but I am selling that share on the 31st July. Entire share I am selling on 31st July. Still we are doing the transaction for the period of the 1st April to 31st July and even afterwards. Whether I have to disclose the related party, answer is yes. But you are not supposed to disclose the related party transaction for the entire year, because after 31st July you are not having any relationship. So you have to disclose just the transaction for the period in which you are in the relationship. Means you have to disclose the transaction for the period of 1st April to 31st July, and the further disclosure is not at all required. Is it okay? Perfect. Next, there is some exemption to government related entities. And which are that exemption? Please focus. If you are doing any transaction with the government, or if any entity on which government has a control, joint control or significant influence, or if any other entity that is related because the same government has a control, joint control or significant influence over both the reporting entity and the other entity, then you are not disclose the related party transaction, but you are just required to disclose that is nothing but the name of government and the relationship. Otherwise, anything is not required. Clear? So these are all about the Ind AS 24, and now we are starting with the most important Ind AS, that is nothing but the Ind AS 33, earning per share. Now please focus here. Why this particular Ind AS is required? Friend, under the world of accounting standard, we have one specific accounting standard, and that is nothing but the accounting standard 20. From the use of the earning per share, we can easily compare the financial performance of the two entities for the same reporting period, or we can easily compare the financial performance our entity from the current year with the previous period. So EPS actually is a tool for comparison of the financial statement. You know very well, earning per share is disclosed on the face of statement of profit and loss. And yes, there are two types of EPS. One is called the basic EPS and second is called the diluted EPS. Both EPS was covered under accounting standard 20. Second thing, if I discuss, disclosure of EPS is required in the both financial statement, means in the standalone financial statement as well as in the consolidated financial statement. It is very clear. Whenever you are presenting the earning per share in the standalone financial statement, then you should use the standalone information. But whenever you are presenting the earning per share in the consolidated financial statement, then friends, you should use the consolidated information. Next point, if I discuss, that is nothing but the basic earning per share. The formula for the basic earning per share is nothing but the profit available to ordinary shareholder. You know very well, under Ind AS we are not using the word equity shareholder, we are using the word the ordinary shareholder. That is nothing but the profit available to ordinary shareholder. This word is very clearly added of the parent entity divided by weighted average number of shares. Means if I consider, this is nothing but the holding company, this is nothing but a subsidiary company, and holding company is having the 80% share of the subsidiary. If I prepare the standalone financial statement, the both company is having the 10,000 shares, but holding company is having the 500 shares, and then subsidiary company is nothing but having the 1,000 shares. So in the standalone financial statement, holding company will report the EPS of rupees 20, and in the standalone financial statement of the subsidiary company will report the EPS of rupees 10. It will be okay. But whenever my holding company will prepare the consolidated financial statement, we will consider the profit available to ordinary shareholder of the parent entity. Can I say my earning as a holding is nothing but the 10,000? Total earning of the subsidiary is nothing but the 10,000. But don't you think so? Holding company is not having the 100% share. Holding company is having just 80% share. And the holding company is having just the 80% share, means just the 800 shares. So simple, can I say their consolidated earning will be considered as 18,000? Divided by, I consider the 500, then friends, I can tell you my consolidated EPS will be considered as a 36 rupees. I think you are following me. Let's take just the 80,000 divided by 500. Yes, my consolidated EPS will be considered as 36 rupees. Now, first of all, we should consider what is the meaning of the profit available to ordinary shareholder. Whenever we are doing the profit available to ordinary shareholder, it is nothing but the profit after tax minus preference dividend minus dividend distribution tax on the preference dividend. Friends, please understand, India is following the single statement approach. Means it is profit after tax plus OCI is equal to considered as a TCI, that is called the total comprehensive income. Whenever we are doing the calculation of the earning per share, our starting point is not TCI. Means our starting point is not total comprehensive income. Friends, our starting point is nothing but the profit after tax. We will start calculation from the profit after tax, and OCI is not taken in the picture. Clear? Okay, this will take on the later stage. Just a minute. Now I want to cover some basic point. Please understand. If there is any extraordinary item, no doubt there is no extraordinary item concept in Ind AS. But if they are giving some questions, repeated questions from the accounting standard, if there is any extraordinary item, my question is whether we should consider that extraordinary item in the calculation of the profit after tax. Answer is yes. If there is any prior period item, obviously that item is again considered. But my problem is that if you are issuing the preference share, and from the viewpoint of dividend, you know very well the preference shares is having the two types. One is nothing but the cumulative preference shares, and the second is nothing but the non-cumulative preference share. What is the meaning of the cumulative preference shares? If because of the insufficient profit, if you are not paying the dividend in the current year, then you should pay that dividend in the future year also. But what is the meaning of the non-cumulative profit? If you are not having the sufficient profit to pay the dividend in the current year, that the holder will forget, and you should also forget that dividend will not be repayable in the future. Clear? So simple. What is the impact of the cumulative preference share and the non-cumulative preference share on the earning per share? There is a huge impact. If it is a cumulative preference share, and because of the insufficient profit, if you are not paying any dividend in the current year, then also you should consider that dividend in the current year for the calculation of EPS. But if it is a non-cumulative preference share, and in the current year, because of the insufficient profit, if you are not paying any dividend in the current year, then it should not be considered in the calculation of the EPS. Next. There are various income or expense which are actually debited to P&L. But because of some law, because of some regulation, you can adjust that expense or income directly in the balance of the reserves and surplus. You can do that. But for calculation of EPS, you should consider that particular expense or income as a part of profit and loss only. So can you give an example? Answer is yes. Friends, normally preliminary expenses debited to P&L. But as per section 53 of the Companies Act 2013, if you are having this balance of the securities premium, you can set off the amount of the preliminary expense with the balance of the securities premium. You can do that, I never denied for the same. But whenever we are calculating the earning per share, that preliminary expense should be considered as a part of the profit and loss only. Clear? Next point. Sometimes we are issuing the preference share at a discount or at a premium. And because of that, my effective rate of dividend is changed. So whenever you are issuing any preference share at a premium or the discount, friends, you should calculate the effective rate of dividend, and from that effective rate of dividend, you should consider that is nothing but your profit after tax. Now we are starting for the weighted average number of share. Whenever I am using the word the weighted average number of share, you should give the weight by using the number of month or the day, preferable number of month. But friends, please understand what I am trying to convey. We have various events. If there is any bonus, then actually weightage is considered from the day one. But there is some problematic situation, please understand. If it is a situation like this, on the 1st April we have 1000 shares. On 1st July we have issued the 500 shares. And on the 1st October, we are giving the bonus of the 300 share. If it is a question like this, then this bonus is considered from the day one. Clear? But the situation is like this. We are having the 1000 shares. We are having the 1000 shares. On 1st April, we are having 1000 shares. On 1st July, we are having the 500 shares. And on the 1st October, friends, we are giving the bonus of 1:2. If we are giving the bonus of the 1:2, so from this 1000, we are giving the bonus of 500. And here from this is 250. So actually we are giving the bonus of the 750 share. But out of 750, 500 share will be considered from the day one. But the 250 shares will be considered from the 1st July. It will be okay. Now, clear? Bonus is considered from the day one, but if there is some ratio, then from the respective date. If it is a convertible instrument, and if it is a convertible instrument, then weightage is considered always from the date of conversion. If any shares are issued against the services, then weightage is considered from the date when the services is rendered. If any share is issued against the cash, then weightage is considered from the date of cash receivable. If it is the case of the business combination, then here always in a business combination, we will consider the date from the date of acquisition. Clear? Okay. Then Next point, this is covered already. Okay. Now, one more point, and that point is nothing but the restatement of EPS. Friends, in some particular year, if you are giving the bonus to the existing shareholder, or it may be possible if you are not giving the bonus, but if you are doing the alteration of share capital, and you know very well, whenever I am using the word the alteration of share capital, it includes the share split off and the share consolidation. Whenever I am using the word share split off, means what? You are demanding the 1 share of rupees 100 from the shareholder, but you are against that 1 share of rupees 100, you are giving the 10 shares of rupees 10 each. What is the share consolidation? You are demanding the 10 shares of rupees 10 each from the shareholder, but against that you are giving the 1 share of rupees 100, then it will be considered as a share consolidation. Please understand what I am trying to convey. Simple, whenever you are issuing the bonus, or whenever it's a situation of the share consolidation or the share split off, friends, what should you do? You should adjust the previous year EPS. Logic is that if in this year earning is 100, if in this year earning is 100, here number of share is 10, that's why I am disclosing the EPS of rupees 10. But in the current year, I am giving the 1:1 bonus. So now in the current year, my number of share is not 10, my number of share is just the 20. So can I say my EPS will be 5? Actually, if general people will see the financial statement, they are thinking that my earning per share is reduced by 50%. But actually, it's not a reduce. First of all, my shareholder is receiving the 10 rupees if they are having the 1 share. But now they are having the 2 shares, so they are receiving the 5 rupees per share. Effectively, they are receiving 10 rupees only. But everyone is not chartered accountant. So, you should adjust the previous year EPS, and in the last year you will consider the number of share 20, and for the comparative financial statement you should disclose the earning per share of rupees 5 only. Clear? Then this is a topic that is called the right issue, and this is one of the favorite topic. Friends, we are giving the right to the existing shareholder, and obviously at a concessional rate. If my market price of share is 10, and if I am giving the right at a 10, obviously it's indifferent to the shareholder. But if my market price is 10, and if I am giving the right at rupees 12, it is called the out of the money right. Means people will not accept. Why they are taking the right at 12? If they want to acquire the share, the market price is 10, so obviously they can take from the market. So I have to give the benefit to my shareholder, and that's why I am issuing the right. Right is optional, it's not a mandatory. If you want to exercise, you can, or if you don't want to exercise, simply you can, whatever. But yes, friends, understand, after right, your market price of shares will be reduced. Obviously, why? Because first of all, I am having the 2 shares, and the price of the 2 share is nothing but the 20, so it's nothing but the 40 rupees. Now, company is giving the 1 share at rupees 15. So simply, now I am having the 3 shares of rupees 55. And obviously, if I divide the 55 divided by 3, my price will be 18.33. Before right, my share was at rupees 20. But after right, the share price is nothing but the 18.33. So obviously, it will be reduced, so don't worry at all. Clear? Whenever you are finding any question of the right, it should be solved by using 3 steps. In step number 1, we will calculate theoretical extract value. And friends, what is the meaning of the theoretical extract value? What is the formula first of all? It's actually weighted average. Formula is like this. Number of shares before right into market price before right plus right issue into right price divided by total number of shares after right. It's actually a pure weighted average. But whenever you are using this formula and whatever you will get the answer, what is the logic of this answer? After right, market price of this particular share should be like this only. Clear? Number 2, that is nothing but the right factor. What is the formula for the right factor? It is nothing but the market price before right divided by theoretical extract value. Let's assume if my answer is 1.15. If my answer is 1.15, it suggests that you are giving 0.15 share as a bonus. You are giving 0.15 share as a bonus from 1 share, in a 1 share. Friends, there is a problem. So you are concentrating on the right and where its bonus came in the picture. Obviously, let's assume if I am having the 10,000 shares and the market price of the share is nothing but the 10, and I am issuing the right, at a 5,000 shares of rupees at rupees 6. So simple, my shareholder will give me 30,000 rupees and I will give 5,000 shares. But if you are not my shareholder, and if you are giving me 30,000 rupees, one thing is very clear. I will not give you a 5,000 shares. I will give you just a 3,000 shares. But can I say in the same consideration, I am giving 5,000 shares to my shareholder? And if I am giving the 5,000 shares to my shareholder, one thing is very clear. I am giving 2,000 shares as a free of cost to my shareholder. And whatever I am giving as a free of cost to my shareholder, it will be considered as a bonus. So please understand, right is a combination of the bonus and the share issued against the cash. Normally the bonus is considered from the day one, but the share issued against the cash will be considered from the date of cash receivable. Clear? So in a step number 2, we are finding out the right factor. In a step number 3, we will calculate opening share into right factor, that is considered from the day 1, and the balancing figure is considered from the date of the right issue. Clear? This is very easy. This same method you are following in the accounting standard also. We are having the same concept in the buyback also. And what is that concept? I am having the one sum. Let's assume I am having the 50,000 shares on 1st April 17. On 1st January 18, I am having the 10,000 shares of rupees 40 per share, when the fair market value was rupees 25. And earning is given 1 lakh and the 1,05,000. Friends, actually can I say your market price is nothing but the 25. But you are buybacking share at rupees 40. And whenever you are bought back the shares at rupees 40, simply can I say you are paying the little bit extra amount from the current market price. And if you are giving the benefit to the existing shareholder, the one thing is very clear, it is considered as a bonus only. So simply, my buyback also includes the bonus. It is exactly method we are following, that is nothing but exactly like right only. And first of all, step number 1 we will do, that is nothing but the theoretical X-right value. And what is the meaning of the theoretical X? In that theoretical X-right value, now we are having the theoretical X buyback value. And what is the formula? Number of shares before buyback into market price before buyback. Here it is not plus, it is a minus. Number of shares bought back into buyback price divided by total number of shares after buyback. Then we will not calculate the right factor. We will calculate the buyback factor. And what is the formula for the buyback factor? It is nothing but the market price before buyback divided by theoretical X buyback price. And in a number 3, just assume we are actually bought back 10,000 shares at rupees 40. So we are having the 4 lakh shares, 4 lakh rupees. And if we want to purchase this share from the market, then price is nothing but the 21.25. This is nothing but this answer. Theoretical. Clear? Okay. 4 lakh divided by 21.25. So actually we can bought back 18,823. But can I say we have just bought back 10,000? So simply this is considered as a 8823 shares is a bonus. And you know very well, this bonus will be considered from the day 1. And if it is considered from the day 1, and accordingly we have to provide the effect. Clear? Simply, perfect. Now, we are taking one more example. That is nothing but the contingently issuable share. Friends, what is the meaning of the contingently issuable share? Let's take an example. I am appointing the Mr. X as a chartered accountant in my office. And I am telling him, please give me your valuable suggestion, because of that my business will increase. And today my turnover is, let's say it's a 500 crore. And because of your suggestion, if it is doubled, it's a 1000 crore after 2 years, I will give you some number of share. Can I say whether I want to issue or not? That is totally depends on the future event, and that is event is nothing but my future turnover. If that person helps me to achieve the turnover, then only I am liable to pay. Otherwise, I am not liable to pay. Are you following me? Now, the problem is that when it will be considered in the calculation of the basic EPS and when it will be considered in the calculation of the diluted EPS. Contingently issuable share is included in the basic EPS, friends, only and only after if specific conditions are met. If specific conditions are not met, then you are not supposed to consider that share in the calculation of the basic EPS. Clear? But yes, don't you think so that shares will be considered as a potential ordinary share? Potential means it will be convertible into future. If that share is a potential ordinary share, it shall be considered in the diluted EPS. But yes, that will be considered in the diluted EPS because we are giving the contingently issuable share on fulfillment of a certain condition. That conditions may be a non-market condition like earning. That condition is based on the market condition. Clear? So simple. That is considered as a potential outstanding share when at the reporting date the condition in contingently issuable agreement are met. Ind AS prescribes that entity should not assume that the position at year end till the end of the agreement period. Assume that the reporting date is the end of the contingently issuable share agreement period. No estimation is required about specified condition being fulfilled or not fulfilled in the future. Means, can I say, I am giving a condition of a double turnover. Let's say 1 year passed. 1 year passed, there is an agreement between me and my employee, that chartered accountant. And till date, they have not passed, means till date, they have not achieved that condition. Means my turnover is not yet double. So I cannot estimate. So simply today it will not be considered as a potential equity share and it will not be considered in the diluted EPS. And in the basic EPS, we will only consider when all the conditions are satisfied. And when all the conditions are satisfied, simply it will be considered as the basic EPS. Clear? Now I am starting the most important topic. That is called the diluted EPS. What is the meaning of the diluted EPS? Diluted means to decrease. To decrease the value of earning per share because of the potential equity share. Because of the potential equity share. And friends, what is the meaning of the potential equity share? Potential equity share means any financial instrument which will be convertible into the future into the equity share. That is not converted today. It will be convertible into future. That's why it is considered as a potential. Clear? If I can take an example, option is nothing but considered as a potential equity share. If my employee will exercise option, simply it will be the share in the future. Convertible debenture is considered as a potential equity share. Convertible preference share is considered as a potential equity share. I think, are you following me? Simply, whenever you are finding any question of the diluted earning per share, first of all, you should consider the increase in earning. And the second, friends, you should consider the increase in number of share. Obviously, today there is no expense in the option. So simple, in option, increase in earning is nothing but the zero. But can I say, if convertible debenture is converted into the equity, I am not supposed to liable to pay any interest. And if I am not liable to pay any interest, one thing is very clear, I will not get any tax deduction on that particular date. So my increase in earning is nothing but the I into 1 minus T. That is called the interest into 1 minus tax rate. If there is a convertible preference share, if that convertible preference share is convertible into the equity, then simple, there is a saving of the preference dividend. And if I am not liable to pay the preference dividend, obviously I am not liable to pay the dividend distribution tax on the preference dividend also. Clear? So this is increase in earning. Now please understand. If your capital structure is a complex capital structure, then friends, you are required to calculate the dilution effect and you should follow the ascending order of that dilution effect. Now first of all, you should understand what is the meaning of the capital structure. Friends, capital structure includes the debt and equity. What is the meaning of the complex capital structure? If in your capital structure you are having the more than one potential equity share, means I may have issued the convertible preference share, I have also issued the convertible debenture. So I am having the more than one potential equity share, then my capital structure will be considered as a potential capital structure. So whenever I am having the potential capital structure, I will not calculate first of all diluted EPS, I will calculate first of all the dilution effect. And what is the dilution effect? Dilution effect is nothing but the increase in earning, and the second is divided by increase in number of share. Increase in earning divided by increase in number of share. And from that dilution effect, friends, you should follow the ascending order. If you check, for option your answer is 0. Convertible debenture, your answer is I into 1 minus T. Convertible preference share, your answer is preference dividend plus dividend distribution tax, and you should follow the ascending order. Clear? If you are not following the ascending order, then your answer may be like this: basic, diluted, anti-diluted, again diluted. But if you are following the ascending order, then your answer will be like this: basic, diluted, diluted, and the anti-diluted. Rule is that if there is an anti-diluted EPS, then it should be at last. Clear? Then only you will get the correct answer. And what is the formula for the diluted EPS? It is nothing but the increase in earning. Rather existing earning plus increase in earning divided by existing number of share plus increase in number of share. Friends, if you are issuing some convertible instrument, it's not actually a compulsory convertible instrument, it's actually a convertible instrument. So if it is a convertible instrument, we don't know at the time of the maturity how many holders will demand the cash or how many holders will demand the share. So today, for the calculation of EPS, you should consider entire holders will be converted into shares only. And accordingly, you have to calculate your diluted EPS. Clear? Restatement of EPS I already considered. Now this most important point. Ind AS 33 requires that an entity which reports a discontinued operation will disclose the basic and diluted EPS for the discontinued operation either on the face of P&L or in the notes. Clear? And obviously there is now not an extraordinary item. So under accounting standard, it was like that. You have to disclose the EPS before extraordinary item and the EPS after extraordinary item. That thing is now not required. Can I go ahead? So finally my Ind AS 33 ends here. Now I am starting Ind AS 34. And the name of Ind AS 34 is nothing but the Interim Financial Reporting. It is exactly like accounting standard 25 only. And friends, if we are discussing the Ind AS 34, why this particular Ind AS is required, let's discuss first of all. Because whenever we are presenting the financial statement, our financial statements are apparently issued at annually. And some information is like this: if we are providing that information to our stakeholder after 1 year, then simple, that actual information loses that importance. If we are providing the information on time, then only it will be beneficial to the companies and beneficial to the stakeholder. That's why this concept came in the picture. Whenever in the class my experience says I am starting teaching this topic, people are believing that this is only applicable to the listed companies. Answer is no, friends. It is not like that. Actually, there is a two different thing. One is interim financial reporting and second is interim financial result. Again, I am repeating, there is a two different things. One is interim financial reporting and second is interim financial result. Listed companies actually presenting on a quarterly basis as per the SEBI guidelines, it's interim financial result. But my Ind AS name is not interim financial result, my Ind AS name is interim financial reporting. So let's bifurcate. Whether it is an interim financial result or it is an interim financial reporting, in a both situation, you should do accounting as per Ind AS 34 only. But whenever it's an interim financial result, your disclosure should not be as per Ind AS 34. Friends, your disclosure should be as per the SEBI guidelines. Clear? There is a proper format for the newspaper and all. How to present our interim financial result in the newspaper, there is a proper format for that. But whenever we are presenting the interim financial report, our disclosure should be as per Ind AS 34 only. So first of all, we should consider that what is the meaning of the interim financial report. Friends, interim financial report means if any financial statements are prepared for the less than 12 months. It may be possible you are preparing the financial statement for the quarterly basis, for the half-yearly basis. It may be possible we are preparing our financial statement for the 7 months and 15 days. What? Yes, it is possible. Let's assume I want a loan on 15th October. And if I want a loan on the 15th October, let's say on the 15th November. Bank is demanding till date, just give me your actual financial statement. And for the remaining 4 or 5 months, you have to give the provisional data. So for that, this 7.5 months, if we are preparing our financial statement, then simply it will be considered as interim financial report and my Ind AS 34 will be applicable. But yes, friends, there is a one relaxation. And what is the relaxation? Let's assume my company was incorporated on the 1st January 20. If my company was incorporated in the 1st January 20, can I say my first year ends on 31st March 20? As per the company law, if you want to prepare the financial statement on the 31st March 20, then you can. But if you don't want to prepare the financial statement on 31st March 20, that is the first financial statement, then directly prepare on 31st March 21. Then directly prepare on 31st March 21. But let's assume I don't want to prepare on 31st March 21 for the 15 months. I am preparing the financial statement for 3 months. Still, Ind AS 34 is not applicable. If I read the entire definition, interim financial report means if any financial statement is prepared for the less than 12 months, But yes, there is a one relaxation. There is a one point. If this is your first set of financial statement, even though it is for the less than 12 months, then it will not be considered as interim financial report. Clear? Okay. Simple. In Ind AS 34, they have not clarified that which entities are required to publish the interim financial report. But yes, if any entity is required to present the interim financial report, then they have to follow Ind AS 34. And yes, it may be a full set of financial statement, or it may be interim financial report. What we have to present? Balance sheet. It actually shows the statement of financial position on a particular date. Statement of profit and loss. It shows the financial performance for the period. Statement of changes in equity. Statement of the cash flow, and the significant accounting policies disclosure. Clear? This thing is required to be disclosed. Clear? Now friends, please understand. This is the most important. If you are comfortable then only it will be beneficial. This is financial year, let's say 2021, and I am preparing the interim report for the quarter 2. Clear? Whenever you are preparing the balance sheet, friends, you should give the balance sheet as on 30 September 21, rather 30 September 20, with compared to 30 September 19. This is called balance sheet as of the end of the current interim period and the comparative balance sheet. Clear? Whenever you are presenting the statement of profit and loss, then statement of profit and loss is actually given for the period ended. Clear? Means we are giving this period for the year ended from the 1st July 20 to 30 September 20. That is for the current interim period. Then we will give for the 1st April 20 to 30 September 20. That is called the year to date. Then we will give the comparative. That is called the 1st July 19 to 30 September 19. Means statement of profit and loss for the previous period, and for the year to date means 1st April 19 to 30 September 19. Clear? Just the balance sheet to disclosure is required, but whenever it's a story of the statement of profit and loss, you have to disclose this for. Statement of changes in equity exactly like balance sheet only, and the statement of cash flow, it's exactly like for this period, means for the year to date only. Clear? So this is the most important period you have to consider. There are two views, that is called the integral view and the discrete view. What is the meaning of the integral view? Integral view means my interim period is considered as a part of the annual period. Discrete means it's a separate. My interim period is considered as a separate. Friends, whether it's a accounting standard or whether it's Ind AS, they are following the discrete view in the general, means we are considering it's a separate financial statement. Clear? Next point. How to calculate the tax expense? Friends, if you are preparing the financial statement for the quarter 2, or rather than quarter 1, let's assume quarter 1, then you are having the actual data of the quarter 1. For the remaining quarters of the years, means for the quarter 2, 3 and 4, you have to estimate. And you are calculating the total income. From that total income, if you are having some carry forward of losses, that carry forward of losses is deducted. And if that carry forward of losses is deducted, we are calculating the total taxable income. And on that total taxable income, we will calculate the tax expense. And whenever we are calculating the tax expense, then find out the weighted average rate. But I found a number of students, whenever you are calculating the weighted average rate, friends, please understand, Your formula is like this: total tax expense divided by taxable income before carry forward of losses. Number of students are in a hurry. They are taking the after carry forward of losses. We will not take the after carry forward of losses. It will be taken as a before carry forward of losses. Then only we will get the correct answer. But it may be possible. In some quarter, you are having a special income. They are chargeable at a special rate of tax. Best example is nothing but the capital gain. And if you are having any special tax, then it should not be merged with the normal income. It should be calculated separately. Clear? Second thing. As per Ind AS 34, you are having the two choice. You can issue the complete set of financial statement, or you can issue the condensed, means summary based financial statement, whatever the situation. If you want to issue the complete set of financial statement, or if you want to issue condensed set of financial statement, that is your choice. But as per Ind AS 34, it's an advisable to issue condensed set of financial statement, means a summary set of financial statement. It is not like that in summary side of financial statement. You will prepare just the asset side of the balance sheet and not the liability side of the balance sheet. It is not like that you will just prepare the credit side of the statement of profit and loss, means just the income side, and you are not preparing the expense side of the profit. No, it's not like that. Then, in the condensed set of financial statement, you are having some relaxation. And that relaxation is nothing but just in the notes to accounts. Whenever it's a story of the balance sheet, that all the thing is disclosed. Clear? Okay. And what are the significant events and transactions we have to disclose? If there is inventory write down or reversal, if there is an impairment loss as per Ind AS 36, if there is any reversal of the provision for the cost of restructuring, if you have any acquired or disposed any property, plant and equipment, if you are having any litigation settlement, if you are correcting any prior period error, or if you have made any of the loan default, there are related party transaction, changing classification of financial asset or contingent liability, and the contingent asset should be disclosed. This is just the ratta. Next point. Whenever you are preparing the condensed financial statement in a notes to accounts, you have to provide the minimum disclosures. And you have to write one line. We have followed the same heading and subheading which are followed at the time of the preparing annual financial statement. Simply, friends, they are telling you, whenever you are preparing the interim financial report, they are asking you to follow Schedule 3 Division 2. Again, I am telling you, Schedule 3 Division 2. Means at the time of the preparation of the annual report, in whatever the format you have presented your financial statement, the same format should be followed at the time of the interim financial report. Clear? Second, if your business is affected by the seasonal fluctuation, then again you have to disclose the fact of that disclosure. In the current year, if you have changed any accounting policy, you know as very well, as per Ind AS 8, change in accounting policy is only allowed because of the two reasons. If it is required by the Ind AS, means if it is a mandatory change, or if it is for the matter of preparation and presentation of financial statement. So whenever you are changing your accounting policy, you have to mention that facts. In the current year, we have changed our accounting policy. Friends, minimum you have to disclose your basic and diluted EPS as per Ind AS 33. You have to disclose the segment report as per Ind AS 8. If you have changed any accounting estimate, or if you have rectified any of the error, then you have to disclose as per Ind AS 8. If there is any contingency was there on the date of balance sheet, then it should be disclosed. If you are entering into any of the major transaction like amalgamation, merger, demerger, share issue, bonus, buyback, right, then it should be disclosed. And if there is any dividend declared or the paid in the current year, then it should be disclosed. Clear? Friends, please understand these are the minimum disclosure. If you want to disclose little bit more, it's allowed. Don't worry at all. Clear? Perfect. Okay. So finally, this is the end of Ind AS 34. Please remember, for Ind AS 34, there is a one line I want to clarify that. Whenever they are asking any sum, please understand, any income or any expense is not preponed or the postponed, except that income or expense depends on the time. If your income or expense is related to time only, then you can set off, otherwise means you can prepone or the postpone, otherwise it is not allowed at all. Clear? Can I go ahead? Okay. Now I am starting Ind AS 36, impairment of asset. Whenever I am starting any new batch, I am starting with this Ind AS only. This is again my one of the favorite Ind AS. Under the world of accounting standard, we have one specific accounting standard, and that is nothing but Accounting Standard 28. And the name of Accounting Standard 28 is impairment of asset. Friends, what is the meaning of actual impairment? If we discuss the dictionary meaning or the basic meaning of the impairment, it is nothing but the decreasing in the value of asset. Whenever I am using the word decreasing in the value of the asset, number of students are asking me a doubt in the first lecture of the batch. Sir, in depreciation also, we are decreasing our asset. Friends, please keep one thing in your mind. Depreciation is a systematic charge. Means we are allocating the total cost of the tangible assets over its useful life. Means at every year you have to provide the depreciation. But impairment is not like that. Today we will discuss some factors. If you are finding any answer positive for this factor, then only impairment is required. Otherwise, impairment is not required. So, dictionary meaning of the impairment is nothing but the decreasing in the value of asset. But according to Ind AS 36, we have to provide the impairment loss when the carrying amount of the asset is greater than the recoverable amount of the asset. That's why my formula is nothing but impairment loss will be the carrying amount minus the recoverable amount. Now we have to discuss what is the meaning of the carrying amount. Carrying amount is considered as a written down value. It will be considered as a balance sheet value. If you are done with Ind AS 12, then it will be considered as your account base. Simple, whenever we are providing the carrying amount, friends, please understand, carrying amount is nothing but the cost of the asset minus accumulated depreciation or minus accumulated impairment loss, if any, it's earlier provided. Recoverable amount. Friends, please understand. If you are having one asset today, actually if you ask me, that asset is having, you are having basically two choice. Number one choice is nothing but, you can dispose that asset today and you will take the amount. Or if you don't want to dispose the asset today, you will use that asset in the future, and because of the usage of that asset, you will generate some future economic benefit. Now my problem is recoverable amount is nothing but the value in use, or we cannot say that it's a net selling price. Under the Ind AS 36, it is considered as fair value less cost to sell, whichever is higher. If you ask me, recoverable amount is nothing but the auqat of the asset. In my balance sheet, value of the asset should not be more than the recoverable amount of asset, otherwise it will distort the picture. So simple, recoverable amount is nothing but the value in use or the net selling price, or rather a fair value less cost to sell, whichever is higher. But yes, before going further, we have to check the non-applicability. We are providing basically the impairment loss on the property, plant and equipment, which was covered under Ind AS 16, of the intangible asset, which was covered under Ind AS 38, property, plant and equipment, intangible asset. We will also providing the impairment loss on the investment property, which was covered under the Ind AS 40. And if there is any investment in the subsidiary, associate or the joint venture, is also impaired. But there are various situations. Actually, it's a non-current asset, but no doubt it's a non-current asset, but we are not providing any impairment loss on that. First of all, inventory, we have specific Ind AS 2. Construction contract is covered by the Ind AS 115, that is nothing but the revenue from the contract with customer. Deferred tax asset is basically non-current asset. Still, we are not providing any impairment loss. We have Ind AS 12. Asset arising from the employee benefits, today we also covered, that is nothing but the plan asset, Ind AS 19. If you are having any biological asset, we have specific Ind AS called the Ind AS 41. If you are having the deferred acquisition right in the insurance contract, we have 104. And again, we are not providing any impairment loss on the financial asset also. Clear? Now, it's just I'm writing the net selling price. But actually, it's not a net selling price. It is a fair value less cost to sell. Now, please understand. Whenever I am using the word fair value, we have to approach Ind AS 113. Fair value is basically the price that would be received when asset is sold, that would be paid when the liability is transferred in an orderly transaction between the market participants on a measurement date. So actually, if you ask me, Ind AS 113 is not following the entry price approach. Ind AS 113 is following the exit price approach. Clear? Last, we have to deduct the cost to sale. And basically, we are getting the fair value from the binding sale agreement. If we are having the current bid price, or we can use the management estimate also. Cost to sale means any cost is specifically incurred for selling of that asset. Now, please understand what I am trying to convey here. In a cost to sale, we will not consider if we are incurring any of the valuation fee. Because friends, you have to understand that valuation fee is basically not cost incurred to sell the asset. Valuation fee is basically incurred to determine the fair value of that asset. Clear? So simple, this is net selling price. After net selling price, I am considering the value in use. Friends, value in use is nothing but the present value of future cash flows. Present value of the future cash flow. If we are not disposing this asset today, can I say we are using that asset today? This asset will help us to generate the future economic benefit. But this asset will not help us to get the future economic benefit today. It will give us the future economic benefit in the future. So we are actually finding out the present value. If you are just only concentrated on study, and if you are less concerned with the practical life, then simply it will be okay for you. But yes, friends, in a practical life, actually we have to determine the present value. And there is a rule. Whenever you are determining the future cash flow, for the first 5 years, growth rate in the cash flow should not exceed the current year business growth rate. After 5 years, it should not exceed the current year industry growth rate. Then whenever you are discounting the cash flow, your cash flow should be discounted by using the pre-tax discount rate. And the pre-tax discount rate means you should use the discounting factor as per the CAPM. That is nothing but the capital asset pricing model. If I use the formula RF, risk-free rate, beta, RM minus RF. RF is nothing but the risk-free rate. Beta means it will be considered as a risk. RM means it is considered as a market rate. And the RF will be considered as a risk-free. Simple, sometimes you are not giving the RM minus RF. They are directly giving you a risk premium. Then obviously it will be okay. Don't worry for that. Clear? Simply, if your cash flow is not in Indian currency, if your cash flow in the foreign currency, obviously the both countries having the different discount rate, because both countries having the risk different, both countries are having the different risk-free rate. So what should you actually do? You will not use the Indian discounting rate, you will use the discounting rate of the country in which your transactions are denominated. Simply you will get an answer in the foreign currency only, and then what you have to do, you have to convert that answer into rupees by using the closing exchange rate. Clear? Okay. Now impairment loss, you know very well, it is directly charged to P&L. But if you are having the balance of the revaluation reserve, then whatever your impairment loss is first adjusted with the balance of the revaluation reserve, and the balancing figure will be charged to P&L. So now if we move further, friends, whenever you are recognizing the deferred tax, whenever you are recognizing the impairment loss in the books of asset, in the books of accounts rather, then actually it creates a temporary difference. Because let's assume here your account base is 100, your tax base is 100. And if you are recognizing the impairment loss of rupees 10, then now your account base is 90, but there is no impairment loss reduction in the income tax, then simply it will be considered as 100. Can I say this is a property, plant and equipment? And for asset, your account base is lower than the tax base. For asset, your account base is higher than the tax base, then you should recognize the DTL, but here it's lower than the tax base, then you should recognize the deferred tax asset. Why we are recognizing the deferred tax asset, if anyone asks you, because we are not getting actually the deduction of impairment in the income tax. Yes, you are not getting the deduction of the impairment in the income tax, but friends, believe me, you are getting the deduction in the name of the depreciation. So basically, if you ask me, impairment is nothing but the early charge of depreciation in the books of accounts, and whatever the temporary difference, on that temporary difference you should recognize the deferred tax asset. Clear? Now, for individual asset, it is difficult to determine the value in use. And for individual asset, if it is difficult to determine the value in use, there is a concept, the name of the concept is nothing but the cash generating unit. Friends, cash generating unit is nothing but the small combination of an asset. And for determination of the self-generating unit, one thing is very clear. If your product or service is marketable or the sellable, then we can say that this is a self-generating unit. Let's assume I am having the 3 department that is called ABC. Whatever the input I am doing the process in department A, it's an output. That output can be sold in the market, or that output can be also, we can transfer to our department B for the further processing. Our production capacity is a very lower, so that's why we are not selling this particular product in the market. We are directly transferring this product to the department B. Still, A will be considered as a separate cash generating unit. Why? Because my product is a sellable or the marketable. Whether I am selling or not, it's my choice. But if my product or service is a marketable or the sellable, then it will be considered as a cash generating unit. Clear? And now we are determining the impairment loss not of the individual asset, but we will determine the impairment loss for the CGU. And in CGU, we will combine the small assets, clear, and we will determine how many assets if we combine, then it will generate the cash flow. Yes, impairment is not a daily game. Impairment loss is providing on the reporting date, and that only if you find some indicators. Which are that indicators? There are 4 external indicators, there are 2 internal indicators. Which are that 4 external indicators? If market price of the asset is decreasing, if the rate of interest is increasing, if there are some adverse conditions against the entity, and if the market capitalization divided by the book value ratio is less than 1. Obviously, if market price is decreasing, your net selling price will be lower, and if your net selling price will be lower, obviously, simply it will be an indicator for the impairment. In all these 4 factors, there is no internal factors. These are considered as an external factors because market factors are affecting to the company. And there are 2 internal factors. First, there has been a physical damage to the asset during the year, or there is a poor economic performance of the asset is reported. There is a poor economic performance of the asset is reported. And if you are finding you are finding the answer yes for any of the factor, then it will be an indicator for the impairment, and you should provide the impairment. You should start the calculation of the value in use. Otherwise, that calculation is not required. Clear? But friends, please understand. For 3 type of asset, you should not check indicator. Irrespective of the indicator, you have to check or rather you have to provide the impairment, if any, on the reporting date. First, if any goodwill is acquired at the time of the business combination, if any intangible with indefinite useful life, and if any intangible which is not available for sale is every year impaired irrespective of the indicators. Clear? Then, the most important topic I am starting, that is nothing but the bottom up and the top down. Friends, if you want to understand the bottom up and the top down, so let's understand this particular topic, then you will get the better clarity. Just a minute. Okay. I am starting with this. For finding out the bottom up and the top down approach for better understanding, let's assume I am having three cash generating unit, that is A, B and C. Whenever I am telling you it's a 3 cash generating unit, it means in my CGU there is not only one asset but there are a number of assets. And let's assume the carrying amount will be like this. It's 100, it's 150 and it's 30. I am having the 2 assets. One is a goodwill and the second is nothing but the HO building. For goodwill allocation is possible, but for HO building allocation is not possible. This is not 10, this is 100. Clear? And the balance of the goodwill is 28, but the balance of the HO building is nothing but the 50. So simple, we will allocate the goodwill. But friends, for allocation, please remember one line. Please remember one line for the allocation. And that is very clear. For the allocation process, if you are having the specific ratio, then you should use the specific ratio. But if you are not having the specific ratio, then simply you should allocate that particular asset in the ratio of the fair value. And if there is a no fair value, then you should allocate that particular asset in the ratio of the carrying amount. Let's assume I am not having any fair value, I am not having any specific ratio, so I will allocate in the ratio of their carrying amount. And if I consider the carrying amount, so one thing is very clear. Whenever I am allocating the goodwill, it is in the ratio of the 10 plus 15 and 3. So total is 110. Here it's 165 and here it is 33. 110, 165 and 33. Then if I am finding the recoverable amount, let's say recoverable amount is nothing but the 95. Can I say my carrying amount is greater than the recoverable amount? So simple, I will provide the impairment loss, and that impairment loss is, let's say it's a 15 rupees. You know very well that impairment loss is first adjusted with the balance of the goodwill. So that's 10, and the balance in the asset, that is 5. This 5 rupees is adjusted again this 100. But friends, please understand, in these hundreds we are not having only one asset. We are having the number of assets. Whatever the asset we are having, our impairment, this is bifurcated in the ratio of their carrying amount. For the next, let's assume this is 140. If it's a 140, my impairment is nothing but the 25. This impairment is first adjusted against the balance of the goodwill, and the balance of the goodwill is nothing but the 15, and the remaining 10 rupees is adjusted against the balance of the asset, that is something but the 10 rupees. And here my carrying amount is a 40, so there is no impairment. This is called the bottom-up approach. We are allocating the asset. After bottom-up approach, we are starting with the top-down. We are having this much asset, that is A, B, C, goodwill and the HO building. The amount of the A is 100. In 100 we have provided the impairment of rupees 5. So now it's 95. We have the carrying amount of the B is 150. We have provided the impairment of rupees 10. So now it is a 140. For C we are having the 30. We have not provided any impairment, so it's 30. We are having the goodwill of the balance of 20. Out of 28 we have provided the impairment of rupees 5 and 10. So now this is 30. And the goodwill and the HO building is nothing but the 50. So if we make a total 95 plus 140 plus 30 plus 13 plus 50, simple. Can I say, friends, my carrying amount is nothing but the 328. And if I am considering the recoverable amount, then let's assume the recoverable amount is a 300. Friends, my impairment loss will be 28. And this 28 is only adjusted against the balance of the HO building. What is the logic in that? Because all the other assets except HO building was already impaired in the bottom-up approach. And if that was already impaired in the bottom-up approach, so one thing is a very clear, simple. Now in the top-down approach, whatever the impairment loss, that impairment loss is only just related to HO building. So let's assume if you are having the two assets, and the allocation of the both asset is possible, then you should use just the bottom-up approach. If you are having the two assets, allocation of the both is not possible, then you should use the top-down approach. If you are having the two asset, allocation of the one asset is possible, but the allocation of the another asset is not possible, then first of all, friends, you should use the bottom-up approach, and then, friends, you should use the top-down approach. It is not like a rule, you have to use the both approach. If asset is allocable, then only bottom-up will be sufficient. If asset is not allocable, then only top-down will be sufficient. Clear? So simple. Identify CGU of the entity, allocate goodwill and the corporate asset. If they are allocable, then we will calculate total carrying amount of the cash generating unit after allocation. We will calculate the recoverable amount, and the impairment loss is nothing but the carrying amount minus the recoverable amount. Whatever the impairment loss is first to the goodwill, and the balance to all the assets in the ratio of the carrying amount. After bottom up, we will start the top-down approach. My starting point of the top-down approach is nothing but to calculate the revised carrying amount after bottom up and the recoverable amount, and simply we will allocate the impairment loss. Clear? Now, after providing the impairment loss, can we reverse that impairment loss? Reversal of impairment loss is allowed or the not allowed? Friends, yes, it is allowed, but in a various situation. Finally, if I discuss the external indicators, market price of the asset is increasing, rate of interest is decreasing, and every conditions is favorable to the company, then it will be considered as an external indicator. there is only one internal indicator, that is nothing but the best economic performance of the asset is existing. It is exactly opposite. And what is the maximum reversal possible? Maximum reversal of impairment loss is possible up to carrying amount if the asset had not been impaired, or the carrying amount with impairment loss, whichever is higher, or the recoverable amount, whichever is lower. Friends, this funda is not new for you. This point we have already covered at the time of the Ind AS 16, that is called the property, plant and equipment. In property, plant and equipment, for subsequent measurement, if we are using the revaluation model, in revaluation model, if we are doing the downward revaluation, and after downward, if we are doing the upward revaluation, then we are following the same concept. We are finding out the book value with downward revaluation and the book value without downward revaluation, and we will compare all the things. Clear? Simply, my Ind AS 36 is done. This is the most important Ind AS. Basically, there are more practicals in this particular chapter, so you have to check that. Now I am starting Ind AS 37. The name of Ind AS 37 is nothing but the provisions, contingent liability and the contingent asset. Under the world of the accounting standard, friends, we are having the accounting standard 29. And the name of accounting standard 29 is nothing but the provisions, contingent liabilities and the contingent asset. Now, first of all, in some specific Ind AS, we are making some specific provision. And that provision is actually not covered under the scope of the Ind AS 37. First of all, construction contract, by mistake here it is written Ind AS 11, it is 115. You know very well, whenever our contract cost is more than the contract revenue, we are recognizing the provision for losses. And that provision for losses is actually covered by the Ind AS 115 only. Under Ind AS 12, we are recognizing the income tax provision. In lease also, this is not Ind AS 17, this is Ind AS 116. In employee benefits, we are recognizing the defined benefit obligation provision. For financial instrument, we are recognizing the credit loss allowances. In a business combination also, we are recognizing the provisions for the contingent consideration and all. So whenever we are having the specific Ind AS, we will not follow the Ind AS 37. And now I am starting my discussion with the definition of provision. Friends, in a life there are three situations. It is a liability, provision, or the contingent liability. I am teaching this point to my CA foundation student. In a liability is fixed, amount is fixed. Means amount is payable and how much payable you know very well. In provision, one thing is confirmed, you have to pay the amount. But how much amount is payable, you don't know. In contingent liability, whether we have to pay or not and how much amount is payable, we don't know any of the situation. Now, what is the meaning of the provision? Friends, the provision means a liability, but actually the amount is estimated. Now you heard one word that is called the liability. So we have to check the liability. Friends, liability is nothing but a present obligation. As a result of the past event and in the settlement of which you are expecting to pay, you are expecting to have in some outflow. That outflow is maybe in a cash or that outflow is maybe in a kind, whatever the situation. Now please understand one more basic point. If any provision which are specifically adjusted against the balance of the asset, then it will not be covered under the definition of Ind AS 37. But if any provision is specifically disclosed on the balance sheet liability side, then only it will be covered under the definition of the Ind AS 37. Sir, can you give an example? Yes. Provision for depreciation is basically covered under Ind AS 16. Provision for amortization is basically covered under the definition under the Ind AS 38. Credit loss allowances is actually deducted from the balance of the debtor. It will be covered under the Ind AS 32, 107 and the 109. But if any provision which is specifically disclosed on the liability side will be covered under the Ind AS 37. And the best example is nothing but any court case is pending and we are recognizing a provision. Warranty provision will be covered here. Now we heard one word. A liability is a present obligation. It's not my future obligation. If I take one example, let's assume in India it's a rule. If you are purchasing a car, you have to overhaul your car at every 3 years. in recognized service center of the government. If I am purchasing this car today, so on the next 31st March, it's not my present obligation. It will be my present obligation after 3 years only. Because if you think, in these 3 years, I can do anything. If I am selling this car before 3 years, then simply it will not be my present obligation. Clear? So it should be present obligation. If there is a present obligation, then only you should supposed to recognize the provision. Otherwise, the recognition of provision is not required. Under Ind AS 37, basically, they are discussing about the three types of obligation. One is nothing but they are discussing about the legal obligation. Second is nothing but, friends, your contractual obligation. And third is nothing but your constructive obligation. Friends, legal obligation is basically created because of some law, some of the court order, or because of any legislation. Contractual obligation is created because of any contract between the two parties. And this word is new for you. That is nothing but the constructive obligation. Friends, constructive obligation is basically created. Constructive obligation is basically created because of the management action, management statement, and the past trend. Whatever the obligation, it is in the definition of the Ind AS 37. Clear? Then, at the time of making the provision, friends, some points you should consider. You should recognize the provision only and only when it is a must be probable for outflow, and that is nothing but the outflow of resources. Clear? We are not creating any provisions for the future operating losses. It may be possible. We are not knowing the party. Whether you are knowing the party or not knowing the party, still you have to make a provision. My best example, if I am falling under section 44 AB of the Income Tax Act 1961, so it's one thing is very clear. I have to do the tax audit. But my chartered accountant is not yet appointed. You can appoint at any time. Still I have to make the provision. And second, this means I am not knowing the party. Or if I am knowing the party, I know this is my chartered accountant, he will demand this much of fees. Still, I have to make the provision. Clear? Next point. If any obligation is arise because of the change in law, then you should recognize the provision only when it's virtually certain the law is to be enacted. Clear? Okay. We are not considering any tax effect at the time of the making of the provision, means my provision is always prepared before tax. Clear? Next point, provision should be discounted by using the pre-tax discountant. This is the most important because this amount will be payable in the future. And if this amount will be payable in the future, this is my future value. And if this is my future value, I am recognizing the provision today. So I have to convert this amount into the present value. But yes, friends, because of the unwinding of discount, if your interest expense is not so much material, then if you are not recognizing any interest, if you are not doing the present value, then it will be okay. Perfect. Next point, friends, if I consider, if you are expecting some reimbursement from the third party, this is the most important point, please understand. Then you have to recognize the entire amount of the provision on the liability side. Let's say it's 100 rupees. And it is a virtually certain that I will receive 30% from the third party. So I will recognize the 30 rupees in the balance sheet asset side. Means my 100 rupees liability side, 30 rupees asset side. But whenever it's a profit and loss, actually you are making the provision because of the 100 rupees expenses. And out of 100 rupees, you are receiving the reimbursement of 30 rupees. So in P&L, you can set off to each other and you can directly recognize just 70 rupees, then it will be okay. But in the balance sheet, you should disclose the provision separately and the asset separately. You cannot set off to each other. Sometimes, because of our goodwill, because of our market, we have done the contract with the other party. If there is any claim against us of rupees 100, let's say, we will not demand 100 rupees from you. We will demand 150 rupees from you. Means we are receiving the 1.5 amount from you. In that situation, we cannot receive that excess rupees 50. We can set off 100 against 100. Excess rupees 50 is only recognized whenever you are actually receiving. Before that, you are not supposed to recognize that point. Clear? Now, main important topic is nothing but the onerous contract. Friends, what is the meaning of the onerous contract? Onerous is actually a burdensome. You are having the burden of this contract. In this contract, your expected cost is more than the future economic benefit. Onerous contract is a contract in which unavoidable cost of meeting the obligation is exceeds the economic benefit expected from this contract. Let's assume I have taken one asset on the lease. I am entering into the contract for the 10 years, and for every year, I am committing to pay rupees 1 lakh rupees. So actually this contract is basically for the 10 lakh. For 6 years, I am using that particular asset, and for the 6 years, if I am using that particular asset, now my wealth is so much great. And that's why I am transferring my asset to, I am purchasing my own factory, and I don't want the lease premise. And if I don't want the leased premise, so I am transferring my location. But still, I am entered into the contract for the 10 years. Just 6 years was lapsed, 4 years is pending. So I met to the lessee. I requested for the cancellation of the contract, but he denied. After that, I asked him, let's give me a chance for the sublease. Again, he denied. Now I am in trouble. Because of the 10 years contract, now I have to pay the lease rent for the additional 4 years. So because of this contract, I have to incur the expenses. But this lease contract will not give me any future economic benefit. So this contract will be considered as an onerous contract. And whenever it's an onerous contract, entire loss is recorded today only. Clear? Next is nothing but the executory contract. You learn this topic in the CA Foundation Contract Act. There are two types of contract, executed and the executory. Let's discuss for the executory. In executory contract, it may be possible either one party or the both parties have performed their partial obligation, then it will be considered as an executory contract. Ind AS 37 applies to those executory contracts which are onerous. If it's an executory contract but it's not an onerous contract, then it will not be in the scope of the Ind AS 37. And now, contingency. Friends, provision is my present obligation. But contingency is not my present obligation. Friends, contingency is my possible obligation. If I discuss the contingency, contingency means nothing but circumstances of the event should be available on the date of balance sheet. Result of which is not available on the date of balance sheet. Result is only known after happening or non-happening of future uncertain event which is not either wholly or partly within the control of the enterprise. That result is maybe a gain or maybe a loss. If it's a gain, then it will be considered as a contingent asset, but if it's a loss, then it will be considered as a contingent loss. There is something different from the accounting standard, that is nothing but the accounting. And what is the accounting difference? Let's discuss first of all the contingent liability. If your contingent liability is a virtually certain, then you should make a provision. If it's a probable, then again you should make a provision. If it's a reasonable, then your contingent liability should be disclosed in the notes to accounts. But if your contingent liability is a remote, then it should be ignored. If your contingent asset is a virtually certain, this is a little bit difficult for you, then you should recognize an asset. If your contingent asset is a probable, then just a disclosure is required. If your contingent asset is a reasonable or the remote, then no disclosure is required. Now, virtual certain means the probability of the event is a more than 95%. When I can say that this event is a probable, when the probability of the event is a greater than 50%, but less than or equal to 95%. When I can say that this event is a reasonable, when the probability of the event is greater than 5%, but the less than or equal to 50%, and when I can say that it's a remote if it is less than or equal to 5%. Clear? So simply you have to consider this much particular point. Perfect. These are the disclosure not relevant at all. So finally Ind AS 37 ends here. And I am taking the next Ind AS, that is called the intangible asset. 38. Under the world of accounting standard, we have one specific accounting standard, that is nothing but the accounting standard 26, and the name of accounting standard 26 is intangible asset. First of all, you should understand the meaning of an asset. Friends, asset means any resource which is owned or controlled by an enterprise as a result of a past event from which future economic benefit is expected. What is the intangible asset? Friends, intangible asset means any identifiable non-monetary asset without physical substance held for consumption in production of goods or the rendering of services. Three words is the most important. One is the identifiable, second is a non-monetary, and third is nothing but the without physical substance. Let's check one by one. First of all, identifiable means it's a separate asset. It should be capable to sell, capable to let out, capable to exchange. Clear? Non-monetary. Non-monetary means, friends, other than monetary. And what is the monetary? For that, we have to check Ind AS 21. Monetary asset means any asset whose settlement is fixed or in a fixed amount of currency or in a determinable amount of currency. Here they are clearly giving the word non-monetary. Without physical substance means which cannot be seen, which cannot be touched. You think there are various assets which are actually not seen or not touched, so you are thinking that these assets are the intangible assets, but actually it is not in the scope of Ind AS 38, because for that we are having the specific Ind AS. If some intangible assets are the held for sale, like in our normal routine course of business, then Ind AS 2 will be applicable. It is our inventory. We cannot see or we cannot touch the deferred tax asset, so Ind AS 12 will be applicable. Right of use of asset 116. Plan asset Ind AS 19. Any financial asset Ind AS 32. Goodwill acquired in the business combination Ind AS 103 applicable. And the deferred acquisition rights in the insurance contract Ind AS 104 will be applicable. Clear? Now, when we can recognize the intangible asset in our books of accounts only if they are fulfilling the recognition criteria. And there are two recognition criteria. One, the cost of the intangible asset should be measured reliably. And the number two, it is probable that future economic benefits will flow to the entity. If you are fulfilling the both conditions, then only you can recognize the intangible asset in your books of accounts. Now please understand, there are assets in which you are having the combination of the tangible plus intangible both. If I can give you an example, if I am purchasing the tele software, then tele software is apparently installed on the CD. So simply, it includes the tangible and the intangible element both. Simple, whenever any asset includes both the tangible and the intangible element, then whether you have to bifurcate or not, that is totally depends on the judgment. We have to check the predominant factor. Simply for academic purpose, if I bifurcate, let's understand. If the value of the storage device is material, then you have to bifurcate the asset into the tangible and the intangible. But if the value of the storage device is not material, then entire asset will be considered as an intangible asset. It will be clear. If you are purchasing the intangible asset, then what expenses should be capitalized? Purchase price, import duties and the non-refundable taxes and the direct attributable expenses. If in the purchase price some duty or taxes is included, and if you are eligible to take the credit or refund of that duty or taxes, then it should be deducted from the purchase price. But if in the purchase price some duty or taxes is included, and if you are not eligible to take the credit or refund of the duty or taxes, then it should not be deducted from the purchase price. If in the purchase price some trade discount is included, then obviously it should be deducted from the purchase price. But if in the purchase price some cash discount is included, then it should not be deducted from the purchase price. One more important thing, if you are purchasing the intangible asset today, but if you are deferring your payment, then whatever amount you are paying is an extra amount, then it will be considered as a borrowing cost and then it should not be capitalized with the intangible asset. Next point. If you are receiving any government grant for the intangible asset, then you should follow Ind AS 20. If it is a non-monetary grant, you should pass an entry intangible asset account debit to deferred government grant, and the balance of the deferred government grant should be transferred into the P&L in the ratio of the amortization. Clear? If you are exchanging of any of the intangible asset, then simply we will follow the same rule which was followed in the Ind AS 16 property, plant and equipment. And for exchange of the asset, you know very well what is our rule. If any two assets are exchanged, then the rule is very clear. That is nothing but the new asset will be recorded at a fair value of the asset given or fair value of the asset taken, whichever is more clearly evident. And how can we determine that this asset is a more clearly evident? Simply friends, as per Ind AS 113 definition, Ind AS 113 is following the concept of the exit price, and if they are following the concept of the exit price, one thing is very clear, we can determine that the fair value of the asset given will be the more clearly evident. Clear? Okay. But yes, we are having some exceptional rule also. And which are the exceptional rule? If the transaction lacks the commercial substance, or if you are not having any of the fair value, then friends, in that situation, you should record the new asset at the book value of the asset given, less cash received, if any. Clear? And when we can say that transaction lacks the commercial substance, simple, we can say that transaction lacks the commercial substance only and only if your future cash flow is not changing. If your future cash flow is not changing, then only you can say that your transaction lacks the commercial substance. Clear? Next point is that if you are acquiring any asset at the time of the business combination, then simply friends, please understand what I am trying to convey. If it may be possible, some asset is a self-generated asset in the books of the seller. That's why they have not recorded that asset in that books of accounts. But yes, you are purchasing this asset today. And if you are purchasing this asset today, simply you can recognize that asset. Simple, whether we will not check whether the asset was recognized in the books of the seller or not, but you can recognize asset. Then research and development is again main topic. Friends, what is the meaning of the research? Research is nothing but the gaining of the knowledge. Friends, research is nothing but the gaining of the knowledge, but development is nothing but the application of the knowledge. Whatever expenses is incurred on the research phase is directly charged to P&L. But whatever expenses you are incurring on the development phase, it should be capitalized. But friends, please understand, at the time of the capitalization, you should consider that simply you can capitalize up to the present value of the future cash flow. How can we determine that my research is completed and the development phase is started? Yes, there are some conditions for that. Please understand. First, technical feasibility of the product, approval of the management is needed, financial resources should be available, and you are expecting the future economic benefits from that. Clear? Then selling overhead, admin overhead, general overhead, training costs will not be included. That's a very easy topic. Don't worry at all. Okay. For subsequent measurement, you are having two choices. You can use either the cost model or you can use the revaluation model. Whatever you are following, it's completely choice of the entity. Whenever you are following the cost model, you should disclose the asset at a cost minus accumulated amortization minus accumulated impairment loss. But if you are following the revaluation model, same as it is, don't worry. What we have discussed in Ind AS 16, you should follow that. Amortization is actually systematic allocation of total cost of intangible assets over its useful life. Amortization, it's actually depends on the future consumption ratio. But if it is not available, then on the SLM basis. Understand that whenever you are doing the amortization, residual value is ignored. If it is a guaranteed residual value, then only we will take, otherwise we will not take. Next point is that maximum useful life, no concept. Whatever the useful life you are taking, you have to provide the justification. And if any intangible asset is having the indefinite useful life, that is never and ever amortized, it is only tested for impairment. Clear? So this is the end of Ind AS 38 also. Now friends, let us start Ind AS 40, and the name of Ind AS 40 is nothing but the friends investment property. Friends, you know very well, actually for the recognition of the fixed asset, rather tangible fixed asset, or rather fixed asset only, we have basically three Ind AS. Ind AS 16 is related to property, plant and equipment, in that we are recognizing the tangible fixed asset. Ind AS 38 is specifically for the intangible asset, and Ind AS 40 is if we are giving the land or building on a let out, simple, then it will be covered under the Ind AS 40. Clear? So basically, first of all, let's discuss the definition of the investment property. Whenever I am using the word, friends, investment property includes land or building or both, is specifically occupied to earn rental or the capital appreciation rather than used in the production of goods or the rendering of services or for administrative purpose or for sale, simple, in that situation your Ind AS 40 will be applicable. If I tell you, for Navkar Digital Institute, we have the number of building, and that building we are using for the commercial activities, means we are using that building for the coaching to the students, simple, then that building will be considered as a property, plant and equipment, and that will be accounted under Ind AS 16. But it may be possible we are having one building, that building is actually let out. And if that building is let out, then that building will not be considered as a property, plant and equipment. That building will be considered as an investment property. And if it is an investment property, in that situation, friends, your Ind AS 40 will be applicable. So if you are using your own land or building for the commercial activity, then simply it will be considered as a property, plant and equipment, and Ind AS 16 will be applicable. But if you are using your own building for the let out purpose, then it will be considered as an investment property and your Ind AS 40 will be applicable. Owner occupied property is nothing but the property held by the owner or the lessee under the finance lease for use in production of goods or the rendering of the services. Clear? Now friends, it may be possible you are having the one building. In a one building there are different floors, and you are using that different floor for the different purposes. Sir, can you give an example? Answer is yes. I am having the building. That building is having, let's say, 3 floors. I am using one floor for my commercial activity, and the remaining 2 floors is, friends, actually let out. My question is, can I say I am using one portion of the building for the commercial activity? So actually apparently it's a property, plant and equipment, but I am let out 2 floors, so apparently it will be considered as an investment property. My basic problem is that whether I should bifurcate that particular building into the 2 different scenarios. Yes, if you can sell each portion separately. If you can sell each portion separately, 110%, entire building will not be considered as a property, plant and equipment or the investment property. One floor will be considered as a property, plant or equipment, and the remaining 2 floors will be considered as an investment property. But yes, friends, if each title or rather each floor is not separately sellable, then simply we have to check if we are using the significant portion for the owner occupied, then entire property will be considered as an owner occupied property. I am having the 2 examples. If entity used in property both for the production purpose and leases out the balance, then if 2 properties can be sold separately, each is accounted appropriately. Clear? Friends, we are having the 15 floors. Out of 5 floors, we are out of 15 floors, the 5 floors we are using at our office. Remaining 10 floors are leased out to tenants. Clear? So simple in that situation, and if I can sell, a company could sell the legal title to the 10th floor while retaining the legal title to other 5 floors. In this case, 10 floors will be considered as an investment property and the 5 floors will be considered as a property, plant and equipment or owner occupied property. But yes, friends, you should understand that if operations cannot be sold separately, then entire property is treated as an investment property only if insignificant proportion is the owner occupied. Is it clear? Second case. Sometimes we are giving other services to our customer. If I am talking about, if the value of the services is significant, if the value of the services is the significant, then it will be considered simple. It will be considered as the property, plant and equipment. But if the value of the services is not that much significant, or we can say it's insignificant, then in that situation, it will be considered as an investment property. Sir, can you give an example? Yes, answer is yes. Friends, let's say I am a Taj group. I am having the number of hotels. Actually, in a hotel, we are providing the room on the rent. But can I say we are not just providing the room on the rent, we are providing various ancillary services related to that. Simple. If we are providing the various services, and actually if you check, that the value of that services is so much material. And if the value of the services is a material, friends, you should understand that, simple, that building, that hotel building will be considered as a owner occupied property or the property, plant and equipment for that hotel group. But clear? But friends, if I am giving one building or one office building on the rent, and with that I am just providing one services, and that is nothing but the security services. Can I say, if you know, the value of the security services is not so much material, and if the value of the security services is not so much material, that office building will be considered as an investment property. Clear? Entity provides ancillary services to the tenants. If the services are insignificant, means it's not so much important, then the building will be considered as an investment property. But if the services are significant, then it will be considered as a owner-occupied property. Clear? Now, I am taking various examples for the investment property. If you are purchasing a land, and if anyone asking you why you have purchased this land, your intention is very clear. You are occupying that land for the long-term capital appreciation, and your planning is not to sell in the short term. Then simple, that land will be considered as an investment property. If I am purchasing a land or building and my purpose is not yet fixed, means it is for the currently undetermined for the future use. Problem is that you are not telling a purpose to everyone, but your hidden purpose is nothing but you want a capital appreciation from that property. And if you want the capital appreciation from that property, please understand, it will be considered as an investment property. Clear? I am having the building, and that building is actually given on the rent to the various tenants. It's simple. That building will be considered as an investment property. Clear? And I am constructing one building, and my purpose is very clear. I am constructing that building for the giving the let out purpose. Simple. Then again, it will be considered as an investment property. Clear? Second case. After that, you have to consider the recognition criteria for the investment property. When you can recognize the investment property in your books of accounts, friends, if you are fulfilling the two conditions. Number one, the cost of the investment property can be measured reliably. And second condition, it is expected that future economic benefits will flow to the entity. If you are fulfilling all the two conditions, then I can tell you, you can recognize the investment property in your books of accounts. And now I am starting with the initial recognition. Friends, initially every investment property shall be measured at a cost. If you are purchasing the investment property, what expenses will be capitalized? It is exactly as per Ind AS 16, that is called the property, plant and equipment. And you should capitalize the purchase price, directly attributable cost, and the present value of the dismantling or the restoration cost. One thing is very clear. If in the purchase price some duty or taxes is included, and if you are eligible to take the credit or refund of the duty or taxes, then it should be deducted from the purchase price. But if in the purchase price some duty or taxes is included, and if you are not eligible to take the credit or refund of the duty or taxes, then it should not be deducted from the purchase price. If in the purchase price some trade discount is included, then obviously it should be deducted from the purchase price. But if in the purchase price some cash discount is included, then it should not be deducted from the purchase price. If you are purchasing investment property today, but you are making you are deferring your payment. If you are deferring your payment, then simply, friends, please understand what I am trying to convey. You can recognize just the cash price. Interest expense is not at all capitalized. Is it clear? Number two, if you are exchanging in any investment property, then again you should follow the same rule which was there in the Ind AS 16. At the time of the exchange of the property, new property will be recognized at the fair value of asset given or the fair value of asset taken, whichever is more clearly evident. You know very well, for the fair value we will check the Ind AS 113, and the fair value is nothing but the fair value is the price that would be received when asset is sold, that would be paid when the liability is transferred in an orderly transaction between the market participants on a measurement date. So simple. Ind AS 113 is always following the exact price approach. Clear? And obviously whenever you are in the question, you are having the both fair value of asset given and the fair value of asset taken. Normally for you, fair value of the asset given is a more clearly evident. Clear? If we are taking out any investment property on a lease, then simple, this is old, you should follow the Ind AS 116. Clear? This is the initial recognition. After initial recognition, I am discussing the subsequent recognition. Friends, please understand. As per Ind AS 16, for the property, plant and equipment, for subsequent recognition, we are having the two options. We can use the cost model or we can use the revaluation model. As per Ind AS 38, intangible asset, again for the subsequent measurement, we are having the two options. We can use the cost model or we can use the revaluation model. But friends, please understand, for investment property, you are only having the one option, and simply that is nothing but it will be continued at a cost. And cost means cost minus accumulated appreciation minus accumulated impairment loss. Revaluation of the investment property is a prohibited. But yes, Ind AS 40 actually encouraged to all the entities to disclose the fair value of the investment property in the notes to accounts. Remember, fair value is not required for the accounting purpose. Fair value is just required for the disclosure purpose. Clear? Okay. It may be possible I am purchasing any property today as an investment property, means I am giving that property today on the rent, But in the future, it's now time my business is expanding, so I want that property for my commercial purpose. So can I say I am transferring that property from 40 to 60? It may be possible I purchased that property and I am giving on the rent, so that's why today it's an investment property. But tomorrow it may be possible I am transferring that property for the sale of the business, and simple, it's in my normal course of business. So I am transferring that property from Ind AS 40 to 2, means from the investment property to inventory. It may be possible today I am using that property, but now I don't want that property. That's why I am giving that property on the rent. So it's a transfer from the property, plant and equipment to investment property. Clear? Simple, friends. Whenever you are transferring your property to investment property or transfer from investment property, it shall not change the carrying amount. It is transferred at existing carrying amount only. Clear? Obviously, there are students who are discussing that. Depreciation and the impairment is a mandatory for the investment property. Some students are thinking that that's an investment, that's why we are not providing the depreciation. Answer is no. We are providing the depreciation on investment property also, because if I check the basic nature of that property is a land and building, and if it's a land and building, we have to provide the depreciation. Clear? Disclosure, it's not important for the revision purpose, so let's ignore it. Clear? Okay. Now next step, that is nothing but my Ind AS 41. And friends, the name of Ind AS 41 is nothing but the agriculture. Clear? It's again the one of the easiest Ind AS, and let's discuss what I am trying to convey. Whenever I am using the word agriculture, this is a new Ind AS. Till date, actually the agriculture products are carried at a historical cost only. But after Ind AS, now the concept is changed, and now everything is at a fair value. And whenever I am using the word everything is at a fair value, so please remember, first of all, I am discussing non-applicability. If you are using any of the land for the agriculture activity, then your Ind AS 41 is not applicable, because land is nothing but my tangible fixed asset. If it's an owner-occupied property, then I am using the Ind AS 16 for accounting of that land. But if my land is given on the rent for the agriculture activity, then that property will be considered as an investment property for me, and I will use the Ind AS 40. Next, bearer plant related to agriculture activity. Friends, please remember, under Ind AS 16 it is covered. If you remember my non-applicability point of the Ind AS 16, and that was the first point, biological asset related to agriculture activity other than bearer plant, means on bearer plant your Ind AS 16 is applicable. But at that time under Ind AS 16 I clearly given you, Ind AS 16 is only applicable to the bearer plant, but it is not applicable to the produce of the bearer plant. So where that produce of the bearer plant covered, that produce of the bearer plant is covered under Ind AS 41, and that's why I clearly written here, it applies to the produce on the bearer plant. Means mango tree is accounted in Ind AS 16, but the produce of the mango tree, means the mango, is accounted under Ind AS 41. Clear? Third, let's remember Ind AS 20 and the non-applicability point of the Ind AS 20. Accounting for the government grant and the disclosure of government assistance means Ind AS 20 is not applicable to tax exemption, tax deduction, government participation, and the most important point, any government grant which is related to the bearer plant. And I already told you that, any government grant is related to agriculture activity, and if any government grant is related to agriculture activity, that will be covered under the scope of the Ind AS 41. If you are having any license, means if you are having any intangible asset related to agriculture activity, it's an intangible asset, and whenever it's an intangible asset, it will be covered under Ind AS 38. If you are taking any land on a rent, simply it will be considered as a lease, and whenever it's considered as a lease, our Ind AS 116 is applicable. Clear? Basically, if you ask me, in this particular Ind AS 41, we will learn three things. One is nothing but the accounting of the biological asset. Second is nothing but the accounting of the agriculture produce at the point of harvest. And the number three is nothing but the government grant related to agriculture activity. But before that, you have to understand the basic definition. First of all, what is the agriculture produce? Friends, agriculture produce is nothing but the harvested product of the entity's biological asset. Clear? So friends, simply, if I am harvesting the mango from the mango tree, then it will be considered as an agriculture produce. Clear? Next, what is the group of the biological asset? It is an aggregation of the similar living animals of the plant. What is the meaning of the harvest? Harvest is nothing but the detachment of the produce from biological assets. Clear? Now, number of students are confused. Biological asset, agricultural produce, and a product that are the result of the processing after harvest. Clear? If I am discussing the sheep is considered as a biological asset and it will be covered under the Ind AS 41. From sheep we are getting the wool yarn. That yarn is considered as an agricultural produce at the point of the harvest and it will be again in the scope of the Ind AS 41. But by using yarn, if we are making the carpet for our normal ordinary course of business, then friends, it will be considered as our inventory, and whenever it's considered as an inventory, friends, our Ind AS 2 will be applicable. Clear? If it's a mango tree, actually mango tree is a biological asset because it's a living plant. But can I say it also fulfills the definition of the bearer plant? That's why, please understand, biological asset is a wider term. And if you ask me, biological asset includes the term bearer plant. I want to speak one line. All bearer plants are actually a biological asset, but all biological assets are not a bearer plant. If it fulfills the definition of the bearer plant, then it will be covered under the scope of the Ind AS 16. But if it not fulfills the definition of the bearer plant, then it will be considered as an agricultural produce or the biological asset and it will be covered under the Ind AS 41. I am discussing this particular point. If it's a mango tree, then simply it fulfills the definition of the bearer plant, and if it fulfills the definition of the bearer plant, then it will be covered under the definition of Ind AS 16 property, plant and equipment. From that mango tree, if we are receiving the mango, then it will be considered as an agricultural produce, and if it is an agricultural produce, then it will be covered under the Ind AS 41. But from that mango, if we are selling the mango juice or the fruity in our normal ordinary course of business, and if it is our normal ordinary course of business, then it will be considered as an inventory and covered by Ind AS 2. If I discuss this example, dairy cattle, it's a biological asset, and if it is a biological asset, simply it will be covered under the Ind AS 41. If we are receiving the milk from the dairy cattle, one thing is very clear, that milk is considered as an agricultural produce, and if that milk will be considered as an agricultural produce, it will be covered under the definition of the Ind AS 41. But if we are selling the cheese from that milk in our normal ordinary course of business, then it is our inventory and our Ind AS 2 will be applicable. Now, I am starting the 2 points, accounting of the biological asset and the accounting of the agricultural produce at the point of the harvest. The both will be similar. Initially, it will be recorded at a fair value less cost to sale. Friends, please understand, whenever I am using the word the fair value less cost to sale, fair value is as per the Ind AS 113, and the cost to sale includes any necessary cost incurred for selling that particular biological asset or the agricultural produce. Clear? But friends, understand, in selling cost, we will not consider the transportation cost, because transportation cost is not related to selling cost. Clear? You can sell this particular product in the current location also. So transportation cost is never and ever considered as a selling cost. This is my initial recognition. Subsequent measurement is also same, and you should value at a fair value less cost to sell. And please understand, whenever we are valuing anything at a fair value, depreciation is not allowed, and that's why we are not recognizing any depreciation on the biological asset. Clear? But yes, in some situation, it may be possible, you cannot determine the fair value. And if you cannot determine the fair value, please understand what I am trying to convey. In that situation, you should recognize the biological asset or the agriculture produce at the point of the harvest at a cost. But at every reporting date, you should try for finding out the fair value. And if you are trying for finding out the fair value, please remember my word. Once fair value is determined, then it's confirmed. You have to determine the fair value on every reporting date. It may be possible, we have purchased the one biological asset and at that time my fair value less cost to sale is 100. And on the reporting date, means at the time of the subsequent measurement, we have to again value at the fair value less cost to sell. There are two possibilities. My fair value is nothing but the 105 or my fair value is nothing but the 95. If my fair value is increasing, that's why my asset is increasing. And if my asset is increasing, then it's considered as a gain. Whatever that it may be a gain or the loss, it's directly transferred to P&L. Clear? So any gain or loss at the time of initial recognition, or at the time of the subsequent recognition, it should be charged to P&L. Now please remember, I am purchasing one bullock. And you know very well that bullock will be considered as an agriculture activity. And friends, if that bullock will be considered as an agriculture activity, my question is bullock is considered as a biological asset. And if that bullock is considered as a biological asset, one thing is very clear, that biological asset is carried at, that biological asset which will be valued at a fair value less cost to sell. Is it okay? Now I am getting calf because of the natural process. I have not incurred any cost. So simply, that is again initially valued at fair value less cost to sell, and whatever the gain or loss is directly transferred to P&L. Clear? If we are receiving the harvest, because of the harvest, if we are receiving the milk, then simply it will be considered as an inventory, and we have to pass an inventory account debit to P&L account. Clear? Next point, this was already covered. Perfect. Okay. Now I am starting for the government grant related to agriculture activity. Friends, there is a difference between Ind AS 20 and Ind AS 41. Please remember. What is the basic logic in Ind AS 20? If we are receiving the grant of rupees 100 today, let's say for the 5 years, according to Ind AS 20, at every year we can credit rupees 20 in our statement of profit and loss. But if you are receiving any government grant for the related to agriculture activity, which is measured at a fair value, 99% it is at a fair value only, then simply, if you are receiving the amount of the grant of rupees 100 today for the 5 years, you cannot credit the statement of profit and loss by rupees 20 at every year. You can credit your P&L at the end of the 5th year only when your all condition is satisfied. Clear? So I have prepared one chart for that. If your biological asset is measured at a fair value less cost to sell, if it is obviously unconditional grant, directly credit it to P&L. But if it is a conditional grant, then you can credit that grant in the P&L only when conditions attaching to that government grant was already met. But you know very well, sometimes if fair value is not readily measurable, we can recognize our biological asset or our agricultural produce at the point of the harvest at a cost. If you are measuring at a cost, then you should follow the Ind AS 20 only. Clear? Friends, in the November 19 paper, they have asked one question that is relating to merged with Ind AS 20 with Ind AS 41. So you should focus this particular point. Clear? Next thing. This is the most important point. Let's assume I am purchasing one cow on 1st April 2020. And at that time, the value, fair value less cost to sale of the cow is nothing but the 100 rupees. And initially, I will recognize this cow or this biological asset at a fair value less cost to sale, means at rupees 100 only. But can I say for the subsequent measurement, means on the 31st March 21 also, I have to measure this particular biological asset at a fair value less cost to sale only. Now, on 31st March 21, if I consider the value, fair value of the cow having age of 3 years is, let's say it's a 105. But the fair value of the cow of the age, age having 4 years, it's let's say 108. So whether I should compare 100 with the 105 or 100 with the 108, your logic is very clear. Because on 1st April 20, if the age of the cow is 3 years, so after 1 year, obviously it becomes 1 year older. So now the age of the cow is a 4 years. So I cannot compare with the 3 years. I should compare with the 4 years. So don't you think so? My fair value is increased by rupees 8. But as per Ind AS 41, this 8 rupees is increased is because of the price change and because of the physical change. I had purchased this cow for the age having 3 years at rupees 100 on 1st April 20. If I want to purchase this cow who is having the age of 3 years today, means on 31st March 21, Price is not 100, price is 105. So can I say this 5 rupees is increased because of the change in the price? But today the price of the 4-year cow is nothing but the 108. So can I say I am having the two options. If I want to purchase the cow of the age having 3 years at rupees 105 or the age having the 4 years it's 108. So can I say they are demanding the 3 rupees extra is because of the age only. So simple, 3 rupees considered as a physical change. In the notes to accounts, you have to disclose the change in the fair value because of the price change and because of the physical change in your notes to accounts. Clear? So simple, this is the Ind AS 41. We will disclose the various disclosures like it is presented separately on the face of balance sheet. Any gain or loss, any restriction, commitment, that all the disclosures are necessary. Clear? Perfect. Can I go ahead? So finally my Ind AS 41 is also done. Now friends, we are starting with Ind AS 101 and the name of Ind AS 101 is nothing but the first time adoption of the Ind AS. First time adoption of the Ind AS. Clear? Okay. So let's discuss the first time adoption of Ind AS. Please focus here. What are the basically objective? From the 2015 we are giving the voluntary phase for adoption of Ind AS. And from the 2016 and 17 friends, it's a mandatory phase. Means whenever you are adopting the Ind AS for the first time, can I say till date you are preparing your financial statement as per the accounting standard? But now you have to convert your financial statement as per the Ind AS. And that's why we are preparing 3 balance sheet, rather we are preparing the opening balance sheet at the time of the preparation of the Ind AS 101. That Ind AS 101 basically explain this was the accounting treatment as per the accounting standard. This is the accounting treatment as per the Ind AS. Now whether you should provide that effect prospectively or the retrospectively, and if you are providing such effect, then can I say 110% your value is changing as per the accounting standard and as per the Ind AS. And if the value is changing, the difference is transferred to some asset or liability and the corresponding effect is given to the retained earning. So that is explained by the Ind AS 101. So if we consider the basic objective of Ind AS 101, simple. It explains the process of transition to Ind AS. This word is the most important. If I am adopting the Ind AS from the 1st April 2016, my first balance sheet will be on the 31st March 17 with compared to 31st March 16 with compared to 1st April 2015. 31st March 17, 31st March 16 and the 1st April 2015. Clear? So effectively, if you can check, my applicability date of the Ind AS is 1st April 2016. But my transition date to Ind AS will be the 1st April 2015. Clear? Ind AS 101 remove the difficulties and the retrospective application of certain Ind AS, and it also suggests the accounting treatment from the resultant difference. Clear? Okay. Simply friends, Ind AS 101 is only helpful at the time of the first Ind AS financial statement. Whenever I am using the first Ind AS financial statement, it may be possible this is the first annual Ind AS financial statement or interim financial report for that period, means simply I am talking about the Ind AS 34. If I am adopting Ind AS from the 1st April 2016, then Ind AS 101 is helpful to me at the time of the preparation of annual financial statement for the year 2016-17 and all the interim financial statement of the year 2016-17. Clear? Basically, we are covering 4 things, and that was given under the para 10 of the Ind AS 101. And which are the 4 things? Please remember what I am trying to convey. It may be possible some assets were not recorded in accounting standard, but that assets recognition is required as per Ind AS. Then you should record that asset. Best example. There was no concept in accounting standard 26 like Ind AS 38. I am discussing that concept. As per Ind AS 38, it may be possible some assets are the self-generated asset in the books of the seller company. That's why they have not recorded that asset. But buyer company is paying a consideration for acquiring that asset. So 110% buyer company can recognize that particular asset in the books of accounts, and best example is nothing but the customer list. That was not there in accounting standard 26. So if anything was not an asset or liability as per the accounting standard, but now the recognition of that asset or liability is required as per Ind AS, then you have to record that particular point. Clear? Next, second situation. Something which was there in accounting standard, and you are recognizing that particular thing as an asset or liability in the accounting standard. But now that particular thing is not an asset or liability as per the Ind AS. Best example. Actually, this example is not now valid, but just I am giving. Under the accounting standard 4, before 2016, we are recognizing the one liability in the name of the proposed dividend. In the name of the proposed dividend. You know very well. Now also accounting standard 4 is changing. But yes, as per Ind AS 10, there is no concept of the proposed dividend. Now we are only having the one concept, and that is called the declared dividend. So we cannot recognizing that proposed dividend now as per Ind AS. Next, reclassify the item of the assets or liability as per the Ind AS. And I am having the best example. If you are having the redeemable preference share, then that redeemable preference share was disclosed under the heading of the share capital in accounting standard. But now that redeemable preference share is nothing but your financial liability, and it should be disclosed in the financial liability. So we are just reclassifying the item. And the number 4. Something which was an asset or liability as per accounting standard, which is an asset or liability as per the Ind AS, but the recognition principle is different. Best example. As per accounting standard 29, provisions, contingent liability and the contingent asset, we are never and ever discounting any of the long-term provision. But can I say now as per Ind AS 37, provision discounting is required, and we are recognizing any provision at a present value. So obviously we have to apply the Ind AS for measuring of all of the assets or liability. So basically, if you ask me, there are 4 things. Number 1, something which was not asset or liability as per accounting standard, but which is now asset or liability as per the Ind AS, you have to record that. Number 2, which was an asset or liability as per accounting standard, but now the recognition of that asset or liability is not supposed to there as per Ind AS, then you have to remove that. Something which was asset or liability as per accounting standard, which was asset or liability as per the Ind AS, but the classification is at a different place, simply you have to reclassify as per Ind AS. And the number 4, in both accounting standard and the Ind AS, it is an asset or liability. But the problem is that the measurement principle is different, then you have to follow that measurement principle. Clear? Next point, friends, you have to follow the same accounting policies in the opening Ind AS balance sheet and throughout all the reporting period. And if any difference was there in the accounting standard in the Ind AS, then that difference is transferred to the retained earning. Clear? Basic principle is like that. Ind AS 101 requires an entity adopting Ind AS for the first time to adopt Ind AS retrospectively. That is, as if entity complying with Ind AS right from its beginning, subject to practicality, exemption and other exemptions specifically given in Ind AS 101. Now friends, please understand what I am trying to convey. There are 2 types of exemption. One is nothing but the mandatory exemption, and the second is nothing but the optional exemption. Whenever I am using the word the mandatory exemption means retrospective application is prohibited. It prohibits retrospective application. Means for mandatory exemption, you should compulsorily provide the prospective effect. Retrospective effect is not at all required. Second type of exemption will be considered as an optional exemption. Whenever I am using the word the optional exemption means you are having a choice. You can provide the retrospective effect or you can provide the prospective effect. If something was not there in the list of the mandatory exemption and in the list of the optional exemption, one thing is very clear. For that matter, you should compulsorily give the retrospective effect only. I am again repeating 3 things. For mandatory exemption, retrospective effect is at all prohibited. For optional exemption, you are having the 2 choice. You can provide the retrospective effect or you can provide the prospective effect. If something which was not covered in the mandatory exemption and which was not covered in the optional exemption also, for that matter, you should compulsorily give the retrospective effect. Clear? So now I am starting with the mandatory exemption, means for the following things, retrospective effect is prohibited. Number 1, derecognition of the financial asset or the financial liability. Sample that Ind AS 109 criteria is following always prospectively. Number 2, non-controlling interest. Friends, under Ind AS we are using the word the non-controlling interest. But under accounting standard there was the word called the minority interest. And as per accounting standard 21, minority interest balance is never and ever negative. But it may be possible under Ind AS this is allowed. Minority interest means rather non-controlling interest can be negative. So under accounting standard there was a different treatment. Okay, never and ever minority interest is not having the negative balance. But under Ind AS 110, the non-controlling interest is maybe having the negative balance. So in that situation, for that matter, we have to provide the prospective effect. So if we consider, a first-time adopter shall apply the requirement of Ind AS 110 regarding the total comprehensive income is attributable to the owners of parent and the non-controlling interest, even if results in the non-controlling interest having the deficit balance. Next point is nothing but for the classification and measurement of financial asset. You know very well, financial asset, there are 3 instruments, debt, equity and derivative. And you can use the accounting method for the amortized cost method or the FATPL or the FATOCI. Clear? That should be done prospectively. So an entity shall assess whether a financial asset meets the condition in para 4.1.2 amortized cost or para 4.1.2a of Ind AS 109 on the basis of facts and circumstances at the date of the transition to Ind AS. Clear? Number 4. That is nothing but the impairment of financial asset. Again, impairment of financial asset is a prospectively. Clear? 5th, government loan. Sometimes you know very well, if you are receiving any government loan at a concessional rate of interest, then you should ensure that whenever you are receiving the government loan at a concessional rate of interest, you are bifurcating into the 2 parts. That's called the liability and the equity. And whenever you are bifurcating these 2 parts, that should be done prospectively. Clear? A first-time adopter shall classify all government loans received as a financial liability or the equity instrument in accordance with Ind AS 32. Clear? Exemption from the re-estimation with the inside information. Again, prospective, just I am reading. Estimates on date of transition to be made as per the information that was available on the date of transition without updating it with subsequent information obtained. Hence, Ind AS prescribes estimates taken under previous gap to be assumed to be a correct basis for the accounting unless it is evident there was an error. If error detected, then retrospective application is adjusted. Clear? Now I am starting with the optional exemption. And the optional exemption is nothing but, friends, please remember what I am trying to convey. You can do the retrospective effect or you can do the prospective effect. And first exemption is nothing but from the business combination. You know very well. Under business combination now, under accounting standard 14, we are having the 2 methods. One is nothing but the amalgamation in the nature of merger and second is nothing but the amalgamation in the nature of purchase. In Ind AS 103, we have actually 2 methods. That is called the acquisition cost method and second is nothing but the pooling of the interest method. One is acquisition cost method and second is nothing but the pooling of the interest method. Now one thing is very clear, whether you want to follow the acquisition method or the pooling of the interest method, that is depends on the situation. You can use the pooling of the interest method only if you are merging the 2 companies which are belonging from the same group. Otherwise that is not allowed. Yes or no? So my problem is very clear. Whenever you are doing the business combination, you have to restate the past business combination. But yes, if you are restating any one past business combination, then you have to restate all the business combination. Clear? So let's read. A first-time adopter may elect not to apply Ind AS 103 retrospectively to past business combination. However, if restates any business combination as per Ind AS 103, it shall restate all the later business combination. Clear? Number 2. That is for the dimmed cost. An entity may elect to measure an item of PPE or the intangible asset at the date of transition to Ind AS, either at a fair value or at the previous gap carrying amount. Clear? You can consider the fair value of that particular asset, or if you don't want to consider the fair value, simply you can continue with the previous gap carrying amount. Clear? Number 3. Next is cumulative translation difference. Friends, at the time of the transition of Ind AS, it may be possible at the time of the conversion of the foreign operation, you are having the balance of the foreign currency translation reserve. You can continue that balance of the foreign currency translation reserve further, or if you don't want to continue with the foreign currency translation reserve, let's assume that balance is nothing but the zero. Clear? So let's read. Ind AS 21 requires an entity to recognize some translation difference in OCI and on disposal of foreign operation reclassified that difference from equity to P&L. However, first time adopter need not comply with these requirements. If use this exemption, then the cumulative translation difference is zero and on the date of the transition. Clear? And the long-term foreign currency monetary item, simple. A first-time adopter may continue the policy adopted for the accounting differences arising from the translation of long-term foreign currency monetary item recognizing the financial statement as per accounting standard. Clear? You know very well. Under accounting standards, subsidiary is accounted as per the full consolidation. Joint venture is accounted as per the proportionate consolidation, but the associate is accounted as per the equity method. Under Ind AS, subsidiary is accounted as per the full consolidation, but the joint venture and associate is accounted as per the equity method. So under accounting standard, there was a problem of just the joint venture. Joint venture was accounted as per the proportionate consolidation method, and now you have to convert as per the equity method. So how can we convert? An entity shall recognize its investment in joint venture at transition date to Ind AS. Initial investment shall be measured as aggregate of the carrying amount of assets and liability that had previously included the consolidated goodwill. Perfect. Okay, these are the bulletin, not required at all. Now I am starting the new Ind AS, and that is nothing but most important. People are waiting for this, and that is Ind AS 32, 107 and the 109 with full focus. Please concentrate here. The name of Ind AS 32, 107 and the 109 is nothing but the financial instrument. If you ask me, the name of Ind AS 32 is nothing but the financial instrument presentation. The name of Ind AS 107 is financial instrument disclosure. And the name of Ind AS 109 is nothing but the financial instrument. I am covering all the three Ind AS together. First of all, what is a financial instrument? Friends, financial instrument is nothing but any contract. For one person, it is considered as a financial asset, but for the another person, it will be considered as a financial liability or the equity. So if I prepare one balance sheet, one side is very clear, it's a financial asset, but for the another side, it may be considered as an equity instrument, and here it will be considered as a financial liability. Friends, I use the one word that is called the contract. That contract is maybe the written contract. That contract is maybe the oral contract, or that contract is nothing but the implied contract, whatever the contract. Clear? Friends, on a one side, it is a financial asset, but on the another side, it may be possible, it is your financial liability, or it is your equity. So if it is a financial liability or the equity, we have to understand the basic difference between the financial liability or the equity. Friends, if it is a financial liability, when we can say that it's a financial liability, if you are having the contractual obligation to deliver cash or a financial asset. If I am purchasing goods on credit, and if I am purchasing goods on credit, I am contractually obliged to deliver cash. Or if I don't want to pay cash, I can do one thing. I can settle the account by paying my bills receivable, or I can tell to my creditor, please collect this particular amount from one of my debtor. So in that situation, I am not transferring my cash, but I am transferring one of the financial asset. Clear? Next is equity instrument. Friends, equity instrument is nothing but the residual interest in the net assets of entity. It is your residual interest. Whenever I am using the word the residual interest in the net assets, means it's after deducting all of its liability. After deducting all of its liability. So basically, whenever I am using the word equity, I am talking about the shareholders fund. Clear? Okay. Now we will discuss one by one the definition of the financial asset, financial liability, and the equity. Let's discuss first the definition of financial asset. Actually, I have written just the 4 things, but in the definition of the financial asset, basically 6 things are included. Number 1, cash including the bank balance. Number 2, that is nothing but the equity instrument of the another entity. Number 3, that is nothing but the contractual right to receive cash or financial asset of another entity. Number 4, contractual right to exchange financial asset under the potentially favorable conditions to the entity. Number 5, any non-derivative contract in settlement of which you are receiving variable number of the own equity instrument. Number 6, any derivative contract in settlement of which you are receiving own equity instrument other than for fixed number of share for the fixed amount of cash. Again I am repeating, other than for fixed number of share for the fixed amount of cash. Now I am taking one by one. First is nothing but cash including the bank balance. And I am having the best example, that is nothing but the bank fixed deposit. Bank fixed deposit. I am having the excess fund and I am depositing that excess fund into the bank fixed deposit. So it will be a financial asset for me, but for bank it's a financial liability. Sir, why it is a financial asset for you? Because I am having a contractual right to receive cash from the bank. And why it's a financial liability for the bank? It's a contractual obligation to deliver cash for the bank. Clear? Number 2, an equity instrument of another entity. Friends, if I am purchasing the share of Reliance, and if I am purchasing the share of Reliance, please understand that it will be a financial asset for me, but it will be considered as an equity instrument for the Reliance. Why it is a financial asset for me? Because I am investing my fund into the share. Number 3, contractual right to receive cash or financial asset of another entity. Best example. If I am selling my goods on the credit basis, and if I am selling my goods on the credit basis, one thing is very clear, from that data, it's my contractual right to receive cash. Or it may be possible, that data is not giving me a cash, but that data is giving me a one of the financial asset. Clear? Next one. It's my contractual right to exchange financial asset or liability under the conditions that are potentially favorable to the entity. And my best example, if I am purchasing the call option, and if I am purchasing the call option, I am having the right to buy, and I will exercise that right only if it is favorable to me. And obviously, whenever you are purchasing the call option, you are having the right to buy, but you will exercise that right only if it is beneficial to you. And whenever it's beneficial, if your market price exceeds the exercise price against the cash. Again I am repeating, if your market price exceeds the exercise price against the cash. Number 5 and the number 6 I will discuss at the time of the financial liability. And the number 5 is like this: any non-derivative contract in settlement of which you are receiving the variable number of the own equity instrument. And the number 6, any derivative contract for settlement of which you are receiving the own equity instrument other than for the fixed number of share for the fixed amount of cash. Clear? This is the definition of financial asset. So if we discuss financial liability, friends, in the financial liability basically there are 4 things. Financial liability is actually a contractual obligation. Number 1, to deliver cash or a financial asset. Friends, please understand, when I am talking about it, to deliver cash or a financial asset, so one thing is very clear, that is nothing but the creditor. If you are purchasing any goods on the credit, it's your contractual obligation to deliver cash to the creditor. Or if you don't want to pay the cash to the creditor, you can do one thing, you can transfer the financial asset. Number 1. Number 2, it's contractual obligation to financial asset with another entity that are potentially unfavorable to the entity. And whenever they are potentially unfavorable to the entity, means if you are selling your call option. And if you are selling your call option, the friends, please understand what I am trying to convey. At the time of the selling of the call option, friends, it's an obligation to sell. It's not your right to sell, but it's an obligation to sell. Clear? Number 3. Number 3 is nothing but it is any non-derivative contract in settlement of which you are receiving you are delivering the variable number of the own equity instrument, and it is any derivative contract for settlement of which you are delivering the own equity instrument other than for the fixed number of share for the fixed amount of cash. Means what I am trying to convey. Let's discuss first of all the equity instrument. Equity instrument is nothing but any residual interest in the net assets of entity after deducting all of its liability. Now friends, please understand. This is your consideration and this is your number of share. If your consideration is fixed, number of share is fixed. Consideration fixed, number of share is fixed. Then simply it will be considered as an equity instrument. But if your consideration is fixed, number of share variable, then it will be considered as a financial liability. Consideration variable, number of share fixed, again financial liability. And the consideration variable, number of share is again variable, then it will be considered as a financial liability. So simply, if you are passing the fixed to fixed test, and if you are passing the fixed to fixed test, then only it will be considered as an equity instrument. Otherwise, in all the situations, it will be considered as a financial liability. Clear? Okay, I'm having one example. You have taken a loan of rupees 50 lakh at the rate of the 12% for the 10 years. Interest is payable every year, but the principal amount is repayable at the end of the 10th year. Means you are making the bullet payment, and you have defaulted in the payment of the interest for the year 4, 5, 6 and whatever. Clear? As per the loans rescheduling agreement, you have to pay rupees 90 lakh at the end of the 8th year. Friends, you have taken a loan, and on that loan you have to pay interest every year. You are making a payment of the interest every year, but you have defaulted in the payment of interest in the 4th year. And if you have defaulted in the payment of the interest in the 4th year, friends, please understand your loan rescheduling agreement is at the end of the 8th year. And if your loan rescheduling agreement is at the end of the 8th year, what should you consider? Friends, remember my one line. Remember my one line. At the end of the 8th year, you are not supposed to pay just an original amount. They have demanded the rupees 90 lakh. So what should you do? You have to calculate cumulative interest. So 50 lakh and the cumulative interest at the rate of the 12% for the 5 years. So how it is 5 years? 4, 5, 6, 7 and 8. So actually apparently if I can check, my original amount is 88,11,708. But can I say people are demanding rupees 90 lakh? So 90 lakh minus 88,11,708. What is your additional amount payable? Friends, your additional amount payable is nothing but the 1,88,292. Clear? So this is financial liability. Now, I want to explain you that is nothing but about the financial liability in the equity. Friends, A Limited sold goods to B Limited on the 1st July 2015. Means my transaction date is 1st July 2015. And the amount is nothing but the 10 lakh. Payment will due actually on the 31st December 2015. Clear? Now please understand what I am trying to convey. If payment is due on the 31st December 2015 and you are not settling your obligation by payment of the cash, you are settling the obligation by payment of the equity share. But yes, no doubt we are actually making the payment by equity share, but first of all we have to check. We are making the payment as equivalent number of share. We are calculating the number of share as like total amount due divided by the market price as on 31st December 15. And in the second question, we are dividing by market price on 1st July 15. If we are making the payment of the number of share by dividing the amount due by market price on 31st December 15, I can tell you, I am using my share as a currency only. And if I am using my share as a currency, then in that situation, it will be considered as a financial liability. But if you are making the payment of total amount due by dividing the market price on the 1st of July 15, then in that situation, it will be considered as an equity instrument. Perfect. Now, I am starting the new topic. And the topic is nothing but the compound financial instrument. Whenever you are valuing the compound financial instrument, first of all, you should understand the meaning of the compound financial instrument. My word is very clear. Here one side, it's financial asset. But here another side, it's a financial liability or the equity. Whenever I am using the word it's a financial asset, I am talking about from the viewpoint of the holder. But whenever I am using the word it's a financial liability or the equity, I am using the word from the issuer. So this side is very clear because we have only one thing. But on the liability side, we are having the two things, that is nothing but the financial liability and the equity. So it's actually the combination. Compound financial instrument is basically a combination of the financial liability and the equity. We will use the substance over form. And whenever I am using the word substance over form, we will consider the real matter of the transaction and not the legal matter of the transaction. As for the reality, if some amount is payable in the future, and if the sum amount is payable in the future, please remember my one line, then simply it will be considered as a financial liability. But if some amount is not payable in the future, then it will be considered as an equity. Clear? If we check for the preference share. In the preference share, we have to make the payment of the dividend on a time-to-time basis. We have to make the payment of the principal amount after some particular years. That's why redeemable preference share is considered as a financial liability. Clear? Next, putable instrument. There are two words. One is nothing but the callable, and the second is nothing but the putable. Let's assume we are issuing the debentures or the preference share, whatever the situation, and for the 5 years. But yes, company is held with an option. Within 5 years, they can redeem their particular debenture or the preference share. Simple, in that situation, it will be considered as a callable. Issuer has the right to redeem before the maturity. Putable. Putable financial instrument is giving the right to the holder of the financial instrument to put back against the cash or any of the financial asset. So apparently, in the putable financial instrument, redemption right is with the holder of the financial instrument. That's why this will be considered as a financial liability. Why? If holder giving me a financial instrument, I am obliged to pay cash or any of the financial asset. So simply, in that situation, putable financial instrument is always considered as a financial liability. Clear? Okay. We are discussing the compound financial instrument. Please focus here what I am trying to convey. If it is a mandatorily redeemable preference share with a mandatorily fixed dividend, means we have to pay dividend on a time to time. We have to pay the principal amount time to time. If we are liable to pay the dividend and if we are liable to pay the principal amount, then in this situation, it will be considered as a financial liability. Clear? If it is a non-redeemable preference share with a mandatory fixed dividend, whenever I am using the word, it's a non-redeemable, means principal amount is not repayable. Principal amount is not repayable, but fixed dividend is payable. Then in that situation, it will be considered as a compound financial instrument. Clear? It will be considered as a compound financial instrument. Clear? But please understand, it would be compound instrument if the coupon was initially set at a rate other than prevailing market rate, or the payment of the discretionary dividend in addition to the fixed coupon. If the coupon on the preference share was set at a rate on the date of issue, entire instrument would be classified as a financial liability because cash flow is perpetuity. In compound financial instrument, if we check the next, that is nothing but the non-redeemable preference share with a dividend payment linked to equity share. Means this is nothing but the non-redeemable preference share but with a discretionary dividend. And friends, but if it is with a discretionary dividend, you have to focus that you are not contractually obliged to pay any of the dividend. There is no contractual obligation to pay dividend. You will pay dividend to the preference shareholder only if you are paying the dividend to the equity shareholder. Otherwise, you are not liable to pay. And if you are not liable to pay, simple, this will be considered as a compound financial instrument. Why it is considered as a compound financial instrument? It is considered as a completely equity instrument. Why? Because there is no obligation to pay dividend and there is no obligation to pay, that is nothing but the capital also. Clear? Next. I want to discuss that is nothing but the derivative instrument. Friends, whenever I am using the word the derivative instrument, means if your instrument fulfills all the three conditions, then that instrument will be considered as a derivative instrument. Number one, the value of the derivative instrument is changes in response to change in the value of the underlying asset. Number two, there is no initial investment or the very low investment in the derivative instrument. And number three, it is settled at a future date. Again, I am repeating, it is settled at a future date. Clear? So simple, in this three situation, if your instrument is fulfilling all the three conditions, I can tell you that instrument will be considered as a derivative instrument. Number one, its value changes in response to change in the value of the underlying asset. Number two, there is no initial investment or the very low investment. And the number three, its settlement is on the future date. Clear? Okay. If we go further, simple, in a derivative instrument, there are various types of the derivative instrument. It may be a forward contract, it may be a future contract, it may be option, whatever the situation. What is the meaning of if we discuss the forward contract? Forward contract is basically purchase or sale to a specific quantity of the underlying asset with delivery or settlement on a pre-agreed future date. And whenever I am talking about the option is basically a contract that gives the purchaser the right to buy or sell a specified quantity of a particular financial instrument. Clear? Okay. Now I am starting with the accounting of the compound financial instrument, but before that, let's discuss equity share. In equity share, you are not having any contractual obligation for the principal. You are not having any cash obligation for the interest and the dividend. And obviously, there is no settlement in the fixed number of shares. So simple, equity share will be considered as an equity instrument. If it is a redeemable preference share with a fixed dividend, then it is nothing but a contractual obligation to pay principal, your contractual obligation to pay here dividend, and there is no settlement in the fixed number of the equity share. That's why that instrument will be considered as a completely financial liability. Redeemable preference share with a discretionary dividend. If it is a redeemable preference share with a discretionary dividend, there is a cash obligation for the principal. There is no cash obligation for the interest or the dividend, and the settlement is not in the fixed number of share. That's why this is a compound financial instrument, because for the principal it will be considered as a liability, but yes, for dividend this will be considered as an equity. Clear? If I consider the convertible bond option to convert into the fixed number of share, there is a cash obligation for the principal because it is not a compulsory convertible, it is just a convertible. There is a cash obligation for the interest and dividend, and the settlement is obviously in the fixed number of share. So it will be considered as a liability for the bond but equity for the conversion option. Clear? Can I go ahead? Okay. Now I am having the one example. ABC Limited issued 5,000 convertible debenture with a face value of ₹100 per debenture. Interest rate is 5%. Debenture is converted into the equity share at the end of the 4th year. Prevailing market rate 7%, bifurcate into the equity and the liability. First of all, you should determine that whether this is a compound financial instrument or not. In this case, you are issuing the convertible debenture. Friends, if you are issuing the convertible debenture, please understand what I am trying to convey. Whenever you are issuing the convertible debenture, one thing is a very clear, simple. There is a cash obligation for the interest. But this is a convertible, so means I don't know whether some people will demand the cash or some people will select the conversion option. So we will find out the cash flow, and that cash flow is nothing but 5,000 into 100 means 5 lakh, and the 5 lakh into 5% means it's a 25,000 rupees interest, and that 25 rupees interest into annuity factor, and friends, I will take the discounting factor of the 7%. Clear? Then simple, this is the present value, and rupees 5 lakh is payable at the end of the some particular years after 4 years, so this is the present value. If we consider total, this total will be considered as the liability component of the convertible bond, and the remaining portion means 5 lakh minus 466,175, 33,825 will be considered as the equity component of the compound financial instrument. Clear? Now please understand. Here we have financial asset, and here we have the financial liability, and here we have equity. For accounting of the financial asset, possibility, there are 3 possibilities. It may be accounted as amortized cost. It may be accounted at FET OCI, or it may be accounted at FETPL. Number 1, amortized cost. Number 2, FET OCI, and the number 2 is nothing but the FETPL. But financial asset is whether accounted as amortized cost or FET OCI or FETPL. That is totally depends on the business model of the entity, and that totally depends on the contractual cash flow characteristics of the particular financial instrument. Now we are checking what is the meaning of the business model. Sometimes at the time of the acquisition of the financial instrument, your business model is to just to hold that particular investment in order to collect the contractual cash flow. But sometimes your intention is not to just collect the contractual cash flow, but your intention is to collect the contractual cash flow plus the benefit of the fair value. Sir, can you discuss in detail? Yes. If let's say I am a company and I am giving a loan to my employee. Friends, if I am giving the loan to my employee, can I say that loan will be considered as a staff loan? And if it is considered as a staff loan, my intention is to just to collect the contractual cash flow from my employee. Means I will collect just interest and principal. Is it okay? But let's assume I am investing in the debentures of some listed company, and the debenture is also listed. And friends, if I am investing in the listed debenture, My intention is to collect the contractual cash flow, means I will receive the interest and the principal amount. But suddenly, if the market price of that particular debenture goes up, I will sell this particular debenture. And if I sell that particular debenture, and I will generate the cash. Clear? So simple. Friends, please understand what I am trying to convey here. Your intention you have to check. And in any of the business, there are two types of intention. One is nothing but your intention is to just to collect the contractual cash flow. And the number two, you will collect the contractual cash flow plus the benefit of the fair value. So if we discuss the example number one, and you have to just determine the business model. X Limited advances a loan to Y Limited for rupees 5 lakh at the rate of the 10% for the 5 years. So simply if I check, in this case, my business model is to collect the contractual cash flow, that is interest and principal. Is it okay? Second, if I check, ABC lends to customer and hold the contractual cash flow, but sometimes syndicate out portion of the loan that exceeds the credit approval limit. So two business model, part to collect contractual cash flow and part to sell. And what is the meaning of the contractual cash flow? Whenever you are investing your fund, you are taking the investment risk, you are taking the credit risk. We will consider the time value of money. So if your investment is just giving the interest and the principal amount, that is nothing but the solely payment of the interest and principal, then I can tell you, your investment fulfills the definition of the contractual cash flow. An entity shall assess whether contractual cash flows are solely payment of interest and principal. That is the currency in which the financial asset is denominated. Principal is the fair value at initial recognition. Interest consists the consideration for the time value of the money and the credit risk. Clear? Now please understand, I am preparing one simple chart that give you a better clarity. Clear? We are learning the accounting of the financial asset. In a financial asset, basically there are three types of instrument. That is nothing but the debt instrument. Second is nothing but the equity instrument. And the third is nothing but, friends, considered as a derivative. Whenever I am writing the word debt on the asset side, number of students are thinking, sir, you are talking about the liability. No, I am talking about the asset only. Whenever financial asset is a debt instrument, means what I am trying to convey, if you are giving the loan to someone, then that loan will be considered as a debt instrument. But for you, it's financial asset. But for the holder, for the issuer, it will be considered as a financial liability. I think you are clear with me. If I am purchasing the debenture of some company, then the debenture will be considered as a financial asset for me. But for that particular person, it will be considered as a financial liability. But the nature of the instrument of the debenture will be considered as a debt instrument. Is it okay? If I am purchasing the share of the Reliance, and if I am purchasing the share of Reliance, that will be considered as a financial asset for me. For me, it's financial asset, but for the Reliance, it will be considered as an equity. And please remember my one line. Please remember my one line. What I am trying to convey here, simply, I am purchasing the share. And if I am purchasing the share, the nature of the instrument will be considered as an equity instrument. If I am purchasing the call option, so I am having the right to buy, and I will exercise the right whenever it is potentially favorable to me. So that whenever I am purchasing the call option, it's nothing but financial asset for me. But can I say the nature of the instrument is considered as a derivative instrument? Because in the call option, your initial investment is very low. Its settlement is on the future date. And the value of the call option will change. That is, depends on the underlying asset. Clear? Now I am starting with accounting. If in the debt instrument your purpose is to judge the contractual cash flow, then accounting will be as per the amortized cost. But your purpose is nothing but the contractual cash flow plus you want to take the benefit of the fair value, then friends, your accounting should be at FET OCI, that is nothing but the fair value through other comprehensive income. And if you are in the residual category, means friends, if nothing is decided, then your accounting should be as per FETPL. If it is an equity instrument, and if your equity instrument is held for sale, then accounting will be at FETPL. But if it is a not held for sale, then friends, your accounting will be at FET OCI. And yes, this FET OCI is an irrevocable option. If you want to select, then you can. Otherwise, you can do the accounting at FETPL also. And whenever it's a derivative instrument is always accounted as per the FETPL. Now, please remember what I am trying to convey here. In debt instrument, if your purpose is to just to collect the contractual cash flow plus the fair value, then you are transferring the gain or loss into the OCI. It's okay. but for which reclassification to P&L is possible. But in the equity instrument, whenever it's not held for sale, and if you are selecting an irrevocable option for the FVT OCI, then the reclassification to P&L is not possible. So if anyone asks you what is the difference between the debt instrument which was classified as an FVT OCI and the equity instrument which is classified as an FVT OCI, in a debt instrument, if your purpose is to collect the contractual cash flow plus the fair value, then it is a mandatorily, you should consider that financial asset at FVT OCI. But in equity instrument, if that equity instrument is not held for sale, then you are having an irrevocable option to select the FVT OCI. In that instrument, once the gain or loss is transferred into the OCI, for which reclassification to P&L is possible. But in an equity instrument, the once amount is transferred to the OCI, for which reclassification to P&L is not possible. I have various charts. Let's check. This is about the classification of the debt instrument. First of all, we will ask one question. Are the contractual cash flows solely payment of interest and principal? If yes, your business model is just to hold the contractual cash flow. If yes, then we will do the accounting as per the amortized cost. If no, then we will check your business model objective is just to collect the contractual cash flow and also to by selling, then yes for FVT OCI. And in other case, it will be considered as an FVTPL. Clear? Perfect. If we consider the classification of the equity instrument, held for sale, then FVTPL. Not held for sale, then it is not mandatory to categorize in FVT OCI. Friends, this is an irrevocable option. If you want to account an FVT OCI, you can, but if you don't want to, then it will be okay. But yes, please understand, reclassification to P&L is not possible. And whenever it's a derivative, always it is an FVTPL only. And I have one chart, and from this chart, you will get the better knowledge. Let's assume, first of all, the debt instrument. Contractual cash flow characteristics pass. Business model is whole to collect contractual cash flow, then amortized cost. Business model with the objective that result in contractual cash flow and selling the financial asset, then FVT OCI. If not, then FVTPL. If we discuss for the derivative instrument for always it's an FVTPL. And for equity instrument, if it is held for a trade, so simply it would be carried at FVTPL. But if it is not held for sale, then simply we have an irrevocable option of the FVT OCI. Clear? Now, there is one concept of the trade date accounting and the settlement date accounting. In India, we have the cycle of the T+2. Means if we are taking any of the financial instrument today in our demat account, we will get the delivery after 2 days. Logic is very clear. In the trade date accounting, you should recognize the financial asset on the trade date only. And up to the date of delivery, whatever the changes in the fair value, it will be accounted in FVTPL or as per the FVT OCI, whatever the situation. But in the settlement date accounting, we will not record the financial asset today. We will record the financial asset in our books of accounts after the delivery only. That is a basic difference. Clear? So timing of recognition of financial asset is also dependent whether accounting is done by the trade date or the settlement date. Clear? That's completely choice with you. On the trade date, a financial asset purchase is recognized on the trade date along with simultaneous recognition of relative liability to pay for it. Financial asset derecognized on the trade date with recognition of gain or loss on the sale of asset. Under settlement date, accounting of financial asset is purchased is recognized on the settlement date along with simultaneous recognition of related liability to pay for it. Financial asset is derecognized on the settlement date with recognition of gain or loss on the sale of asset. Clear? Perfect. Okay. Friends, for financial asset accounting, I already told you, we are having the three possibility. We can do accounting at amortized cost. We can select the accounting as per the FVT OCI, or we can select the option of the FVTPL. In initial recognition, if you are following the amortized cost, then it will be at the fair value plus transaction cost. Whenever it's an FVT OCI, it will be at a fair value plus transaction cost. But whenever it's an FVTPL, it should be at a fair value. And whatever the transaction cost you are incurring, that is immediately charged to P&L. Next point is very clear. This is an initial recognition. For subsequent recognition in amortized cost method, you should find out the effective rate of interest. And from that effective rate of interest in every year, you should add that interest in your financial asset. Clear? In FVT OCI, We will compare the fair value on the reporting date with the fair value at the time of the initial recognition, and whatever the gain or loss is transferred into the OCI. In FVTPL, we will compare the fair value on the reporting date with the fair value at the time of the initial recognition, and whatever the gain or loss is transferred to P&L. Clear? So let's check. In amortized cost, the amount at which financial asset is purchased at initial recognition minus their payment plus interest using the effective interest method. Any difference between the initial amount and the maturity amount of the financial asset is adjusted for any of the loss allowance. Clear? If financial asset is measured at an FVT OCI, changes in the fair value between the reporting date is charged or credited to OCI. On derecognition of financial asset, cumulative gain or loss previously recognized in OCI is reclassified from equity to P&L. Clear? And the interest income, impairment gain or losses is recognized in the P&L. And now this is the most important. I already explained you difference between debt classified as an OCI and the equity being classified as an OCI. I know very well. In the debt instrument, if your purpose is to collect the contractual cash flow plus the benefit of the fair value, then it's a compulsory to categorize at the FVT OCI. But in equity instrument, if it is not held for sale, then you have an irrevocable option for the FVT OCI. Clear? Next is nothing but any interest, dividend or income is recognized in P&L for the debt instrument. In this case, dividend is recognized in P&L, but other gain or loss is recognized in OCI. And the most important point, on derecognition of the debt instrument, whatever the gain or loss was earlier recognized in OCI is now transferable to P&L. But in equity instrument, if earlier gain or loss was recognized in OCI, is now not transferable to P&L. Clear? This is the basic difference. Perfect? Okay, I am going ahead. There is one new concept, and the name of concept is nothing but, friend, is treasury share. And what is a treasury share? If you are purchasing own equity instrument, then it will be considered as a treasury share. So actually it is like if we have our own equity share capital, but we are purchasing our own equity share from the market, so that equity share will be an investment. Actually, this was not allowed in India. Any company cannot purchase their own equity share. Yes, if you want to select the option of the buyback, you can do that. But you cannot purchase the own equity instrument. And if you cannot purchase the own equity instrument, but under Ind AS, that will be considered as a treasury share. So an entity reacquires its own equity instrument in the buyback process. These bought back shares are termed as a treasury share. In India, there is no concept of the treasury share. However, as per Companies Act, this should be cancelled and cannot be held by company. So this cannot be held as an investment. This investment will be considered again the equity share capital, and we will disclose the net balances. Clear? Second point, in the statement of financial performance, means in the statement of the profit and loss, we will record interest, dividend, loss or gain. It depends on the classification in the balance sheet. Like if we are using the word the redeemable preference share. But if you are using the word the redeemable preference share, but apparently, can I say that redeemable preference share will be considered as a financial liability? Till date, you are using the word dividend on the preference share, but under the Ind AS, now we are telling that redeemable preference share is actually a financial liability. So on financial liability, we should recognize the interest expense and not the dividend. So interest, dividend, losses and gains related to financial instrument shall be recognized in the manner consistent with their balance sheet classification. As for example, an issuer entity classifying preference share as the financial liability must recognize dividend on the preference share as the interest expense. Transaction costs relating to equity in transaction shall be accounted for as a deduction from the equity and net of any related tax benefit. Transaction costs, the related to the issue of the compound financial instrument. And you know very well in the compound financial instrument, there are two elements. One is liability and second is equity. So whatever the transaction cost you are incurring, it shall be allocated in the proportion of the liability and the equity. Clear? Okay. Next is, there are some special points I am taking. That is nothing but the loan between the group companies. And if that loan is repayable on the demand, so friends, understand whatever you the fair value of the interest-free loan is not less than its face value. Clear? And this would evenly apply from the perspective of the lender. So whenever it was a repayable on the demand, financial asset and the financial liability is recognized at an absolute amount only. Clear? This is a repayable on the demand. Next is, there is no fixed maturity. If the loan has no fixed maturity date and is available in the perpetuity, then asset holder and the lender should measure the fair value about the market participants' assumption. Clear? This point should be keep in your mind. Now I am starting with the derecognition of the financial liability. Friends, you should understand this derecognition of the financial liabilities. When we derecognize the financial liability, first of all, we will determine the carrying amount of the existing loan. And how to determine the carrying amount of the existing loan? That is nothing but the present value of the future cash flow by using the original effective rate of interest. Then we will determine the fair value of the financial liability. Means we will determine the present value of the future cash flow as per the revised agreement using original rate of interest. If the difference between that two present value is greater than or equal to 10%, then friends, we will follow the extinguishment accounting. But if it is a less than 10%, friends, we will follow the modification accounting. And now I am starting, what is the modification in the financial liability? Actually, friends, modification means there is no renegotiation of the terms. Rather, it's a change in just the future estimate of the cash flow. Clear? Any difference between the carrying value of the existing loan and the present value of the future cash flow as per the original effective rate interest is adjusted in the P&L with corresponding effect in the carrying amount of the existing loan. Any upfront charges payable for the restructuring is charged to P&L. And means what should you do? You should derecognize the existing carrying amount. Perfect? Okay. But whenever it's an extinguishment or it will be considered as a renegotiation. Friends, it's a restructuring of the new contract leading to cancellation of the old contract and the creation of the new contract. Entity should calculate the present value of the renegotiated future cash flow at current effective interest rate. Upfront charges payable to the restructuring is charged to P&L. Derecognize the existing loan at carrying amount and recognize the loan at a fair value. Differential amount will be charged to the P&L. Is it okay? Okay. If any question you found for the forward and the future contract, now it's a miscellaneous topic, it started. Friends, forward contract is basically a contract which is customized contract for buying or selling of the underlying asset on the future date. You know very well, we are entering into the forward contract for the foreign currency. If I am liable to pay some amount in the foreign currency in the future, and that's why I am entering into the forward contract with the bank. At the time of the forward contract, effectively, if you ask me, there is no premium. So simply, and that time there is a no entry. But on the balance sheet date, if it's valued at a fair value, obviously it's marked to market, it will be valued at a fair value. Simple, if it's a premium, if it is a negative figure, then you should debit the P&L and you should recognize the derivative financial liability. But if it is a gain for you, then you will recognize the derivative financial asset account debit to P&L. If you will solve this sum, then you will unlock better guarantee. Now, upon the settlement, if it's a net asset, then we will receive the money and we will pass an entry, bank account debit to derivative financial asset, and my account is closed. But when it's a liability, we have to pay the money. So simply we will pass an entry, derivative financial liability account debit to bank account. Sorry. And now I am starting with a new point, that is nothing but the reclassification of financial asset. Means first of all, our intention was to collect the contractual cash flow. That's why we have accounted at amortized cost. But now our intention is changing, and now our intention is to collect the contractual cash flow plus the benefit of fair value. So we have to do the accounting as per the FAT OCI. I think you are following me. It may be a reverse situation. So simple, whenever you are reclassifying your financial asset, that accounting should be done with a prospective effect. So entity shall classify the financial asset only if entity changes its business model for managing those financial assets. Such changes are expected to be frequent changes, very infrequent changes, and if entity reclassifying any financial asset, it must do so prospectively from the reclassification date. Clear? Let's do one by one. If you are transferring from amortized cost to FAT OCI, at the date of the reclassification, it should be valued at a fair value, and you are transferring at FAT OCI, so whatever the gain or loss will be recognized in OCI. Clear? If you are transferring from amortized cost to FATPL, so on the reclassification date, it should be valued at fair value. You are selecting the option of the FATPL. So friends, please understand, whatever the gain or loss, that gain or loss should be transferred into the P&L. If you are transferring from FAT OCI to amortized cost, now please understand whatever I am trying to convey. It's an FAT OCI to amortized cost. So till date, whatever the gain or loss, can I say, was already transferred in OCI? That cumulative gain or loss will be adjusted in the carrying amount of the asset. So obviously, that OCI balance is removed and your value of the financial asset is also changing, and that value, from that value, you should calculate the effective rate of interest and for amortized cost method. It will be clear. Now FVTPL to amortized cost. FVTPL to amortized cost is nothing but the carrying amount of the financial asset on the date of change to the carrying amount under the amortized cost method. It will be the same only. Simple, and you have to find out the effective interest. Friends, please understand there is a difference. Whenever you are transferring from FVT OCI to amortized, whatever the balance which was in OCI is adjusted with the balance of the carrying amount of the financial asset, and you have to effectively find out the new effective rate of interest. But whenever you are transferring from FVTPL to amortized cost, the gain or loss was till date credited or debited to P&L. So ignore that, it was correct. Whatever your carrying amount will be the new carrying amount under the amortized cost category, and you have to calculate the effective interest rate. Now, FVT OCI to FVTPL, this is the most important. Fair value change to be adjusted from P&L. Existing OCI balance to transfer to P&L on the realization. Change is not available for investment in equity share accounted under FVT OCI. Because friends, you know very well, whenever you are doing the valuation of the equity instrument, and if that equity instrument is not held for sale, then you are having the irrevocable option to select the FVT OCI. And if you have selected that option, then you cannot now change that particular method. Clear? And the last, FVTPL to FVT OCI, fair value changes is directly now transferred to OCI. So effectively, if you ask me, there are 6 situations: amortized cost to FVT OCI, amortized cost to FVTPL, FVT OCI to amortized cost, FVTPL to amortized cost, FVT OCI to FVTPL, and FVTPL to FVT OCI. Clear? These are the 6 reclassification. Clear? There are some example. Example is not required now. Now, option. This is just a summary. If you are a writer or seller of the option, then you are having the obligation to sell if holder exercise the option. If holder exercise the option. Clear? If you are a seller of the call option, then simply you are seller of the call option. Means you have an obligation to sell. Why you are selling the call option? Because you are finding the bearish trend. But whenever you are seller of the put option, you are finding the bullish trend. And whenever you are seller, so friends, please understand that what I am trying to convey. It's an unlimited loss, but limited gain. Clear? And that gain is limited up to the premium received. More than that, gain is not possible. And in this case, you will receive the premium. Clear? Next. If you are a holder or the buyer of the option, then has an option to exercise or not. Whenever you are buying the call option, so you want to fix price because you are estimating that that price will be increased. So simply you are finding the bullish trend. But whenever you are buying the put option, means you have a right to sell. You want to fix the price today, whatever the market price, because you are finding the bearish trend. And whenever you are buying the option, you have to pay premium. And in that situation, your loss is limited. Your loss is limited up to the premium paid, but your gain is nothing but the unlimited. Clear? This is the situation. Sometimes you are finding this word, at or on money. That means there is a no gain or loss. Whenever you are finding the word that is nothing but the out of the money means it's actually loss making. So simply you will not exercise this option. Whenever you are finding the word that's in the money, it's likely to be exercised. Clear? Okay. Now I am starting with the accounting of the derivative instrument. Friends, it should be valued at a fair value. So there is a no accounting except in case of option at a fair value is nil. In case of option, premium paid or received or will be the fair value of the option, and it will be recognized as the derivative financial asset or the derivative financial liability, whatever. Subsequently, it will be measured at a fair value, and whatever the gain or loss should be transferred to P&L. Clear? Now, this topic is not much more important. Still, we cannot predict the institute. They may ask a question. That is nothing but the hedge accounting. Friends, what is the hedge? Hedge is nothing but the risk. And for covering of risk, if you are entering into any of the contract, then that contract will be considered as an hedge accounting. Entity exposed to various risk, foreign exchange risk, interest risk, price variability, etc., which may not represent the core activities of the business. Therefore, an entity may want to insure itself against such risk by use of the derivative or other financial instrument. In such case, there may be accounting mismatch, as hedge item may be valued using amortized cost method, FVTPL or FVTOCI, but hedging instrument will be valued at FVTPL only. Clear? Hedging instrument is always valued at FVTPL. So Ind AS 109 permits company to opt for hedge accounting on transaction by transaction basis. Means friends, please understand, in today's scenario also, hedge accounting is not mandatory. If you want, you can, otherwise you can ignore that. There are three types of hedge: fair value hedge, cash flow hedge, and the net investment in the foreign operation. Just 2 to 3 lines is given in the module for the net investment in the foreign operations, so apparently this is not much more important. We have to discuss the fair value hedge and the cash flow hedge. Fair value hedge is basically hedge to change in the fair value of the assets and liabilities. And the cash flow hedge is entered into hedge exposure of the variability in the cash flow from the asset or liability or highly probable forecast transaction. Clear? Okay. So if we consider, friends, one example for the cash flow hedge. An Indian importer purchased the raw material of US dollar 1 lakh on 1st March 2020. Exchange rate on the 1st March 2020 is $1 is equal to 72. Company have to make payment after 2 months, that is on 1st May 2020. Importer worried that dollar rate may increase. So to reduce the risk of loss on increase of the dollar, company purchased the forward long contract on dollar at forward rate of $1 is equal to 72.9. On 31st March 20, spot rate is $1 is equal to 72.6 and the forward contract long for 1 month maturity is $1 is equal to 73.30. Spot rate on 1st May 2020 is $1 is equal to 73.5. Clear? So simple, on 1st March, we will pass an entry purchase account debit to creditor account, that is $1 lakh into 72. And on 1st March, there is a no entry for the forward contract. On 31st March, if we consider, my rate is increased from 72 to 72.6. Clear? So this is a loss. We will pass an entry foreign exchange loss account debit to creditor, and that loss is not transferred to P&L. Clear? That loss is transferred to cash flow hedge reserve account debit to foreign exchange loss account. For hedging instrument, I am entered into the transaction at 73.3, but on that date rate is nothing but the 72.9. So simple, we will record the derivative financial asset to cash flow hedge reserve. Simple. Then we will amortize. Simple. This friends, you do the sum, then only you will get the better clarity. Clear? So finally, this is the end of financial instrument. It's a very long topic and mostly question is asked from the amortized cost topic.
Friends, after financial instrument, if we start the Ind AS 113, the name of Ind AS 113 is nothing but the fair value measurement. Friends, this is the most important Ind AS because in all the Ind AS, whenever we are finding the word the fair value, that fair value is determined as per the Ind AS 113. If I discuss the basic objective of accounting, basic objective of Ind AS 113, it actually defines the fair value. Ind AS 113 is a single Ind AS that in all the Ind AS that are giving the guidance for how to measure the fair value. And yes, whenever we are measuring the fair value, how that fair value will be disclosed in the notes to accounts, that will be provided guidance for the guidance by the Ind AS 113. Clear? Second thing, but in every Ind AS, whenever we are finding the word fair value, we are using our Ind AS 113. But the most important part is that there are some exceptions. In a share-based payment, it's in Ind AS 102. Whenever we are finding out the fair value in the share-based payment, we should not use the Ind AS 113, but we will calculate the fair value as per Ind AS 102 only. In the leasing transaction also, we will not take the fair value as per Ind AS 113. Sometimes you are thinking that this is the fair value, but actually it's not a fair value. I am having the best example, that is nothing but the net realizable value as per Ind AS 2. Whenever it's a net realizable value as per Ind AS 2, actually there is a difference between the net realizable value and the fair value. Clear? So simple, measuring that have some similarities to fair value, but actually it's not a fair value. Clear? These are the nothing but the non-applicability point. Now if we discuss the definition of the fair value, this is the most important definition. In this revision lecture I spoke minimum 3 to 4 times.
Fair value is the price that would be received when asset is sold, that would be paid when liability is transferred in an orderly transaction between the market participants on a measurement date. Again, I am repeating. Fair value is the price that would be received when asset is sold, that would be paid when liability is transferred in an orderly transaction between the market participants on a measurement date. Please focus here. Here we are taking the value whenever we are selling the asset. Here we are taking the value whenever we are making the settlement of the liability. So simple. Ind AS 113 is not following the concept of the entry price, but Ind AS 113 is following the concept of the exit price. Clear? Second thing, most important thing is that fair value is a market-based measurement and it is not an entity-specific measurement. Clear? It may be possible I am using this particular property by this way, but actually general public is using this property by particular this way. Simple. So this is not an entity-specific measurement, but this is a market-based measurement. I use the word that is nothing but the orderly transaction. It should not be a forced transaction. It should not be a transaction at the point of gun. It's a voluntary transaction. Clear? Simply then it will be considered as an orderly transaction. For measuring the fair value, simply I am bifurcating the entire topic into the 4 parts. Number 1, we should consider the asset liability. Number 2, we will consider transaction. Number 3, we will consider the market participant, and then number 4, we will consider the price. Let's start the discussion of the asset or liability. Friends, if there is any restriction which is related to that particular entity, then at the time of the measurement of the fair value, we will not consider that particular restriction which is related to entity. But if any restriction is related to particular asset or liability, then it will be considered. Clear? Second change. Friends, please understand, at the time of the measuring of the fair value, you should consider the condition and the location of the asset. At the time of the measuring of the fair value, you should ensure that is there any restriction on the fair value, that all the things we should consider. Next most important thing is that, friends, whenever I am using the word fair value, one thing is very clear, that is nothing but we should check the condition and the location of the asset. Clear? Second is transaction. Friends, as per Ind AS 113, there are 2 types of market. One is nothing but the principal market and second is nothing but the most advantageous market. Friends, the principal market is basically the market in which volume of the transaction is little bit higher. But the most advantageous market is actually most beneficial to us. Means, whenever we are selling the asset, we are getting the higher amount. But whenever we are disposing the liability, we are paying the lower amount. That is called the most advantageous market. Clear? Friends, please understand, if you are having the both market, then you should consider the fair value of the principal market. In the absence of the principal market, we will just consider the value of the most advantageous market. Clear? Then after that, my second point, that is nothing but the market participant. Friends, market participant means the buyer and the seller, means the 2 parties. And what are actually the characteristics of the market participant? Friends, please understand. There are 4 characteristics. That market participant should be independent. He or she should be knowledgeable. He is able to transact in the asset or the liability. And the parties are motivated, but not forces or otherwise compelled to do the contract. Friends, first my word is they are independent. Means they are not related party as per Ind AS 24. They are knowledgeable. So basically they are knowing all the facts and circumstances related to that particular asset or liability. Actually they are able to do the transaction. Means there should not be a minor. And the number 4. That transaction should be a motivated transaction. It should not be a forced transaction. It may be possible. If it is a forced transaction, we are not getting the correct fair value. Clear? Now the next point is nothing but the price. Friends, please understand. I already told you Ind AS 113 is following the concept of the exit price and not the entry price. Exit price reflects the expectation about the future cash flow by selling it to the market participant that would use it in the same way. Clear? Okay. Now there are 2 consider. One is nothing but the transaction cost and second is nothing but the transportation cost. Here I am writing. One is nothing but the transaction cost and the second is nothing but the transportation cost. And we are having the 2 market. One is the principal market and second is the most advantageous market. Friends, if it is the transportation cost, then it will be considered in the both market. But whenever it's a transaction cost is just considered in the most advantageous market, but it will not be considered in the principal market. Why? Friend, transaction cost is basically a cost related to transaction. But the transportation cost is basically a cost related to particular asset or liability. And if that cost is specifically related to particular asset, simply we will consider in the both market. If I can give in one example, I want to sell one of my asset to anyone. But if I want to sell, obviously I have to incur transportation cost for supplying that particular asset from my place to the place of the buyer. So it's necessary. Whatever the buyer, I have to incur that cost. But yes, actually I appointed a broker for doing that transaction. Actually, appointment of broker is not necessary for fulfillment of that transaction. Clear? You can directly sell to the buyer. But yes, if you are not able to find out the buyer, that's why you are appointed a broker. So simple transaction cost, whatever you are paying as a brokerage fee will be considered as a transaction cost, and that transaction cost is related to particular that transaction only. Simply, that's why we are not considering. Clear? Next, if I go further, whenever you are determining the fair value of the non-financial asset, whenever I am using the word the non-financial asset, I am talking about the property, plant and equipment, I am talking about the intangible asset, I am talking about the investment property. What thing you should consider? Friends, obviously at the time of the preparation of the at the time of the determination of the fair value for the non-financial asset, we will consider the highest and the best use of that particular asset. Means that asset should be physically possible, legally permissible, and the financially feasible. Let's take an example. If I want to sell the property which is at the 8th floor, and in my building there is no lift, obviously I will get the lower amount compared to the other building. Obviously, legally permissible. If actually my house is of the 200 square feet only, but I am having the excess space, that's why I extended my house. Actually, that was not legally permissible. Still, I have extended house. Simple. So obviously, we will get the lower price. Financially feasible. Normally, in your area, the price per square meter is nothing but the 50,000, but you are quoting 75,000. So obviously, it's not financially feasible. So you should consider basically three things: physically possible, legally permissible, and the financially feasible. Clear? But whenever you are determining the fair value related to liability in the equity, how you should find out? First of all, our first priority is nothing but the quoted price in the active market. If the quoted price is not available in the active market, we will use the observable input. And if it is again not available, then we will use the income and the market approach. Clear? If I want to determine the fair value of the Reliance share, and if I am the RIL, Reliance Industries Limited, obviously my share is quoted. I will take that only. If my company is not listed, I will take the price of the similar entities with some observable input. And otherwise, if it is not available, I will use the market approach and the income approach. Is it okay? Now let's start the valuation technique. Number one technique is nothing but the market approach. In market approach, we will use the prices and other relevant information generated by the market involving identical or the comparable asset. Clear? Simple. You can use the matrix pricing model and whatever. Clear? This is pure theoretical. Next approach will be considered as the income approach. Income approach, simply you will find out the fair value of the asset by using the present value of the cash flow. You can use the different model, like you can use the Black-Scholes model, you can use the binomial model and the whatever. And the last approach is nothing but my cost approach. Clear? That reflect the amount that will be required to currently replace the asset. That's simply considered as a cost approach. Now fair value hierarchy, if we can check. First of all, we will use the level 1 input. And that level 1 input is basically quoted in the active market. If level 1 input was not there, we will use the level 2 input, that is nothing but the other than quoted in level 1, such as quoted price for the similar asset or liability, or the observable input and whatever. And in level 3, we will use the unobservable inputs. Clear? And according to that, we will find out the fair value. Clear? So friends, finally this is the end of the this particular Ind AS 113. Clear? Friends, if I discuss the next Ind AS, and that is nothing but the Ind AS 108 operating segment. Under the world of accounting standard 17, that is one specific accounting standard, and that is nothing but the segment reporting. Now you should focus here why I am trying to convey this particular Ind AS to you. Because if I give an example, let's assume Tata. And if Tata is making the profit of rupees, let's say 500 crore. But can I say if Tata is making the profit of rupees 500 crore, actually as a stakeholder, I am interested in that particular point. From which area they are making the profit, rather from which product they are making the profit. So I check the profit of the Tata Motors. The profit of the Tata Motors, let's say it's 500 crore. And out of the 500 crore, 400 crore is, let's say, from the commercial vehicle, but the 100 crore is, let's say, from the passenger vehicle. Clear? So simple, you want that bifurcation. Let's assume next case, if I am giving the example of the Nestle, just I am giving my own example, and the Nestle is disclosing the profit of rupees 1000 crore, and if I check from which place they have earned this profit, so I found that out of rupees 1000 crore, 900 crore profit is from the product Maggi, and the remaining 100 crore profit is from the chocolate. Can I say now you are in little bit worry? Why you are little bit in worry? Because government may restrict that product at any time. And if government may restrict that product at any time, 110%. As a stakeholder, I am in tension whether my future profitability will be enough or not. Clear? Next question, if I take, that's nothing but, let's say some pharmaceutical company is making a profit, and if that pharmaceutical company is making a profit, I have to check whether they are making the profit from the research or development, or whether they are making the profit of like anything. Clear? So simple, in this we are just not combining anything, we are segmenting everything. Clear? Simply, next point, accounting standard 17 is totally on the thumb based rule. They are telling you in this particular industry, this type of the segment. But under Ind AS 108, this is totally based on the management approach. If management is taking a decision by using this much information, obviously this information should be disclosed in our notes to accounts. This is totally based on the management approach. There is no thumb-based rule. So if I read this particular thing, an entity shall disclose the information to enable the users of its financial statement to evaluate the nature and financial effects of the business activities in which it engages and the economic environment in which it operates. Clear? It requires judgment in its application. Management should consider the core principle as it determines the segment disclosure rather than relying on the set of rules. There is no set of rules. Totally, we are dependent on the management only. Clear? The basic concept is that we should provide that information which is used by the management. And clear? And by using that information, we are allowing our stakeholder to understand the financial performance and the financial position of an entity. Clear? Simply, my stakeholder will check whatever my financial performance and financial position, it's whether they are located in India or out of India, how well those activities are performing, this will be checked by my stakeholder. Clear? Second change. This is the most important paragraph. Please read that. It allows the financial statement user to review the segment information from the eyes of management as opposed to risk and reward approach. They are now totally depends on the management. If management using this much information, 110%, we will use this much information only. Clear? Perfect? Okay. Friends, please understand. In India, we are preparing two types of financial statement. One is nothing but the stand-alone financial statement, and second is nothing but the consolidated financial statement. And consolidated financial statement is not mandatory for everyone. If you are having some parent or if you are having some subsidiary, associate and joint venture, then only consolidated financial statement is required. Otherwise, consolidated financial statement is not required. If your company is not required to follow the consolidated financial statement, then segment information is just disclosed in the standalone financial statement. Clear? But if your company is required to present the consolidated financial statement, then segment information is mandatory in consolidated financial statement, but it is then optional in standalone financial statement. Means if my company want to prepare CFS, then segment information is must in CFS, but in SFS, entity has a choice to disclose the segment information or not. That is completely choice with the entity. Is it okay? But friends, please understand. Whenever you are disclosing segment information voluntarily, then you can give the title as a segment information only if you are following all the applicable points as per Ind AS 108. If actually segment information is not mandatory in my case, sir, can you give an example? Yes. If my company is preparing the CFS, but I want to disclose the segment information in both CFS and SFS. Actually, in SFS, it's an optional. So, I am disclosing that segment information voluntarily. So, I can give the title as a segment information only and only if it complies all the criteria with Ind AS 108. Otherwise, I cannot give the title. This is clear? I already inform you. If company is not required to present CFS, then standalone financial statement is a mandatory, but in CFS obviously it is not applicable. But if company is required to present the consolidated financial statement, then obviously in standalone financial statement it is optional. They would not deny it, but it's an optional. But in the consolidated financial statement, friends, it is a mandatory. Can I go ahead? Perfect. Okay. For better understanding, I am bifurcating the entire Ind AS into the 4 parts. Number 1. We will identify the CODM. CODM is nothing but the Chief Operating Decision Maker. Because I already told you, under Accounting Standard 17, there was a thumb-based rule. But under Ind AS 108, there is a no thumb-based rule. It is totally depends on the management. So first of all, we will identify who is the Chief Operating Decision Maker in your entity. With consultation with Chief Operating Decision Maker, we will identify the operating segment in our entity. Clear? We will identify operating segment of our entity. After identification of the operating segment, we will select the reportable segment. Means, if I am identifying total 7 segments from my business, I will not disclose each and every segment. I will explain you some conditions. If my segment fulfills that any of the one condition, then I will disclose. Clear? So it may be possible. My operating segment is 7 and my all segment fulfills the conditions of the reportable segment. So my reportable segment is also 7. It may be possible my operating segment is 7. But my all condition is, my all segments are not fulfilling the conditions for the reportable segment. So I am just disclosing the 5. But it is never and ever like this. My operating segment is 7, but my reportable segment is 8. Never and ever. Clear? If I am having just the operating segment 7, I can disclose maximum 7. Over and above that is not possible. Clear? So first of all, we will identify the Chief Operating Decision Maker. After identification of the Chief Operating Decision Maker, we will identify the operating segment. After identification of the operating segment, we will find out the reportable segment. And the last, we will provide the reconciliation. What that reconciliation I am explaining. Clear? So let's start. First of all, the first topic with nothing but the identify the Chief Operating Decision Maker. Friends, actually if you ask me, Chief Operating Decision Maker is mostly from the top level management. But actually it's not necessarily a person. CODM is basically a function. How can we identify that CODM? It's not like that. If it is a Reliance Industries Limited, then I can tell you the Mukesh Ambani is the CODM. Answer is no. Who is CODM? What work will be done by the CODM? CODM, if you ask me, it's basically a person or it's basically a group of person. They are allocating the resources of the entity and they are assessing the performance of the operating segments of the entity. Mostly if you ask me, they are not taking the financial decision making, but they are taking the operational decision making. Clear? So actually CODM is basically a function that allocates the resources of the entity, that assess the performance of the operating segments of the entity. Clear? Second, friends, it is mostly from the top level management, like CEO, Chief Executive Officer, or the COO, that is Chief Operational Officer, or a group of individuals like production manager or the sales manager, whatever. Clear? Simple. My basic fundamental is that, again I am repeating, Accounting Standard 17 was totally based on the thumb-based rule. Here we are producing that information which is used by the management. So my stakeholder will get exact idea about the financial performance and financial position of the entity. Let's take an example. If it's a Navkar Digital Institute and I am the auditor of the Navkar Digital Institute, let's assume. Whenever I am providing the segment information in the financial statement, first of all, my first step is nothing but I will identify the CODM in Navkar Digital Institute. So I ask every stakeholder who is taking the decision in this company. People are telling, here there is only one man show. All the decisions are taken by our respected Managing Director Hitesh Shah sir. Simply, I can find out Hitesh Shah sir is basically a CODM of the Navkar Digital Institute. But basically, if you ask me, again I am changing my situation. I ask every stakeholder who is taking the operational decision. So that's, the people are saying, Hitesh Shah sir is just taking the financial decision. Otherwise, we have the team of the directors and that directors team is taking all the operating decision. So in this case, I can tell you, no doubt, Hitesh Shah sir is a top level management, but actually he will not be considered as a CODM. CODM will be considered as a group of directors who are taking all the operating decision. Clear? This was my second situation. Number third situation. I ask every stakeholder who is taking the decision in this particular company. They are taking. Here, all the decisions are taken by our group of directors. I ask him, whether whatever the decision taken by the directors is a full and final. They said no. Final decision making power is with our managing director. Then in that situation, final decision is taken by the MD. And if the final decision is taken by the MD, who is the CODM, MD will be considered as a CODM. Next, if I discuss, that is nothing but fourth and the last situation. People are telling me here actually the decision is taken by the group of directors. MD is just reviewing that decision. If he finds something inappropriate or he has some other opinion, he is just giving suggestion to the group of directors. After considering this suggestion, my directors will take the final decision. Again, I am repeating the situation. First of all, decision will be taken by the directors. That decision is just reviewed by the managing director. If managing director finds something inappropriate or he has some other view, so he will give just some suggestion to the group of directors, and final decision will be taken by the group of directors only. So I can tell you, in this situation, my group of directors will be considered as a CODM because final decision is taken by them only. Clear? Can I go ahead? Perfect. Next, I have some example. Executive Committee of Company ABC comprises CEO, COO and President. Committee assess the performance and make the resource allocation. Each committee member has a single vote. Who is the CODM of the ABC? Obviously, decision making is with the committee. So who is the CODM? Committee will be considered as a CODM, Executive Committee. Clear? Next, second example. Same as previous slide, except that President can override the vote of committee. He is not just reviewing the decision, he can override the vote of the committee. So simple, final decision making power is with the President. And if the final decision making power is with the President, who is the CODM? President is the CODM. Number two. Same as previous slide, except that supervisory board reviews the operation of the committee. And in each case, you should find out the CODM. If supervisory board is just reviewing the decisions taken by the committee, he is just a reviewer. Final decision making power is again with the committee only. And if the final decision making power is again with the committee only, who is the CODM? Friends, committee will be CODM. Clear? So if we check in answer, CODM is the president and CODM remains the executive committee. Clear? So simply my first step is done. Now, I am checking that this is nothing but my point number 2. After consultation with the CODM, we will find out the operating segment in our business. And how to find out the operating segment in our business. Friends, for finding out the operating segment in your business, you should ask a minimum 3 questions to your CODM. If you are getting yes for all the 3 questions, then I can tell you this is your CODM. Number 1. First of all, we will ask, let's assume my CODM telling me we are having the 8th segment. For every segment, I am asking a 1 question. For every segment, don't ask a common question for all the 8 segment. You should ask separately for every segment. My first question, whether your segment is actually able to earn the revenue. If it is not able to earn the revenue, there is some expenditure only, then it will be okay. Simply. Why? Here, if they are asking you just to identify whether there is any revenue, but here they have not written the word just the revenue. If there is any only expenses, then it will be okay. And that's why you clearly written earning revenue is not essential. Then friends, you are not believing me. Under Ind AS, various entities have reported Research and Development Center as the CODM. You know very well, under Research and Development, there is actually no revenue. We are having just expenses only, and they have disclosed the CODM. They have disclosed that particular segment. Second question, whether your result of that particular operating segment is reviewed by the CODM. And the third, whether the discrete means the separate financial information is available for that segment. If you are getting the yes for every question, then simply I can tell you this will be considered as an operating segment. Clear? Again, I am repeating. First of all, your segment is able to earn revenue. If there is no revenue, they are just incurring expenses. Number 2, whether CODM is regularly reviewed the operating results of that particular segment. And the number third, is there any separate financial information available? If you are getting yes for the every questions, then I can tell you this is your operating segment. Clear? Second thing. Friends, whenever you are finding out the operating segment, but at the time of the operating segment, we are aggregating or we are combining the many segments. If they are consistent with the core principle, if they are having the similar economic characteristics and if similar in each of the following. Let's think in the reverse situation. At the time of identifying the segment, you should consider minimum 5 things. You should consider the nature of the product and services. You should consider the nature of the production process, type of customer, distribution channel, and the regulatory authority. If they are not similar, then simply it will be considered as a different segment. Sir, can you give an example? Yes. Nature of the product and services, I am having the best example, and the example is nothing but the Tata. You know very well, Tata is dealing in various products. If they are not similar, then we will identify the different. Clear? If I discuss the Tata is dealing in salt. Tata is dealing in motors. We have Tanishq, Tata Jewelers, Titan Watches, Tata Sky, Tata Docomo, Tata Steel. Are you following me? So simple, I am bifurcating the Tata on the basis of the product and services. Next, nature of the production process. And I am having the best example, the nature of the production process is nothing but the Amul. How? So friends, please understand. Amul is basically dealing in the various dairy products. They are bifurcating their business. Let's assume they are bifurcating the business like this. One particular segment which is related in which you are doing all the process just automatically. And the second, one particular segment in which you are doing the process at the manually. Clear? Number third, distribution channel. And I am having the best example of the distribution channel is nothing but, let's say, it's an NDI. That is called the Navkar Digital Institute. In Ahmedabad, in Gujarat, basically we are having our live coaching centers. In that particular case, we are providing our services face to face. We are having the different franchises at different locations. And the new venture that is called the Navkar Digital Institute, we are providing our services by online lectures. Clear? So simple. We are distributing our services but through different mode of channel. Clear? Next point. Regulatory environment. And the best example, if you ask me for the regulatory environment, that is nothing but the SBI, State Bank of India. State Bank of India, it's a bank. So RBI will interfere in every activity. Reserve Bank of India. There is a one more segment of SBI that is called the SBI Life Insurance. They are dealing in the insurance products. And if they are dealing in the insurance products, obviously IRDA will interfere. Insurance Regulatory Development Authority of India. Clear? And the next type of customer, I am having the best example that is nothing but the Chroma. Simple, Chroma is having the various wholesale customer, they are having the various retail customer. Clear? So simple, at the time of this particular, you should identify this many things. Clear? Now I am identifying the reportable segment. Friends, whenever we are calculating the reportable segment, friends, you should understand that we will check the minimum 5 condition and the number 1 condition. My segment revenue should be greater than or equal to 10% of the total revenue. And in the step number 1, whenever I am using the word the revenue, please understand that I will consider the internal and external revenue both. Number 2, we will find out the total profit of the all segments in which there is no loss. We will find out the total losses in the all segment in which there is no profit. And whenever we are calculating the whichever is higher. But whenever we are calculating the whichever is higher and that higher amount is in absolute term, means we will not consider the sign. And multiply by the 10%, simple, that point is related to segment result. Number 3, we will check. My segment asset should be greater than or equal to 10% of the total asset. Number 4, I will consider management may disclose any segment as a reportable segment. This is the completely choice with the management. And in number 5, you should ensure that your reported external revenue must be greater than or equal to 75% of the total external revenue. Friends, this step number 5 is only relevant for you for exam purpose when you are having in the question internal and external revenue both. If you are having just the revenue, then you cannot use this step number 5. Please understand, in step number 1 we are using the word revenue, but in the step number 5 we are using the word external revenue. Clear? This will be clear. Now, If any segment was there in 10% criteria in the previous year, if that is not falling in the 10% criteria in the current year, still you have to disclose that segment. Clear? This thing should be clear in your mind. This point is done. And which fact is disclosed? General information we will discuss. Factor used to identify the reportable segment. Types of the product and services from each reportable segment derives its revenue. Clear? Then we will provide the reconciliation. How we will provide the reconciliation? Segment revenue with the total revenue. Segment expense with the total expense. Segment result with the total result. Segment asset with the total asset. And the segment liability with the total liability. That disclosure is required. Clear? Okay, friends. Now please understand what I am trying to convey. If in the current year, you are making a sale of 10% or more to a single customer or a group of customer, then such fact should be disclosed in your notes to accounts. Friends, you have to just disclose the fact. Identity of the customer is not required. Number of units, amount is not required. Just you have to fact the disclose that is in the current year, we have made more than 10% of your sales to the one and only one customer. Clear? Yes. If your CODM is changes, or if you are adopting Ind AS for the first time, you know very well under accounting standard it was a thumb-based rule, but under Ind AS it's nothing but the totally based on the management. So whenever you are changing your segment, obviously you should restate your past information. But yes, whenever we are restating the information, and if it is impracticable, or the information is actually not available, or the cost to develop the information would be excessive, in that situation, if you are not restating the past information, then it will be okay. But if you are not restating the past information, that fact should be disclosed in the notes to accounts. Clear? Okay. And can I go ahead? And there is a key impact if I discuss. There are various companies I am having, and if I discuss the various companies, Biocon is disclosed in the March 16. If I check pharmaceutical balance sheet, they have discussed the pharma and the contract research. But whenever it's in Ind AS, they are discussed small molecules, biologics, branded formulations, research services. Clear? If I discuss for the CIPLA just disclosed in the March 16 exclusively in the pharmaceutical product. But whenever it's in Ind AS, they are disclosing two segments. One is a pharmaceutical and second is a new venture. If I am checking about the Dr. Reddy's laboratory, in March 16, that is profit before interest and tax segment profit. But here it's a gross profit. Clear? This is just for your knowledge. Perfect. Can I go ahead? Now if we discuss the new Ind AS, that is nothing but Ind AS 115, revenue from contract with customer. This is applicable from the May 2019 attempt, and it was actually applicable from the 1st April 2018 in practical life. After introduction of this Ind AS, friends, please remember, our old Ind AS, that is Ind AS 11 construction contract, and the Ind AS 18 is revenue is abolished. I already told you at the time of the introduction of Ind AS, whenever in the IFRS we are getting IFRS 15, obviously Indian public will issue the Ind AS 115. Whenever in the IFRS we are getting the IFRS 16 leases, we have introduced the Ind AS 116. Clear? What is the basically revenue? Friends, revenue is defined as the income arising in the course of entity's ordinary activity of business. It should be related to entity's ordinary activity of business. Clear? Friends, Ind AS 115 is applicable to all the contract with customer to provide goods and services. And that goods and services are basically an output of the entity's ordinary course of business in exchange for consideration. Again, I am repeating. Ind AS 115, the name is very clear. It's nothing but the revenue from contract with customer. So it is applicable to all the contract with customer to provide goods and services. And that goods and services is basically an output of the entity's ordinary course of business in exchange for the consideration. Clear? But yes, friends, please understand, in a short form, it is not applicable to life. And what is the meaning of the life? Life is nothing but the lease contract. Because for the lease contract, we have one specific Ind AS called Ind AS 116. I means insurance contract. We have one specific Ind AS called the Ind AS 104. F is nothing but the financial instrument. We have one specific Ind AS called the Ind AS 109. And the E, that is called the exchange. And what is the exchange? Please understand. There is a non-monetary exchange between the entities which are in the same line of business. Clear? Let's assume there is an entity A and there is an entity B. Yes, there is an entity is in Gujarat and this entity is in the Maharashtra. They are actually having the same line of business. Let's say they are selling some pen in the market. But yes, A is getting the one order from the Maharashtra customer. Simply, he will directly inform to B, just pass this product to the Maharashtra customer on behalf of me. So they are exchanging the non-monetary exchange between the entities which are in the same line of business to facilitate the sales. Clear? So simple. This non-applicability point is very clear. Life. L means there is nothing but lease. I is nothing but the insurance contract. F is nothing but the financial instrument. And E is nothing but the exchange. Clear? Next point. Now let's discuss some definitions. If I discuss the definition of the contract. First, contract is an agreement between two or more parties that creates an enforceable rights of the one party and the enforceable obligation for the another party. Clear? Friends, enforceable means it's a non-cancelable. Clear? And again I am repeating, it's an agreement between two or more parties. Clear? Next, if I discuss the definition of customer. Friends, what is a customer? Customer is basically a party that contracted with an entity to obtain the goods or services. And that goods or services, please understand, that are an output of the main activity of business in exchange for the consideration. Clear? Friends, please understand. Please understand. If I am selling one of my fixed asset to one party, obviously, this will not be in the scope of Ind AS 115. Because that is not an output of my main activity of business. If it's an output of the main activity of business, then only it will be considered. Clear? Income. That is the most perfect definition is given. Income. Income is actually an economic benefit arising during the accounting period in the form of inflow or enhancement of asset or decrease in liability that result in increase in equity other than contribution from the equity participant. Obviously, if I am issuing the IP or FPO, again my equity balance will increase, but that is not included. Here, because of the income, my future economic benefit is increasing, and that future economic benefit may be in the form of inflow, maybe it's an increase in asset, or maybe it's a decrease in liability, and obviously because of the gain, my equity value will be increased. Clear? Okay. Transition provision, this is applicable from the 1st April 2018. You can use either the full retrospective approach or the modified retrospective approach. This will be the okay. Clear? Now, entire Ind AS 115 is totally based on the 5-step model. Number 1, identify the contract with customer. Number 2, identify the performance obligation. Number 3, determine the transaction price. Number 4, allocate the transaction price. And the number 5, recognize the revenue when your performance obligation is satisfying. Clear? Again, I am telling you, there are 5-step model. Number 1, identify the contract with customer. Number 2, identify the performance obligation. In number 3, we will determine the transaction price. After determination of the transaction price, we will allocate the transaction price. And after allocation of the transaction price, we will recognize the revenue. Clear? Let's start one by one. First of all, at the time of the identification of the contract, please understand that contract may be oral, may be written, or it may be implied contract that is based on the customary business practices. Clear? When we can say that this contract is there, just remember my one word. We have IRCTC, but actually in this case we are using the ARCTC. What is the ARCTC? Contract is actually approved by the both party, that is means A. Rights is known by the both parties, that is R. Contract as a commercial substance means C. T means that every party can identify the terms of the contract. And the finally C, there is some reasonable certainty for the collection of the consideration. If I read officially, the parties have approved the contract. Entity can identify each party's rights regarding the goods or services to be transferred. The contract has a commercial substance. Entity can identify the payment terms, and it is probable that entity will collect the consideration. Clear? Then I can tell you it's in a contract. Clear? When a contract does not meet the above criteria, entity receives the consideration, it shall recognize the revenue only when the following event is occurred. Entity has no remaining obligation, and the contract is terminated and the consideration is not refunded. Means, friends, if you are receiving any of the advance consideration, then simply that advance consideration basically your financial liability. But you can recognize that advance consideration as a revenue only and only when you are not having any remaining obligation. And number 2, contract is already terminated and that consideration is a non-refundable. If that consideration is a refundable, then it will be considered as your financial liability. Clear? Next, friends. How can we combine the contract? Simple. In a 3 situation, you can combine your contract. Number 1, The contracts are basically negotiated as a single package. The amount of the consideration paid in the one contract, that is depends on the consideration paid to the another contract. And the number third, that is goods or services in the promised in the contract are basically a single performance obligation. If you are fulfilling any of the one condition, then I can tell you, you can combine your contract. Perfect? Okay. Modification in the contract. Friends, what is the modification? I am just giving an overview. Otherwise, it's a topic of approx 20 to 25 hours. But I want to cover in 20 minutes. So please repose trust on me. Whenever you are changing the price of the contract, or whenever you are changing the scope of the contract, or you are changing the both the things, means you are changing the price and the scope of the contract, and when that changes is approved by the both parties, then simply, friends, understand that this contract will be considered as a new contract. Otherwise, it will be considered as a price of the existing contract. Friends, understand my one point. Because of the change, if the scope of the contract is increasing, and that increasing is actually matched with the standalone selling price of that particular goods or services, then it will be considered as a separate contract. Otherwise, it will be considered as an original contract. Clear? I am having one chart that is for the modification in the contract. First of all, is any goods or services is distinct, means separately? If we are receiving the answer no, then simply it will be considered as a part of the existing contract. If we are receiving the answer yes, we will ask one more question. Whether the consideration increases, which is increasing in the standalone selling price of the goods or services. If no, then you should terminate the old contract and create the new contract. If yes, then simply that new increase will be considered as a separate contract. Clear? Now I am starting with number 2. That is nothing but identify the separate performance obligation. Clear? Friends, what is the meaning of the performance obligation? Performance obligation is basically a promise. Promise to provide goods or services which is actually distinct, or series of goods or services that are substantially the same. Clear? Again one thing, if we are providing the distinct goods or services, or if we are providing a series of the distinct goods or services. Clear? Okay. Control of the asset. We can recognize the revenue in our books of accounts when the control of the asset is transferred to the buyer. Clear? And how can we estimate that, or how can we determine that controls is actually transferred? Clear? Okay. Entity has a legal right for the payment, and the customer has an obligation to pay for the asset. Amount of the consideration to which an entitled in exchange for the goods or services is basically considered the transaction price, and the transaction price do not include any amount collected from the third party. So if I am making the sale of rupees 100, but on the sale of 100, if I am charging the 18 rupees GST, so basically I am collecting rupees 118. But can I say this GST is with not me, this GST should be payable to the government, and if this GST should be payable to the government, this amount is collected on behalf of the third party, and if this amount is collected on behalf of the third party, then simply it will not be considered. Clear? Now, we are determining the transaction price. At the time of the determination of transaction price, friends, you should consider the fair time value of money. Obviously, if it's less than 1 year, then there is no materiality of the interest expense at the time of the unwinding of the discount. We will also consider the fair value of the non-cash consideration and out-of-the-pocket reimbursement. When my consideration is totally variable, means it depends on this situation. Let's assume if I am doing the construction contract and they are giving me a consideration like this. If I complete in a 1 year, they will give me a 5 crore rupees. If I complete in a 2 year, they will give me a 4 crore rupees. But if I complete in a 3 year, they will give me a 3 crore rupees. Can I say I am having the more than 2 value? If I am having the more than 2 value, means you are having the many different possibilities. You should use the expected value method. And how can we use the expected value method? Just I am determining the probability. Probability of the completion of the contract within 1 year, probability of the completion of contract within 2 years, and probability of the completion of contract within 3 years. And finally, whatever the consideration will be multiplied by the probability, and we will find out the total of our variable consideration. But let's assume I am having just a 2 option, either yes or either no. Whenever you are having the just a 2 option, you should use the most likely method. Simple, my rule is very clear. If you are having the more than 2 possibilities, then you should use the expected value method. But if you are having the just 2 possibilities, then you should use the most likely amount. Clear? Second change. If you are providing any volume discount, So basically volume discount are offered to as an incentive to the encourage additional purchase and the customer loyalty. This price is reduced prospectively, means it should not be reduced retrospectively, and it should be reduced for all the purchase. Let's take an example. I am giving you an option. If you are purchasing more than rupees 100, I will giving you a 10% discount on all the goods. Till date you have purchased 60 rupees. So obviously my condition is not fulfilled. And if my condition is not fulfilled, I will recognize the sale of rupees 60 only. Next, you are giving the order of rupees 50. Now, can I say if you are giving the order of rupees 50, your sale is more than 100? Means if you are fulfilling condition. And if you are fulfilling condition, it's my liability to give you a discount. So simply, in this case, I will recognize not the sale of rupees 50. But can I say till date you have purchased the goods worth rupees 110. And I have committed to give you a discount at the rate of the 10%. So simple, I will give you a discount of rupees 11 and 50 minus 11 at that time I will just record the sale of rupees 39. It is considered as I have provided discount retrospectively, but I am recognizing the discount just prospectively. Perfect. Both prospective and the retrospective volume discount results in deferred revenue if the customer is expected to obtain the discount. Clear? Next point. At the time of the sale, if you are having any constraint in estimation of the variable consideration, then what should you do? The variable consideration is included only to the extent that is highly probable that significant reversal of the revenue, rather significant reversal in the amount of the cumulative revenue recognized will not occur. Clear? Okay. Penalty. Actually, you should consider that whether this penalty will be considered as a part of the contract or it will be substance of the contract. If the penalty is inherent in the determination of the transaction price, it shall form part of the variable consideration only. Clear? And whenever you are receiving any non-cash consideration, the non-cash consideration is obviously valued at a fair value. Clear? Okay. This is the most important point. Please understand. I am having two customers, customer A and the customer B. Customer A and the customer B. I am selling to the customer A of the value of rupees 100, and my normal credit period is nothing but the 1 month. Means he will be making the payment within 1 month only. But I am selling the goods to Mr. B at rupees 150. At rupees 150. My normal credit period is 1 month, but I am giving the credit period of 6 months to Mr. B. Can I say, don't you think so? If Mr. B is ready to pay the amount within 1 month only, I am selling the goods at rupees 100 only. And if I am selling the goods at rupees 100 only, but he is not ready to pay the amount within 1 month, he is ready to pay the amount within 6 months. So whatever I am charging extra, this 50 rupees will be considered as a financing component. So whenever you are finding out any significant financing component in the transaction, you should recognize the revenue at a cash selling price only. Difference between your consideration and the cash selling price will be considered as an interest, and that is recorded on the time basis. Clear? So revenue is recorded at cash selling price. Difference between the cash selling price and the consideration to be received will be considered as an interest income. Clear? Now this is the most important point. Number of students are confused here. Whenever you are making the payment of consideration to the customer, let's assume my name of the company is nothing but the Colgate. My name of the company is nothing but the Colgate. Clear? We have one mall that is called the Reliance Mart. Colgate is nothing but the seller and the Reliance Mart is nothing but the buyer. So Colgate company is selling the toothpaste to the Reliance. Clear? So actually the consideration should be payable by the Reliance to the Colgate. Obviously they will make the payment, don't worry at all. But this is the mall of the Reliance and this is the entry point. Colgate is telling to the Reliance, you should keep a rack of Colgate at the time of entrance in front of this place only. So whenever any people enter into the Reliance mall, first of all, they will find the rack of Colgate only. So they will not think about the other toothpaste and directly they will purchase the Colgate toothpaste only. Reliance said, why I will keep your rack in front of our gate? Colgate said, don't worry. If you are putting all the Colgate toothpaste at this particular point, I will make a payment to you. In this case, Obviously, for toothpaste, Reliance will make payment to the Colgate. But in this case, after that payment, Colgate is also making payment to the Reliance for what? For this particular services. Don't you think so? Reliance is taking, Colgate is taking that particular area for their benefit. So if you are making the payment to your customer, actually the Reliance is the customer for the Colgate, right? So simple, in that situation, what should be the entry? If you are receiving any goods or services, if answer is no, then it will be considered as a reduction in the transaction price. But if answer is yes, then till the fair value, it will be considered as a purchase for the Colgate, and excess amount will be deduction from the transaction price. So if Colgate, let's say we have sold the toothpaste worth rupees 1 crore and the Colgate is making the payment of rupees 5 lakh. If Colgate is not receiving any services, then in that case we will recognize the revenue of rupees 95 lakh. But if Colgate is receiving the services and this 5 lakh is actually a fair value, so simply Colgate will recognize the revenue of rupees 1 crore, but 5 lakh will be considered as an expense, it will be considered as a purchase. But let's assume this 5 lakh is actually not a fair value. If we consider the fair value, then it will be considered as a 3 lakh only. Then Colgate will not recognize the revenue of rupees 1 crore. They will deduct the 1 crore minus 2 lakh, the excess over the fair value. They will recognize the revenue of 98 lakh only, and here they will recognize the purchase of rupees 3 lakh only. Can I go ahead? Perfect. So this is the one point. Now we are learning the allocation of the transaction price. It may be possible you are doing the various performance obligation. So whatever amount received is allocated in all the performance obligation in the ratio of the standalone selling price. Clear? So transaction price is allocated to all the separate performance obligation in proportion to the standalone selling price of the goods or services at the beginning of the contract. The standalone selling price should be estimated if it is not observable. Clear? Okay. How to estimate? You are having the three options. You can use the adjusted market assessment approach, you can use the expected cost approach, or you can use the residual approach. Clear? When same for the allocation of discount. Now, satisfaction of the performance obligation. It may be possible your performance obligation is satisfied at the point of time, or it may be possible your performance obligation is satisfied over the period of time. Whenever we are fulfilling our performance obligation, then only we can recognize the revenue in our books of accounts. Before that, it is not possible. How can we say that my performance obligation is satisfied over the period of time? Number one, customers simultaneously receive and consume the benefits provided by the entity. Entity's performance creates an asset for the customer. Clear? There are various methods. Long-term construction contract, there are two methods, output method and the input method. Don't worry at all. Clear? And the performance obligation is, how can we say that this performance obligation is satisfied at a point of time? Friends, as a seller, I am having the right to payment of asset. Seller has transferred all the possession of the asset. Customer has a legal title to the asset. Customer has a significant risk and reward, and customer has accepted the asset. In that situation, we can say that performance obligation is satisfied at a point of time. Now, if we discuss the cost recognition, costs are recognized in the same proportion that applies to the recognition of revenue, except if there is any abnormal cost or input costs that are proportionate to the construction activity. Clear? Simple. This is again a very easy topic. Clear? Now, friends, we are doing in a chart form. Then you will get the better clarity. Yes. We are considering all the charts. Please focus here. Okay. Ind AS 115, revenue from contract with customer. Friends, if we consider the scope, we will excluding the life. And I already told you what is the meaning of the life. Lease, we will cover as per the Ind AS 116. I is insurance contract, that will be covered as per Ind AS 104. Financial instrument is nothing but considered as an Ind AS 109. And the next is nothing but any non-monetary exchange in the same line of business. Clear? Okay. If I discuss the definition of customer, a customer is a party that has contracted with an entity to obtain the goods or services of an entity, which are the entity's output of the main activity of business in exchange for the consideration. Clear? Secondly, next point, if I consider the recognition, you should understand that there are 5-step model. Identify the contract with customer, identify the performance obligation, identify the transaction price, allocate the transaction price, and the satisfaction of performance obligation. Clear? So let's start with the identifying the contract. Whenever I am identifying the contract, friends, you should follow the ARCTC. Means contract must be approved. Each party knows the right. Their transaction has a commercial substance. Terms of the payment is very clear, and there is no doubt on the collection of the consideration. Clear? If you are receiving any advance and the criteria is not met, then the revenue is only recognized if all the performance obligation is satisfied and substantially all the consideration is received, and the most important is that consideration is a non-refundable. But if the contract is cancelled and the consideration is a non-refundable, then again you can recognize the revenue in your books of accounts. Clear? Next point, that is combining of the contract. Friends, contract combination must be at the inception of the contract. Clear? Not in between. Entered at any time or with the same customer either. Contracts are negotiated as a single package. Consideration of the one contract that is depends on the another contract. And the number third, goods or services are promised. It's a single performance obligation. If you are fulfilling any one conditions, then you can combine the contract. Don't worry. And my next topic of this step number 1, that is nothing but the modification in the contract. How can we modify the contract? Friends, whether you are receiving the goods or services and that goods or services are the distinct, if no, then simply it will be considered as a part of existing contract. But if you are receiving the goods or services distinct, then you have to check whether the consideration increases is increase in the standalone price of the standalone selling price of the goods or services. If no, then you should terminate the old contract and you should create the new contract. If yes, then simply it will be considered as a separate contract. Clear? That was my step number 1. Now, next step, friends, if I start, that is nothing but the identify the performance obligation. And friends, whenever we are identifying the performance obligation, friends, you should focus that performance obligation is a promise to either of the following. Number 1, that is nothing but the distinct goods or services. Distinct, that is in relation to product. If the customer can use the goods or services independently or in combination of other goods or which are readily available in the market. Distinct in relation to contract. Clear? The promise to transfer goods or services can be separately identified in the contract. How can we say that these goods or services are distinct in terms of contract? And the integration is, there is no integration of the goods or services promised with other goods or services of the contract. Number 2, goods or services do not modify the customize the other goods or services of the contract. And the number 3, goods or services not highly dependent or the interrelated. Clear? Perfect. Next is nothing but a series of the distinct goods or services that are substantially the same and that are the same pattern of the transfer of the customer. When it molds all the meets the criteria of the performance obligation satisfied over the period of time, we will discuss on the later stage. Perfect. Okay, let's go ahead. Just I am rotating the things. Okay. And friends, the number 3 is nothing but the identify the transaction price. Clear? Friends, that basically transaction price is the amount of the consideration for which entity expects to be entitled in exchange for the goods or services to a customer, excluding the amount collected on behalf of the third parties. Now, if we discuss for the variable consideration, explicit or implicit based business practices, published policies or specific statement of an entity. If I discuss the measurement method, there are 2 methods, that is nothing but the expected value method and the most likely method. Clear? It is probably the based method used when number of possible outcomes are the more than 2. Clear? We will use the expected method when the outcome is more than 2. Most likely method, this method is used when only 2 outcomes are possible. Perfect? Okay. If we discuss the constraint of the variable consideration should form part of the transaction price only when it is highly probable that will reversal of cumulative amount of revenue will not occur. Indicators of the lack of high probability. Variable consideration depends on the factors outside the entity's influence. Number 2, uncertainty is not going to be resolved in the near future. Number 3, entity's practice of either offering a broad range of concession or the changing the payment terms and condition. Number 4, entity has limited or no experience or other evidence with similar types of contracts, or the past experience do not have any predictive value. And the number 5, contract has a large number and the broad range of possible consideration of the amounts. Clear? Perfect. If penalty is inherent in determination of the transaction price, it should form part of the variable consideration. Now, if we discuss for the significant financing element, revenue is equal to cash selling price only. Per consideration minus cash selling price will be considered as an interest. Discount rate should be the one that would be reflected in the separate financing transaction between the entity and its customer at the contract inception. After contract inception, entity shall not update the discount rate for changes in interest rate or the other circumstances, and there may be determined rate by the identifying the rate of discount at normal amount consideration in the cash selling price. Friends, if you are receiving any of the non-cash consideration, that non-cash consideration must be measured at a fair value. If fair value not determinable, the standalone price of the goods or services promised to the customer. Next, whenever you are making any amount paid to the customer, my best example is nothing but that Colgate and the Reliance Mall. If you are receiving the goods or services, if no, then it will be considered as a reduction from the transaction price. But if yes, then if you have to consider, if transaction price is greater than fair value, if no, then it will be considered as a purchase. But if the transaction price is greater than the fair value, then up to fair value it will be considered as a purchase, but excess is reduction from the transaction price. Clear? Okay. Now let's start this new topic. Just I am rotating the things. Okay, that is nothing but for the allocation of the transaction price. And if it is allocation of the transaction price, friends, please understand, allocation should be done based on the standalone selling price of the goods and services. And the methods to estimate the standalone selling price, you have the various options: adjusted market assessment approach, estimated cost plus profit margin approach, and the residual value approach. Clear? Okay. Discount will be considered as a total standalone selling price is equal to minus total consideration will be considered as a discount. That discount will be allocated all the performance obligation in the ratio of their standalone selling prices, or it will be allocated to one or more, but not all this performance obligation. Clear? When there is an observable evidence and all the following conditions are met: number 1, entity regularly sells each distinct goods or services or the bundle of the goods or services on standalone basis. Entity regularly sells some of those bundle of the goods or services on the standalone basis at a discount. And the number 3, discount attributable to each bundle is same as discount in the contract. Clear? Discount should be allocated by using the residual value approach. Next, if we consider the allocation of the variable transaction cost, that is allocated to the entire contract and allocated to one or more, but not all the performance obligation or the distinct goods or services in series of the single performance obligation. Clear? And now we are changing the transaction price. Simply, friends, now if we move further, okay. And this point is nothing but the satisfaction of the performance obligation. Friends, please understand what I am trying to convey. Revenue is actually recognized when your performance obligation is satisfied. Performance obligation is maybe satisfied over the period of time, or the performance obligation is maybe satisfied at a point of time. How can we say that the performance obligation is satisfied over the period of time? Simply, friends, please understand. In this situation, it is considered as satisfied over the period of time. First, customer receives and consumes the benefit as entity performs. Number 2, performance creates or enhances the asset which is controlled by the customer. Number 3, this asset is created has no alternative use to the entity. Clear? And friends, simply friends understand that it may be possible you are imposing some contractual restriction. And whenever it's so satisfied over the period of time, friends, you should measure the work in progress. And for the measurement of the work in progress, you can use the output method or you can use the input method. Output method, value of the goods or services recorded till date, and the input method, input of the efforts used till date divided by total expected output. Clear? And it only consider the inputs that represent entity's efforts to satisfy the performance obligation. Clear? This is nothing but the measurement of the progress. Performance obligation is satisfied at a point of time. If performance obligation is not satisfied over the period of time, it will be considered as a performance obligation satisfied at a point of time. Clear? When we can say that it is at a point of time, you are having the right to payment of asset, possession has been transferred, customer is having the legal right, customer has the significant risk and rewards, and the customer has accepted the asset. Clear? Okay, let's move further. Now if we discuss the one special point, that is called the sale with the right to return. Refund can be in form of full or partial refund of any consideration paid, or credit that can be applied against amount owed. that will be owed or to the entity and another product in exchange. Clear? Okay. Revenue should be recognized for the amount to the which the entity expects to be entitled. That is, no revenue be recognized for the total product expected to be returned. Clear? Number 2, for any amount received or receivable for which an entity does not expect to be entitled, entity shall recognize the refund liability. Next, if I discuss, an asset is a right to recover the product from the customer by selling the refund liability and the corresponding adjustment to the cost of sales. Clear? Okay. Just I am rotating the things. And if we discuss for the warranties, generally warranties are given as assurance that product complies with agreed upon satisfaction and accounted as per Ind AS 37. Clear? If a customer has the option to purchase the warranty separately, then the warranty is a distinct service because the entity promises to provide the additional goods or services to the customer and the above general insurance. Accordingly, entity shall account for the promised warranty as a performance obligation and allocated a portion of the transaction price to it. Clear? Next point. For assessing the warranty, provide additional services, following factors should be considered. Just remember my one line, that is called the L and T. L and T. That is not warranty required by law, and its nature of task to be performed, and the time. Clear? If I discuss for the warranty required by the law, generally warranty required by law is to protect the customer from the defective purchase. Promise for such warranty is not a performance obligation. Clear? Okay. Nature of tasks to be performed. Tasks necessary to provide assurance that a product complies with agreed upon satisfaction. Clear? That give rise to a separate performance obligation, and the time is nothing but the length of the services. Perfect? Next, friends, if I discuss, customer has the option to buy additional goods or services. Option can be form of the customer award credit or the contract renewal option or other discount on the future goods or services, etc. Please understand. Does the option provide material right to the customer? If answer is no, no separate performance obligation. But if answer is yes, is option to buy additional goods or services, it's at standalone selling price? No, then treat it as separate performance obligation and allocate the transaction price to the ratio of the standalone selling price. Treat it as an advance for the future goods or services and they recognize the revenue when those goods or services are transferred to the customer. Clear? Next point if I discuss, that is nothing but the non-refundable upfront fees. Just a minute. Friends, if it is a non-refundable upfront fees, generally upfront fees relate to activity that an entity is required to undertake at or near contract inception to fulfill the contract. That activities does not result in the transfer of profits or goods or services from the customer. Hence, it should be recorded as an advance for the goods and services, and the revenue is recognized when the goods or services are provided. If those set of activities do not satisfy the performance obligation, the entity shall disregard to those activities and when measuring the progress. And if the fees related to goods or services, entity should identify whether it amounts to the separate performance obligation or not. Clear? Okay. Next, if I discuss regarding the license. This is the most important point. You have to understand this license. Clear? Friends, what is the license? A license establishes a customer rights for the intellectual property of the entity. Please understand. Are goods or services promised along with the promise to provide license? If no, the single performance obligation. But if yes, two separate performance obligations should be identified. Number one, promise to provide goods or services and the promise to provide the licenses. Clear? Okay. When we can say that it's a promise to provide licenses, right to access, that is nothing but the performance obligation satisfied over the time, or if all the following criteria are met. Which are the criteria? That is nothing but the contract neither explicitly or implicitly convey that entity will undertake the activities that significantly affect the intellectual property to which the customer has a right. The right granted by the license directly exposed to customer to an effect. Clear? And those activities do not result in transfer of goods or services. Perfect. This was the point. And finally, my Ind AS 115 ends here. And now I am starting with Ind AS 116. Just focus here. The name of Ind AS 116, friends, is Leases. This is the new Ind AS for the CA final student, applicable from the November 2020 attempt. Clear? Actually, this Ind AS was introduced on 31st March 2019. It's actually converged IFRS 16. Ind AS 116 actually replacing the existing Ind AS 17 with effect from the 1st April 2019. Means for the lease accounting, we will now not follow the accounting, Ind AS 17, but we will follow Ind AS 116. It set out principles for the recognition, presentation and disclosure of leases. The key change that has been introduced is the elimination of the classification between operating and finance link, which means all the lease on a lessee's balance sheet will be recognized. Clear? In the books of lessee, we will not bifurcate any of the lease as operating and the finance lease. All the lease will be considered as a finance lease in the books of lessee. Lesser accounting remains unchanged. A lessee would required to recognize the right to use of an asset and the lease liability in their balance sheet. Is it okay? Friends, if we discuss the next topic, then it is nothing but your impact on some industries. That is nothing but on aviation companies. Number of aviation companies are taking their aircrafts on the operating lease in accounting standard 19 or as per Ind AS 17. That's why they have not recorded that particular airplane in their balance sheet. Clear? But problem is that but now as per Ind AS 116, every lease is to be recorded as a finance lease in the books of company. And if it is recorded in the books of the company, so simply, first of all, that asset was not recorded in their balance sheet, but now this asset was recorded. So simply, friends, my purpose is nothing but there are some off balance sheet items that is I am recording on the balance sheet. Clear? So next, if I discuss scope, Ind AS 116 is not covering the exploration of the minerals, oils and natural gas. For that, we have one specific Ind AS called Ind AS 107. Exploration and evaluation of mineral resources. Leases of the biological assets, that is nothing but the Ind AS 41. Service concession arrangement as per Ind AS 115. License of the intellectual property rights as per Ind AS 115. Right held by lessee under licensing agreements such as motion picture film, video recording, patent and the copyright, etc. Simply, this is nothing but as per Ind AS 38. Clear? Can I go ahead? If I discuss, friends, the meaning of the lease. Friends, lease is basically a contract or a part of contract whereby the lessor conveys to the lessee the right to use an underlying asset for an agreed period of time in exchange for consideration. Now, there are some contracts in which you have to determine whether this particular contract is actually lease or this contract is not a lease. Let's discuss. An entity should consider whether the contract transfer control of asset itself, then the transaction is a sale or purchase within the scope of Ind AS 115 or Ind AS 16 and not covered by Ind AS 116. If that transaction is particularly for the purchase or the sale, then it will be considered as a sale transaction. Clear? To determine whether the contract is a lease contract and or not, following criteria should be considered. First of all, we will check that must be a contract or the part of contract. Right to use of an asset for a specified period of time in exchange for the consideration. Clear? Now, whether this contract or a part of contract, Ind AS 116 provides a guidance to determine whether a contract is a lease contract or the service contract. An entity should separate the lease component and the non-lease component based on the relative standalone selling prices. Clear? Now we are checking right to use an underlying asset. Clear? At commencement of the lease term, an entity should ensure that if contract conveys the right to use of an asset for a period of time, then it will be considered as a lease. Clear? Again, my word is very clear. You are transferring the right to use of an asset for a specified period of time. To control the use of an asset, lessee have the right to obtain substantially all of the future economic benefit from the use of the asset throughout the period of the use. Friends, my word is very clear. Substantially all and then not all. Like if I am taking one building on the lease, and if I am taking the one building on the lease and some person say, you should use that particular building for specified time period only. So 110% I can tell you, I am not getting the substantially all of the future economic benefits. Clear? Next, if we discuss, right to use an underlying asset. Right to control the use of the identified asset includes the right to direct the use of the asset. Means lessee has the right to direct how and for what purpose the asset is being used throughout the period of use. Clear? Now let's check the right to use an underlying asset. An underlying asset can be identified. If yes, then that contract will be considered as a lease. If not, then that contract will not be considered as a lease. Clear? Let's take an example. CCD outlet occupies a certain area of the Ahmedabad airport, but the specific place will be determined by the airport authority based on the free space. Simple, if I found some free space here, I will tell you to open your outlet here. Tomorrow, if this space is occupied by someone, then I will tell you, please open your outlet here. Simply, in this particular situation, the space is not identified. It is not a lease contract because the owner can exchange one place for another and no asset can be identified. Clear? Next example, if I can take. CCD will occupy shop number 10 at Ahmedabad airport. This place is assigned to the CCD and no one can change it during the contract. The contract contains a lease because the underlying asset can be identified. Clear? Now I am taking substantive right to substitute the asset. Please listen this point very carefully. Sometimes customers, lessee does not have the right to use of an asset if the supplier has the substantive right to substitute the asset throughout the period of the use. How can we say that the supplier has a substantive right to substitute the asset? If they are fulfilling two conditions. First condition, if supplier has the practical ability to change the space used by the customer, and the supplier would benefit economically from the substituting the asset. Clear? If the supplier has a right or obligation to substitute the asset only after either a particular date or on occurrence of the specified event, supplier substitution right is not substantive because the supplier does not have the practical ability to substitute the alternative asset throughout the period of use. Clear? Okay. Friends, we are having an example. Customer enters into contract with transportation agency for transportation of goods from Ahmedabad to Mumbai on a specified vehicle. The vehicle is explicitly specified in the contract, and the supplier does not have the substitution right. The goods will occupy substantially all of the capacity of the vehicle. Supplier operates and maintains the vehicle and is responsible for the safe passage of the goods. Customer is prohibited from hiring another operator. Clear? The contract does not contain a lease because the customer does not have the right to control the use of the vehicle. Customer does not have the right to direct how and for what purpose the asset is being used, and the customer has no right to change how and for what purpose the vehicle is used during the period of the use. Clear? Okay. Yes, friends. Sometimes supplier is keeping with him some protective right. Means I am giving my property to a lease to you, but I can tell you, don't do any illegal activity here. You cannot start the liquor business on my premise in Gujarat. Clear? So simple, I can restrict you that. But simply, I am keeping just the protective rights. Sometimes a contract may include terms and conditions designed to protect supplier's interests in the asset or to ensure suppliers competitive with laws and regulation. Protective right define the scope of customer right of use, but do not prevent the customer from having the right to direct the use of the asset. Protective rights do not restrict the customer to obtain the economic benefit from the use. Clear? Perfect? Okay. Now we are discussing the lease term. What is a lease term? Lease term is always begins on the commencement date of the lease. What is the meaning of the commencement date? That is the date actually when the asset is available to the lessee. There are two dates. One is nothing but considered as a inception of the contract, and second is nothing but the commencement of the contract. When both parties are doing the contract, that date will be considered as an inception of the contract. But when the both parties are not entering into the contract, but actually when the asset is available to the lessee, then simply it will be considered as the commencement of the contract. Clear? Simple, you have to record the right to use of asset and the lease liability. If I discuss the lease term entity shall apply the definition of contract and determine the period for which the contract is enforceable. A lease is no longer enforceable when the lessee and the lessor have the right to terminate the lease without permission from the other party with no penalty. Lease term also includes the rent-free period provided to the lessee by the lessor. Clear? And friends, whenever we are calculating the lease payment, which we will consider fixed lease payment, less if any we are receiving any lease incentive, variable lease payment that depends on some index, amount expected to be payable by the lessee under residual value guarantee, exercise price of the purchase option if the lessee is reasonably certain to exercise that option, and the payment of penalty in termination at the time of the termination of the lease. Clear? Okay. This is just a summary, don't worry. Friends, I told you, in the books of lessee, now every lease will be considered as a finance lease, and the lessee will record the asset in the name of the right of use of asset. But there are two relaxations. If that lease is a short-term lease, or if that lease is related to the low value lease, in that situation, if we are not following the Ind AS 116 criteria, means whatever the payment we are making is simply charged to P&L, and it will be considered as a expense only. A short-term lease is a lease that of the commencement has a term of the less than 12 months. A lease that contains a purchase option cannot be considered as a short-term lease. Lessee can elect, means they have a choice to treat the short-term lease by recognizing the lease rental as an expense over the lease term, rather than recognizing the right of use of asset and the lease liability. The election needs to be made on a class-by-class basis. Similar election on the lease-by-lease basis can be made in respect of the low-value leases. Clear? If we now discuss impact of the lease modification on the short-term lease. Clear? There is a lease modification, there is any change in the lease term. Perfect? Okay. Now, the low-value lease. This is the most important. This is a new topic. Please understand. Whether an underlying asset is of the low value is performed on an absolute basis. Leases of the low value asset qualify for the simplified accounting treatment. An underlying asset can be low value only if, first, lessee can benefit from the use of the underlying asset on its own or together with other resources that are readily available to the lessee, and the underlying asset is not highly dependent or interrelated with other asset. A lease of underlying asset does not qualify as a part of the low value if the nature of the asset is such that the asset is typically a new car, that not be a low value. Obviously, clear? And if it's a low value of the lease or the short-term value lease, then simple, that is whatever you are making the payment simply will be considered as the interest expense. Now I am starting with the accounting in the books of lessee. Whenever we are doing the accounting in the books of lessee, first entry we will pass, that is nothing but the right of use of asset account debit to lessor. Because we are not bifurcating whether this is a finance or operating, every lease will be recorded. And this amount is nothing but the lease liability plus prepaid lease payment plus initial direct cost plus if there is any dismantling cost, or if we are receiving any lease incentive, then it should be deducted. Clear? And finally, this will be recorded at a present value. Next, we will record interest expense to lessor. Third, at the time of payment, we will pass an entry lessor to bank. In my books, we have recorded one asset, right of use of asset. So simply for that purpose, we will pass an entry depreciation account debit to right of use of asset, and the both expenses charged to P&L. Subsequently, you are having two choice. You can use the cost model or you can use the revaluation model. Clear? Okay. Depreciation is mandatory. Next, if I go ahead, lease modification. Lease modification is defined as a change in scope or the lease of the consideration of lease. It may be possible lease modification is considered as a separate lease, or it may be possible lease modification is not considered as a separate, exactly like Ind AS 115. When it is considered as a separate lease, modification increases scope of lease by adding right to use of one or more underlying asset, and the consideration for lease increases by amount commensurate with the standalone selling price of the increase in the scope. Means your scope should be increased and your lease rental should be increased, and this lease rental should be comparable to market rent. When if it is not accounted as a separate lease, lease should be allocate the consideration in modified contract applying the requirements of Ind AS 116. Determine the lease term and remeasure the lease liability by discounting the revised lease payment using the revised discount rate. Clear? Lease modification is not accounted as a separate lease. Lessee should account for the remeasurement of lease liability as follow. Lease modification that decreases the scope of lease by decreasing the carrying amount of the right of use of asset to reflect the partial or full termination of the lease should be recognized in P&L. For all other lease modification, making corresponding adjustment to the right of use of asset. Clear? In the lessor book, we will bifurcate whether it's a finance lease or operating lease. Now, number of students are asking me a question. Sir, if in the books of lessor, it is an operating lease, then there is no problem. Because that asset is de-recognized in the books of lessor and the lessee will recognize in the name of the right of use of asset. But sir, in the books of the lessor, if it is a, sorry, my mistake. If in the books of lessor, if it was the finance lease, then it should be de-recognized in the books of lessor and the lessee will record, then don't worry. But if it in the books of the lessor, it's an operating lease, then problem is such that lessor is continue to recognize that asset and the lessee will again record that asset. So don't you think so it is actually a double accounting? Answer is no. Lessor is recognizing an asset, but lessee is recognizing the right of use of asset. It's a different thing. Clear? Simple. We will check how to determine the finance lease in the books of lessor. If lessee has the option to purchase the asset at the end of the lease term, if the lease term covers substantial portion of the useful life of the asset, if the present value of the minimum lease payment covers substantial portion of the fair value of the asset, and if the asset is of the specialized nature other than lessee, anyone cannot use that. Clear? Whenever we are if it is finance lease, then we will pass an entry lease receivable account debit to asset account with the amount of the net investment. Net investment is nothing but the present value of the gross investment. Gross investment is nothing but the minimum lease payment and the unguaranteed residual value. Clear? Second entry, we will pass the lease receivable account debit to interest income. Third entry, bank account debit to lease receivable. And the fourth entry, interest income account debit to P&L. Now, if it's an operating lease, then don't worry. But if it is a sale and lease back agreement, then you should understand. If you are transferring the asset and it is considered as a sale as per Ind AS 115, then in the books of lessee, we will de-recognize the asset and apply the lessee accounting model to the lease back. Measure the right of use of asset at a retained portion of the previous carrying amount and the recognized gain or loss. But if transfer is a sale as per Ind AS 115, then recognize as per the recognized underlying asset in the books of lessor it is accounting model to the leaseback. If transfer is not a sale, then in the books of lessee, continue to recognize the underlying asset and they recognize the financial liability as per Ind AS 109 for any amount received from the buyer. If transfer is not a sale, then in the books of the lessor, don't recognize underlying asset. Recognize financial asset as per Ind AS 109. Let's take an example. I have a carrying amount 720 lakh, useful life 12 years, sale at fair value rupees 1000, asset simultaneously leased back, annual lease payment rupees 230 lakhs per annum for the 3 years, transaction qualify for the sale under Ind AS 115 and the present value factor is 570 and the discount is nothing but the 10%. Simple if we consider the carrying amount of the right of use of asset. Out of the total fair value 1000, my present value of the lease payment is 570, means it's 57%. Of rupees carrying amount 720, so I will recognize the right of use of asset at rupees 410. Whenever I am selling this asset, I am receiving the cash. That's why cash account debit for 1000 lakhs. I am recognizing the right of use of asset at rupees 410 lakh to sale account, means to PPE 720, to lease liability and to gain 120. Clear? Sublease. What is a sublease? If this is a lessor, he is giving one property to the lessee on lease, and again that property was giving on the again lessee. So this person works like the intermediate lessor. Then it's considered as a lessor. If I am giving my property, which life is 10 years, and let's assume for the 4 years, then obviously for me it's an operating lease, but lessee will recognize that asset. But this intermediate lessor, if giving this property for the 3 years, so simply we will not compare 3 years with the 10 years, I will compare that 3 years with the original lease term with 4 years, simply, and accordingly we will identify. Clear? Perfect. So these are the basically the revision session. And friends, please understand, I tried to cover entire topic, entire Ind AS. Actually, it needs 200 hours, but I tried to cover in 8.5 or the 9 hours. Clear? Thank you, friends. Thank you very much, and the best of luck for your exam.
If you like this video, share it with your friends. Subscribe to our YouTube channel to watch more such videos and learn from our expert faculty members. Press the bell icon to get regular notifications whenever we upload a new video. Download NDI mobile app to get complete CA course online. We value your support. Thank you for watching.